Welcome everyone to SumZero's Top Stocks Virtual Investor Summit. I think this is going to be awesome. As many of you know, we have been hosting Top Stocks for the last 7 years or so, with the goal of really bringing the community together, and also obviously creating just great ideas for everyone to consume. This year, for the first time, we're sort of giving our winners the opportunity to sort of pitch and summarize their ideas on a live call. And we've also invited a number of kind of outside guests. So we're going to be covering a number of interesting topics. We've got, just as an example, Manish Pabrai is going to be talking about Turkey. We've got Guy Spire, who's a legendary value investor, who's going to be talking about a couple names in India, as well as Credit Suisse Group, as far as I know. We're going to be talking about ChatGPT. We've got the lead internet equity analyst from RBC going to talk about big tech. And even my wife, who's going to be talking about inflation. She's the head U.S. inflation strategist at JP Morgan. So it should be a really interesting day, sort of packed with lots of information and insights. So with that, I don't want to take up too much of your time. Love to sort of get the ball rolling here. I'm going to just ask Braden to introduce our first speaker. So Braden, I don't know if you want to make that intro.
Our first speaker is actually Alexander Nelson, who won our Rising Stars Challenge, which we ran alongside our annual Top Stocks investment competition. Always our widely marketed and kind of participated in competition throughout the year. That competition was voted on by a panel of some of our more senior investment professionals. And Alexander kind of emerged from a pretty serious and extremely talented group with his report on Burford Capital, which he'll have an opportunity to walk through here today. So quick background on Alexander. He's an investing student from the Nordics, and appropriately so values in-depth research, much like many folks here, and independent thinking and philosophical openness. He likes to actually spend his days learning from the best investors on the planet, and attempting to internalize their lessons, which I think has sort of paid off for him here in terms of his success with this report. So I'll hand it over to Alexander. Looking forward to hearing his report and thesis on Burford, and we'll go from there. Alexander, I'll pin you.
Thanks a lot for that introduction, Braden and Divya. I'm super honored to be here. It's going to be a lot of fun. I'm going to quickly share my screen. You can see my presentation. It should be on the screen visible for you all now. So yes, I'll be speaking about Burford Capital. Super brief then about me again. My name is Alexander Nelson, and I'm currently a student at Lund University, class of 2025. If you'd like to contact me, easiest way to do that is email alexnelt@umich.edu. And a quick disclaimer. I'm currently an intern at Caracan Capital LLC, who is long Burford Capital. However, I submitted and won this SumZero contest before starting my position with Caracan Capital. So this is purely coincidental. I here present my own views only and do not represent the views of Caracan Capital. This is not an endorsement to buy or sell any securities by Caracan Capital. I'm solely communicating my own views, again, just iterating that as an individual. So Burford Capital, why is this something that's worthy of your time? Well, Burford operates in a quickly expanding market with high returns that are uncorrelated to economic and financial markets. Within this industry, incumbent players benefit from competitive advantages like deep relationships and information asymmetry, and this provides the opportunity for above average returns. Thirdly, and this is where price dislocation comes into play, investors are worried of potentially misrepresented accounts and the unpredictability of year-to-year results. And this gives the opportunity. And let's dig deeper into that. What specifically are investors worried about? Well, there's accounting complexity as GAAP treatment of fund structures and financial assets, which we will talk more about, lead to a murky financial picture. Moreover, unpredictable short-term results make investors worried as there are irregular income profiles that confuse your sense of the business, and there's limited information disclosures on individual cases that the company makes that create some type of sense of black box. Tying into that point, a legacy short report that pointed to many of these uncertain elements infused fear in investors. And finally, there's a large legal case where Burford could potentially win over $1 billion that created sort of a binary bet that you can only own the stock if you have a certain view on the outcome of the litigation, which I don't necessarily believe to be the case. But let's step back. What is litigation finance? Litigation finance is non-recourse financing of commercial legal cases to corporate plaintiffs and law firms in exchange for an economic interest in the outcome of that litigation. It involves two parties, the litigation funder and a claimant whose rights have been violated. The funder provides a cash advance, and it's a bit quiet. I'm going to try to make it a bit louder and see if it helps. The provider provides a cash advance, but only gains an economic interest only in the case. They do not own the case specifically. The general funding structure varies specifically, but if we assume some type of normalized structure, it includes a preferred return on the cash advance and a percentage or multiple of the recoveries. It's a quickly growing market that's only been sort of active in the last decade or so, having started in the 2000s, but really picking up the pace after the great financial crisis. This is due to the fact that legal services has long been a cash-only business, but it's now finally starting to become a user of capital. What is it that attracts companies to litigation finance? Well, first of all, many small firms may simply lack the necessary finances to bring forth an affirmative claim, making litigation virtually impossible without funding. Second of all, there's an opportunity cost to litigation. Companies are not in the business of litigation and often have a hard time weighing the value of a claim, which requires the forecasting of various legal elements relative to investing in new growth projects where they do have expertise. A funder can here come in and improve capital efficiency by monetizing the value of their legal assets. Cost-related, there's finally an accounting benefit as cost-related litigation are expensed through the income statement, depressing current net income, while any recoveries are reported as a non-operating income, which are often dismissed by investors. So you can balance the reporting with using litigation finance instead. Looking at the market as a whole, the commercial side of litigation finance, which we are interested in, was pinpointed at $12.5 billion in 2021. The US, which constitutes half of this market, has litigation finance has a 13% market penetration within legal services as a whole. This provides some sort of context of how large the industry is. And the US is currently the most mature legal market, so keep that in mind. It's a market that's been growing very rapidly, almost at a 30% CAGR over the last several years, and is expected to continue to grow at an almost double-digit rate for the next 6 years. But let's move on to Burford specifically. Burford is the largest litigation finance company in the world with more than $4 billion in assets. It invests in every stage of the litigation process and across all verticals, including single case, cross-collateralized portfolio financing, asset recovery, post-settlement, and monetizations. In the beginning of the litigation finance industry, single case investing was the most regular type of deal. But as the industry has matured, portfolio financing has become more and more common. This is where Burford specifically specializes. I would also point out some unique elements of Burford, and I've highlighted their asset recovery and enforcement team. Burford has developed over time an internal talent to execute on enforcement. This is important because it's very, very difficult to price enforcement risk. It's super uncertain, and having this internal expertise in-house gives Burford more visibility into the expected value of cases than other funders. You'll see on the screen that assets under management for Burford is 2 times that of the closest competitor. And as the company continues to compound at a high absolute rate, I would guess that this discrepancy only continues to grow. The company was founded in 2009 by Christopher Bogart and Jonathan Mollott, who are still much involved in the business. Mr. Bogart, who's the CEO, has a long background of being a litigator, and he owns more than 4% of the business. The same can be true for Mr. Mollott, who's the CIO, professor of law, and one of the most cited experts in the field of litigation finance. The compensation policy of Burford, I just want to highlight, this will be important later on. All performance compensation is measured based on cash generation. And since we'll talk about the short report shortly, where they talk about the fair value adjustment Burford makes, we just remember that everything is based on cash generation. The portfolio has over time produced great returns, with Burford's overall return when treating their entire investment book over time as one portfolio. The result has been a 93% return on invested capital and a 30% IRR. So that would give you a weighted average life of each investment of about 2.3 to 2.4 years. The portfolio breakdown very, very diversified across industries, geographies, and case types. You'll note that settlements provide a very similar IRR to the overall portfolio, as wins in court, the IRRs achieved there are sometimes then neutralized by the few losses that they have. I've been a bit lazy and screenshotted one slide from Burford's investment presentation because I believe it truly gives conveys the message of the asymmetry that's featured in the portfolio. So yes, Burford will lose some of their cases, but most will return between 0 and 200% of return on invested capital. And then you'll have few outlier cases that really drive up the returns. So this is the very appealing part, that yes, when you can lose and you lose a little, but when you win, you really win big. What's my investment thesis? One is that Burford is competitively advantaged. 2 is that they have unrecognized performance fees with a present value of 270 million. And 3, the complex accounting is confusing investors. So on the first point, sustainability of returns. There's limited competition within litigation finance, as banks and traditional lenders are not suited for financing legal cases. Litigation is very ambiguous as collateral. And then law firms, who could be another potential candidate, they have ill-suited capital structures for this type of investment, which gives little incentives for them to take on contingency cases. Investment banks or other non-traditional financial players, they have dabbled in the space, with limited success. There's legal expertise that's lacking, and origination opportunities from having deep relationships within the industry are lacking. So this limits them to certain non-complex or secondary transactions. Conflicts of interest are also at play here, as many of these players will have other branches where they do other types of business. They have to be comfortable potentially sponsoring clients that are suing companies they have business with, which makes it very difficult. On the importance of size, we'll see here that Burford's investment returns have been increasing as its asset base has grown larger. Burford's large and permanent capital base allows the firm to invest in cases unattainable to other players, and this is one of the key advantages. On the graph that you can see, their returns have been much higher when they've deployed over $20 million in one investment, compared to investments that have been below $20 million of size. And this really hones in that argument. Used as a factoid, in 2021, they deployed over $45 million to one single commitment, which most other funders would not have been able to make. I really like this slide and want to talk about what it implies. In each consecutive period that is visible here, we see that Burford's returns have been increasing, and as its total asset base has been increasing as well. This relationship has been true even if you exclude the one outlier, their best case to date, the YPF case, which we will talk more about later. So even though the whole portfolio has returned 93% return on invested capital, recent results have been much better than that. Also note how results in the industry have been fairly stable over a decade. IRRs achieved by Burford are very much in line with industry standards, and those have been consistent over time. I would emphasize confidentiality here to the first point, as distributing is very sensitive information related to a case to multiple financiers. That threatens to waive attorney-client privilege, which harms the prospects of the legal case. Henceforth, clients rarely approach more than 2 or 3 litigation finance firms when seeking funding, and Burford is many times the only call in funding matters. My second thesis point, which relates to the asset management side of the business. Here, Burford's expected carried interest, which it effectively is from fund management, totals over $500 million, with a present value of $270 million if you use a 10% discount rate. Total AUM in this side of the business is $3.3 billion. And the fee part of it is $2.2 billion. That's because I've highlighted here in red two funds that require separate calculations as their fee structures are fairly different. I've also noted which funds are in harvesting mode, essentially that the investment period has concluded and that they're now in the stage where they will be realizing the profits that they made throughout their life. This is in accordance with the European fall structure and will henceforth then realize a lot of these profits in the coming years. So we should see this playing out in the financials in the medium term. As I've calculated the expected carried interest over the coming 5 years for their regular asset management division, I've used an average of the contract terms established in their different funds and the expected annual returns, which differ from fund to fund as there are certain lower risk and higher risk strategies. Separated out the two various distinct funds where Burford achieves a huge part of the economic interest as compared to regular funds. So they are expected to return almost 350 million in carried interest from these two funds alone. And when we add them all up, the present value of this carried interest is 270 million. However, all of these equations assume that the asset management division will be shut down, so it's one-time in nature. If you had assumed that old funds would be replaced by new funds, well, then your fair value, present value is almost 700 million. So this depends on the assumptions you are willing to make. Very brief on the complex accounting in the short report. In 2019, Muddy Waters released a short report on Burford Capital, pointing to some of their mark-to-model tendencies and the implications of that. At its trough then, Burford's share price was down almost 80% as investors were worried and fearful over the arguments made by Muddy Waters. One of the main issues that Muddy Waters had with Burford was that the use of fair value accounting incentivized Burford to make huge uneconomic decisions. And it looks fairly bad if you do it on a high level basis. 40% of Burford's book value consists of unrealized gains. But I believe these claims stem from a misunderstanding of Burford's business. You see, even though Burford adjusts their cases to fair value, most of these adjustments all stem from one case, what we would call YPF. It's several different cases, but they're all in the YPF umbrella. So the YPF investment skews the results. There's a high-profile case against Argentina concerning an NYSE breach when the nation expropriated the oil company YPF in 2012. Burford, who financed the case, sold parts of its economic interest to several different shareholders from 2016 to 2019, and this gave rise to mark-to-market bookings. Investors, in fact, wanted Burford to mark-to-market these transactions, and as a result, they have a remaining stake in the YPF case valued at $725 million. This is a one-time outlay that falsely portrays management's behavior when it comes to accounting. When excluding this one-time adjustment, the total value of their portfolio is actually marked at cost, 84% of it, and only 16% is a fair value adjustment. I think this is much more reflective of management's behavior and their decisions than just looking at it on a surface basis. Also remember and consider how when they made a fair value adjustment to a case, that case ultimately ends up realizing a cash gain that's 5 times the value of the adjustment that they made. So they've been very conservative in the actual adjustment. I won't discuss this in detail, but just to give a very broad overview how you might be confused over the reporting. You see that from 2019 to 2021, looks like earnings fell by almost half. However, when you adjust for different fund minority interests and then adjust the cash only results, which we are interested in, we see in fact that earnings have been fairly stable. And 2021, I would contend, was a bad year due to COVID-19 shutting down sort of court places so that you couldn't go through with the legal cases that you were expected to go through with. That's been a temporary pause in the business. I can discuss my financial metrics with anyone who's interested if they contact me, but very brief here. Assuming stable 24% IRR, they've done that historically. not assuming anything different in the operating structure. So the results they received in 2020 is very much what I've expected. See that net income as a percentage of gross incomes, that would be the operating sort of elements that are in between there. They're very stable, as I expect, at 39% there compared to 37% in 2020. My return on assets is roughly 6%, with a constant leverage ratio coming to a final of 15% return on equity. YPF, anyone who's interested can read my comments on YPF on SumZero. Then we must discuss valuation before I conclude. So if I take my 2026 expected net income to a 15 times multiple of earnings, adding up the dividends and that after-tax carried interest we discussed, you get a premium to the current value of about 100% or close to 20% IRR. This doesn't include any value from YPF, which could boost returns very much from 50 to 400%. The change in book value you see here showcases that I'm not reliant on multiples, instead just on earnings growth. In fact, I'm assuming them to decline. I will conclude there, and anyone who's interested in knowing more about the details about YPF, my financial models, or other slides that I have, you can contact me at the email below. Thank you.
Alex, thanks so much for that. We have 2 minutes or so here, actually, and a question, because you alluded to it, and maybe share some insight from the SumZero platform. Can you touch quickly on just sort of the YPF resolution timetable?
Sure, I would definitely do that. So in 2022, which we're just passed, they filed a lot of their motions, the summary judgment, responses and replies. They had a final briefing in June. And since then, we've just been awaiting the court resolution. That could come any day, this week, next month. It's truly not something we have any insights to, but it should be this year. And if Burford wins the case, proceeds to the company could be anywhere from 1 billion based on the reps of precedent, which is an agreement that YPF had made with another company, to potentially $8 billion, four times the market cap of Burford today, depending on if they get prejudgment interest or not in the case. There's a lot of variables, but could potentially be a huge win. And if they do lose, they would have to adjust their book, unfortunately, but it wouldn't result in any cash outlays for Burford.
Got it. And further related, if you might, how would you think about handicapping those outcomes in the YPF case?
Yeah, so that sort of goes to the core of the thesis, how I don't think you need to have a view on YPF for this to be a great investment. However, I would probably consider the different elements. You would see that Argentina, they make the case that they think that the payout should be in pesos, and with the devaluation of the currency, that would very, very greatly diminish the proceeds that Burford would get. So there are certain of those uncertainties that you need to make adjustments for, a discount used based on your own beliefs on how likely they are. So yes, I would not make YPF your core argument for why this is a great investment opportunity, and instead you sort of view it as a potential great option.
Excellent. Appreciate that. I'll help you end it there. But if anyone wants to read Alex's full report, as he sort of alluded to, it's in full on SumZero. If we can help connect you guys with Alex, or feel free to reach out to him directly. But Alex, thanks so much for that. Fascinating.
Next up, we do have the winner of the ex-US category, Cy Conley, for his idea on Nintendo. The ticker is NTDOY. The ADR shares in 7974 on the TSO. Actually, the first of our 2 back-to-back winners today. I do have a little bit of background on Saya. Saya is the founder of Skycatcher and the fund manager for its master fund. Based in Austin, Texas, he founded Skycatcher in 2015 to invest in the internet paradigm shift to virtual worlds. Skycatcher invests exclusively in internet and software companies across the spectrum, public, private, and venture companies. They employ a highly concentrated mandate that is supported with a deep fundamental research background, acting as business owners alongside founders and engaged product enthusiasts. Skycatcher has backed some of the leading video game companies globally, including the largest video game IPO to date in South Korea's Krafton, seeded rising unicorns from India and Bangladesh venture ecosystems, and recently launched a digital asset strategy to support the evolution of the on-chain economy. Saya graduated with a bachelor's in business administration from the University of Texas at Austin. So Saya, I'll turn things over to you.
Thanks, Griff. First and foremost, SumZero, thank you for, again, hosting this annual event. I think it's an honor to have been selected and even a double honor to have back-to-backs. So hopefully we keep it going. I'd also like to thank my team for the detailed work they've done and what we're sharing with you today. Some of my peers who've just been great thought partners to brainstorm with, and then our LPs who have had the patience, but also the conviction in our process. So let's dive in. So we as a firm, we think of ourselves as full stack investors, essentially being able to invest across multiple asset classes in a deep fundamental way. Our goal and our process is described, in my opinion, intense, business owner mindset, and focused. Ultimately, Skycatcher seeks to achieve asymmetric returns, where we try to break down our investment theses across two different aspects: a differentiated view over a short-term horizon and a visionary view over a longer-term horizon. Hopefully in our Nintendo thesis, you'll be able to see two aspects of our thesis. Now, for us, we've been focused on video games since 2018. And since then, we've had 3 high conviction investments, which can make up to nearly half the fund sometimes. It's been quite a successful area of hunting for alpha. And our last position, which won the 2022 Best Idea for SumZero, is Square Enix, and it still remains our top position today. But for today, I'm here to discuss with you our newest high conviction position, Nintendo. Now, many people know Nintendo for its video game business. In fact, the vast majority of its revenues is tied there, and I think it's well explored and discussed. I'm not here to discuss that today. Although we do see value there, where our clear edge view is, and essentially our visionary thesis, is understanding that Nintendo is building an app store platform business that we think is incredible asset. And when I say app store platform business, to be a little bit more specific, it's third-party software sales plus the Nintendo Online subscription revenue. We've been following Nintendo since 2018, when we as a firm pivoted towards games all in. It was only in the recent past December that we built a position in Nintendo. And with that, we shared our thesis with the SumZero community. Now, what's interesting about Nintendo, although we've been tracking it, is that we've seen multiples compress over time. What you see here is consensus EBITDA multiples over the last 4 or 5 years, and you see that it's basically compressed, while during this period, Nintendo has become a much higher quality business and has grown earnings. Now, looking forward, where we have a differentiated view is across a couple of key aspects. First and foremost, we believe that Nintendo offers robust earnings growth over the next 12 to 18 months. And over a longer term period, we think there's still margin expansion as it pivots towards a software business. And ultimately, we think there's very limited downside given the assets in terms of IP and where we are in terms of execution of the App Store platform thesis. And when we take kind of a more visionary view, the big picture, what Skycatcher really seeks to achieve, we want positions where the outcome is asymmetric. In this case, we believe Nintendo offers a 200% upside from here. But the key aspect is this App Store platform business for us, which in the rest of this presentation, I will break down for you further. Now, the icing on the cake for our thesis and why now is essentially there's a major driver and a next-gen Switch console coming anywhere from May of this year to Q1 2024, which we'll discuss later. So that was an executive summary of our thesis. Now what I'd like to do is break down the key pillars to each assumption we have. First and foremost, starting with the Switch as a platform. The Switch is the first console for Nintendo to become an App Store platform. Essentially, this hardware is a ticket into an ecosystem. Now, what's a better way to look at this and understand this is that what you see here is over the course of the last few years, the number of the consoles that come out for Nintendo, how there's a boom bust cycle for the number of software titles released. And what you see on the blue line, which is the Switch, it's the first console that has seen increasing number of titles being released. This has never before happened for Nintendo, but it also is reflective of the strategic shift around third-party software titles coming on the platform. And when you think about this App Store platform in terms of a console platform, it competes directly with PlayStation and Xbox. But what many are surprised, it's actually bigger than those two other players. Now, these console platforms, one of the most interesting aspects is that they've benefited from a secular shift in consumer behavior in terms of how we purchase games. Back in 2013, as you see here from this bar chart, most video games were bought from physical channels. Very little was bought from digital. 2020, this was roughly around 50-50, and we believe this will get to a space where digital dominates how we purchase games. During this entire transition, all three major App Store console platforms have benefited, and Nintendo especially has benefited. What you see here is digital sales as a percent of total software sales. From 2019 to the most recent year, you can see that digital sales have almost doubled. And we actually are being what we think is conservative of forecasting digital sales getting to 67% over the next few years. Now, again, when I say App Store platform, I'm mainly focusing on third-party software here. And the blue bars that you see is what drives total Switch revenue, where we believe third-party software will actually be much bigger than the first-party business. And it gets a little bit better because it's a little different in terms of the Switch. It's different than other App Store platforms like iOS and Android. They actually have a monthly subscription business, which has now reached close to 40 million users and is growing. We're really excited about both of these drivers. Okay, so now let's get into why now. Essentially, the catalyst we see in the next gen Switch coming out. Today, the third-party games on the Switch are actually mainly indie games. These are in the industry are called single A or double A, and they generally have price points between $15 to $35. And you can see that when we've analyzed both Xbox, PlayStation, Nintendo, you can see that the average gross revenue per user is significantly lower. But this also presents the opportunity because the current Switch device is a chipset from 2015 and really can't support the AAA game segment. There's a lot of inventory that's not there effectively. And with this next gen Switch device, we know that NVIDIA is working on it. The existence of a more powerful chip is confirmed. And with that, we believe that the next gen Switch can support these AAA games. And this is a key factor because this audience that is looking for these AAA game titles, in terms of the Nintendo user base, what surprises many people is that the vast majority of Nintendo user base is actually core gamers. It's not the family cohort. And with these core gamers, one of the things that they're looking for would be interesting is that when they have titles like Call of Duty, which hasn't been on the Switch forever, what you see here is a tweet from the head of Xbox announcing that Call of Duty will come to the Switch. We expect many more of these types of announcements of these major franchises, again, that have never been on the Switch, all of a sudden have a new distribution channel. And with that, obviously bringing average selling prices, the much higher average selling prices to the Switch. Now, on a user basis, as a user of the Switch, we've also noticed that game discoverability is improving. And the Switch has also been making efforts towards highlighting third-party partners. Here's just a quick screenshot of Nintendo highlighting Ubisoft and Capcom. Ultimately, this catalyst of this next-gen software, we believe could lead to an S-curve growth of third-party software sales. And again, this will be backed on third-party titles coming that have never been, and with that, them being higher average ticket prices. Now, separate from the third-party part, kind of what I think of the icing on the cake, Nintendo has tremendous pricing power for its first-party iconic video games. In fact, just recently, there was a leak about the new Zelda game getting listed at $70 versus $60. This is something that we haven't even incorporated in our model, but it's part of the thesis of just thinking through the drivers of margins here. Last but not least, we think there's a new Nintendo. And this new Nintendo is best looked through the lens of a software business. In fact, by our estimates, we think the inflection between software and revenue, software and hardware revenue mix has already inflected. And as this inflection happens, there's a step change in Nintendo's margin. It is already really robust at mid-30s, but we think there's a chance here for this to get to high 40s. Very few companies have done this over the last decade. In fact, most notably, Microsoft was one that was able to do that. We think Nintendo has a really good shot at this. Now, in terms of risk for our thesis, the risk would be that many view that the Switch has peaked, which you see here is a bar chart of the number of new units sold, which peaked in 2021 at 30 million units. But from our perspective, the more important factor is the playing user base, which you see is the blue bar chart, is that it's continued to keep expanding and growing. We think that's the important KPI metric to focus on. Another risk is viewing Nintendo through the lens of previous console boom bust cycles. We know that this is, from our perspective, we don't believe this is a risk because, again, the Switch is really the first operating system console that has been built. And we think that it's going to look more and more like an Apple iOS or Google Android. This new Nintendo, in our perspective, and thinking long-term, the next 4, 5, 6, 7 years, is an operating system company, just like Apple, who has vertically integrated hardware and software experience. The old Nintendo is one that's, again, defined by first-party games and hardware sales. But this new Nintendo, what I've shared with you today, has a robust third-party software business, a robust online subscription business, and in addition, value-added services. This is what gets us excited. But the market doesn't see this. This new Nintendo trades at a massive discount to best-in-class peers. Again, margins for Nintendo are mid-30s. We think this can get to higher 40s, and with that, potential revenue multiple expansion. And on an absolute basis, if you look at Nintendo today, it's valued at 7.5 times EBIT, which implies very little growth. But from our perspective and our analysis, we believe earnings can grow closer to 15 to 20%. And with that, attaching a much higher multiple to what's the fair multiple for Nintendo. And if you look at Nintendo kind of over the last few years, it's trading at the bottom trough of its multiples in terms of earnings. It's trading at a discount to the industry peer group. And again, this is our differentiated view here, but we believe earnings growth will grow faster than the industry itself over the next 12 months. And last but not least, taking kind of a business owner mindset and a holistic approach, when we value the user base for Xbox and PlayStation, they're valued significantly higher than what a Nintendo user is. In fact, we think this is one of the most exciting opportunities that we've looked at in terms of owning such a great App Store platform business. To sum up, our Nintendo thesis, and it really is unlocking the value of the App Store platform business. When we look at these long-term views and we think about what is the normalized business, we look at 2027, and we believe the App Store platform can generate a little bit more than $3.5 billion at 87% margins. Because remember, they drive revenue through commission take rates. And because this is such a high quality, robust business, applying a premium multiple of 30 times EBIT, and we discount that back from 2027 to today at an 8% discount rate. Now, this concludes our presentation, but I would like to leave you with 3 key thoughts. First and foremost is viewing Nintendo from the perspective of having both a differentiated and visionary view supported by a secular theme of consumers stop purchasing digitally versus physically. Second, there's a major catalyst in a next-gen Switch device which will allow Nintendo to support AAA games that it never supported before, and with that, bringing higher average ticket prices. And last but not least, the third point is Nintendo will look more and more like Apple in the coming years. This completes our presentation. If you'd like to learn more and get into details, please see our memo on the SumZero website, or please feel free to reach out to me on this website, this email that's listed here.
All right, sorry, that was great. You mind taking your screen down for us for a second? I do have a couple questions we'd like to get through. Kind of more immediately, obviously this is, a great story and one you're obviously well familiar with and following for a long time, but kind of more immediately, can you talk about the most recent quarterly, results? Obviously a bit disappointing in terms of what the street was at least expecting at both the top and bottom line. How does that square with your thesis going forward?
Yeah, no, great. Thank you for the question, Griff. So our thesis we've shared with today is obviously multi-view review here, and that's how we like to think as being business owners. But what I would say for the metrics that are important for us, annual playing users was up from 100 million previous year to 112 million. Software as a percent of sales was up from 49% to 54%. Digital as a percent of software sales was up from 40% to 46%. So really the long-term trend, the KPIs that we've shared with you today are all intact. And I think for shorter-sighted participants, their focus on, the fiscal year ending in 23, it's not how we look at it. So I think for us, it depends on what KPIs are important for you. And for us, we're pleased with what the quarter was. And I think the more important factors is what is to come, because Nintendo is, they are not, they're in some ways very secretive company about their plans and what's next. So I think we do have some assumptions around the launch of the Switch, but I hope that gives you a good sense of our view of how we view the quarter.
Excellent. Yeah, and we do have a comment coming in from the audience, Saya. Why can't the sell side spot what you're seeing in Nintendo? What are they missing in the story here?
Yeah, look, I think we work hard to get the bear side and see the other side of it. And in our conversations that we've had with people, I think there's just this focus around this console boom bust cycle, right? And I think many people view this peak Switch as like a key driver to all this. And if you view Nintendo through that, and you look at where revenues are, and you say this company made most of the revenues from hardware, hence I'm going to focus all my analysis on that, I think you're missing the bigger shift here. But outside of that, I think those are the two key things that we identified, and we tried to share that in the presentation today around what sell side sees. But there is, I think, some change here. I think we're starting to see some sell side start to kind of slowly understand what's unfolding here. But it's not that Nintendo also makes this simple for everyone to understand, right? I think we've done a lot of our own scuttlebutt research here to come up to these estimates ourselves.
Awesome, thanks for that, Saya. Another question from the audience. Now, should the 24-25 EBITDA margins be depressed by the new hardware launch? What's your view on resorts, franchise building, or a bit of a distraction? And do you think they're going to be accretive over the long term?
So just on just understand the question. The question is on margins being depressed because of hardware launch.
Hardware launch, and then on the resorts side of things.
The resorts, it's too small to be. I mean, remember, we're talking about a company that's almost 12 billion in revenue, right? With we don't have resorts being impactful given its scale. And in terms of the new hardware, so I think that's one of the key factors of we don't know what the form factor of this device is. If it's what we anticipate, where it's a continuation of the Switch, and this is what Nintendo has basically implied, then there shouldn't be this big expense drop because you're not having to reinvent the wheel. So if you recall, these margins compressing with new hardware happen each time because every time Nintendo had a new form factor and reset the user base. What's happening going forward is that that's not the case. The iterations are much more incremental. And so moving from this kind of one chip, this one NVIDIA chip to this new one is not going to be as material as kind of the previous iterations of Switch. But, you know, for us, the hardware part was never, this has very little to no impact in terms of kind of where our thesis is. We view the hardware as the ticket into the ecosystem, right?
So sorry if I jumped to from hardware back to software and vice versa and whatever, but you know, there was a comment on your idea on SC, so I thought was pretty interesting. You know, kind of a core part of your thesis is, you know, Nintendo essentially building its own version of Apple. Now, how do you think Nintendo's internal app store is, you know, positioned competitively relative to its peers here?
Look, Nintendo, I think it's different than obviously PlayStation and Xbox, right? It has first-party franchises and iconic games that those don't have, right? So I think most gamers, and this is more kind of anecdotal research, but I think most gamers who are core gamers probably have both a Nintendo and an Xbox, but they don't have both an Xbox and a PlayStation, right? So I think the IP value of what Nintendo has, I don't think what we're not saying is Nintendo's going to cannibalize third-party games away from PlayStation and Xbox. They're obviously still going to be more powerful machines, but the form factor of the Switch being able to be mobile and be more powerful is interesting to contemplate, where maybe there are some AAA games that, like a Call of Duty, where you're going to be on the road and you want to play, and the Switch will be the only device that allows that, versus when you want the full graphics and everything else, then you're at home on your Xbox. So I think for us, we don't view this as this big competitive threat to others. And we see a lot of overlap in terms of people having both systems. But I hope does that answer the question? Did I get it correctly?
Yeah, I think so. I mean, you know, specifically, we do have another one, you know, specifically related to Sony. You know, do you think it can attain sort of a higher margin on App Store as opposed to Sony, or maybe it's more, you know, most direct competitor here?
We don't know that, right? So what we've done is we've assumed 30% take rates on the third-party software sales. I think that's just a fair assumption. But remember, this $3.5 billion in revenue that we're forecasting, that's at an 87% margin, because it's just a take rate business. So I think for us, you know, we think we're ballpark right. I mean, that's historically what app stores charge. But yeah, I don't have any specific, like, I think to the point of, you know, for myself, right, as a consumer I have all three devices, but there are different games I will play on each one depending on the experience, right?
Great, appreciate that. Just in terms of, you know, maybe thinking more big picture here, you know, corporate governance is always something we have to consider when dealing with, you know, companies in Japan and whatnot. Obviously, you know this a lot better than I do, Saya, but I'd love to hear a little bit more about, you know, Nintendo's governance practices, and how they're kind of looking to create, you know, sort of shareholder value over the long term.
Yeah, I think so. This is a new Nintendo guard, right? It's not the old guard, but it's still very Nintendo, meaning it's secretive, it's very Apple-like. They have shared plans around capital return, right? There is a host of proactive investors such as Value Act and such that are involved with the company and been working with them, and I think you'll see this improve over time, in the sense that I think from my intuition and just our interactions with the company is that the stock price going up and reflection of that is just them doing a good job of the business. But they are artists first and foremost. I think this is true for all of our Japanese companies. I think it's an artist mindset as opposed to the business mindset. And look, in the long run, I think that's the right way to approach it, because there are game companies in the US and Europe that take the business approach. And what we've seen is they end up cannibalizing themselves because they over monetize. They get too aggressive. They see the high free cash flow. And I think Nintendo will go slower at its own pace, but it's gotten better than 4 or 5 years ago from that sense.
That's terrific. I appreciate that. I guess, sort of also on, perhaps the longer term picture here. One of the more unique aspects that you're inclined to talk about here is that, you see a lot of opportunities in the private markets across gaming. Where are you kind of seeing risks and threats to some of these legacy, gaming houses like Nintendo, Xbox, what have you? Coming out of some of these upstart, private companies and, as well as like companies like Roblox, for example, that are, allow you to literally build your own video games. So I'd love to hear a little bit more about that.
No, thank you for that. So we're very active on the venture front. I think gaming is one of those industries that has continued to secular grow, but a lot of the growth happens when you bring new experiences. So like think back in a few years ago when there was battle royales, a new concept, it grew the TAM of the shooter market. It didn't actually cannibalize the other categories. So for us on the venture front, we have investments in a platform that is decentralizing the publishing of games. So you think about obviously Xbox and Nintendo and Sony, they're publisher of games, but they hold a lot of power over the content players, right? In fact, with their move towards subscription, content IP holders are probably getting a little wary. So we do have investments where using blockchain technology that a platform is disrupting publishing and giving more power back to content providers. Outside of that, I think when it comes to just new innovation and new ideas, it's one of the exciting parts is gaming is not an industry that you can reinvest at high returns because you can't throw money at the problem. You're investing into teams. And so for us, we think the sweet spot is leading seed and Series A rounds where you find innovative teams with new concepts. And, with a team of 20 to 30 people, you'd be surprised what can be built and how quickly a global product can launch on that front.
Great. So, Saya, if another question here, just one last one before we step off here. What's stopping Xbox or PlayStation from creating a similar competing mobile gaming product?
Nothing's stopping them. I doubt that they would do it because their core demographic, it's the console experience itself is really great. But I don't think that's if you think that's what is going to be competitive to Nintendo, then I think you're missing the bigger picture that Nintendo's first party IP, its content, is what people will buy the console for. And from there, the third party software part it's all icing on the cake, and it's growing because it's becoming a part that Nintendo's starting to kind of really invest in, right? But as I mentioned before, the Nintendos, the Zeldas, the Marios, right? These are IPs that, they have this advantage in the war of content that I think those other platforms are actually trying to get to. So think about what Xbox is doing, what Sony's doing. They're buying game companies. They're trying to get content. Well, look, we've seen this battle happen in Netflix versus HBO versus, versus Amazon. The unique part of this battle for distribution is that Nintendo has its own IPs that, are now passing close to 30, 40 years of generations and growing. Just one more data point and we can wrap up here is, as someone who's been playing Pokemon since a teenager and following each iteration, it's fascinating for me to see that as such an old IP, the new release of the Pokemon came out, it broke records from previous years and it continues to happen. But I think you try to find an IP that has shown that level of longevity, breaking records each time. I actually struggle to do that. Even looking at like Disney IP, they're not as, the very few IPs can actually match what Nintendo has, especially with Pokemon.
I absolutely agree with you there. Sai, appreciate your time, sir. Everyone, was Sai Connolly from Skycatcher, walking us through his thesis on Nintendo. So we'll drop things off for now here. We do have a bit of a transition before we head over to a conversation with Guy Spear and Divya Narendra. So with that, I will mute myself and pass things over to Braden.
Thanks, guys. Saya, fascinating conversation. I appreciate you taking the time to walk us through all of those questions. We have a couple of minutes here if anyone needs to run in and grab coffee, but I'll get to it just to keep things flowing along. We do have Guy joining us, which should be a fascinating conversation between himself and Divya. For those who perhaps don't know Guy or don't know his background, I'm sure many of you very much do, but he's managed the Aqua Marine Fund, their privately offered investment fund since 1997, and is also the author of The Education of a Value Investor. Pretty fitting for this community. He previously worked as an investment banker in New York and as a management consultant in London and Paris. He has an MBA from the Harvard Business School, so perhaps he and Divya can harp on their days at Harvard, and holds a first-class degree in politics, philosophy, and economics from Oxford University. On graduating from Oxford, he was co-awarded the George Webb Medley Prize for the best performance that year in economics. So I don't want to take too much more time because this should be a lot of fun, but Saya, thank you again. Divya, I'll hand off to you and Guy.
Great. Are you in Switzerland right now?
I'm in Zurich. We've got one of the first sunny days that we've had for a very long time, which makes me really, really happy. It's been tough here in Zurich because you got these kind of clouds that close in on the valley and they kind of can stay for like a month. And
yeah,
it's countered by the ability to go up to the ski resorts and ski, which are the closest one is 45 minutes away. The one that I go to is an hour and a half away. But this year it's been mainly cold and dark here in Zurich, which has not been fun. So spring is on its way, and I'm really happy about that.
Yeah, no, that's I think we can all agree that when it's too cold, it's no fun. I'm actually in Connecticut, and it's been a little on or off. Some days it's like just bitterly cold. Today it's like just very gray. I feel like every day is pretty much gray throughout winter, whether it's hot or cold.
What I would say about Manhattan, at least, or that part of the US, is that if you look at a map of the world, the latitude is about Barcelona. So it's actually further south, closer to the equator than, say, Zurich is, and certainly far closer to the equator than, say, Paris or London. And so the days don't get quite as short. And my experience of New York City is that it's a way brighter winter than, say, in Northern Europe. And Zurich's almost good.
Yeah.
If I'd have moved to Milan, that's south of the mountains, that's a whole different thing again. So
yeah. Well, Braden mentioned the Harvard connection. I should probably clarify. I did not go to the business school. I was an undergrad over there. But we would run into you guys once in a while at night.
And I was invited to give a talk to the undergraduates at one point, sort of a career talk. So I did have just a little bit of contact with the undergraduates. And I did Harvard Summer School one year before I came to the business school, which was really an amazing experience for me. I learned a lot. But I have now done 2 university tours, and I don't know what the average age of people listening to this is, but I've done 2 university tours in the Northeast with 2 of my elder children. I think that's something that's really great to notice and know, is that I think that to an American mind, especially somebody who, say, lives in Connecticut and New York, it really is unimportant in my eyes and in so many people's eyes. So long as you're at one of the well-known colleges and universities, you're kind of the same thing, it seems to me, and your opportunities are approximately the same. And I think that having done that university tour, I am less stressed about, for example, where my children go to college or university, as long as it's one of a group of about 30 or 40 or more. So Harvard's not the
great
be-all and
schools.
end-all.
That's an entirely different discussion. But yeah, it's I always joke with my friends, like I'm pretty confident I would not have gotten into Harvard today if I had to reapply. It seems like every year it gets crazier and crazier, the stories I hear.
But also, I think that we can also be confident that one can get equally good, if not better, education in other colleges and universities. And my best sense of having a daughter who will be attending Columbia and having a daughter of friends who are attending Harvard is that it's an extremely unusual environment and may not be suited to many of the students who are there actually.
I think it was Thomas Sowell who was talking about that, or like some, people often just go to a college for the wrong reasons, and it ends up actually kind of backfiring in some ways. But just, I guess, to set some background, obviously Braden kind of read your quick bio. If you could just, we're going to be talking about a couple individual names, two in India and then Credit Suisse, which is obviously near and dear to you. What is your background in terms of how you transitioned into value investing and just how you started Aquamarine? Like, maybe you can just tell us the inception. Give us the inception story.
Yeah, and the main point to take away from that is that you don't want to do what I did, and that I mean that very, very seriously. And what I did is a huge part of why I wrote the book that I wrote, in that I made some an enormous career mistake early on. So at the time that I was graduating from business school, but it doesn't matter for the purposes of anybody listening to this. It doesn't matter whether you were graduating from Harvard Business School or from university or from high school even. I was kind of in a rush to get ahead. I wanted to have achieved a lot quickly. I was arrogant and aggressive. And I went to work for an investment bank called D.H. Blair, which at the time, which was pre-internet, when you wanted to look up companies, you had to go to the library and they'd show you past newspapers on microfiche. But there were some reports of this bank having been engaged in unsavory behavior and activity. But I ignored those reports and went to work for it anyway. And I describe it in the first chapter of my book. After I left that bank, the firm was shut down for violations of NASD and other rules. And they were at best, you could say that they were sailing very, very close to the wind. But a more accurate and probably correct interpretation was that they were playing fast and loose with the rules, which basically meant ripping off the client. I think the expression is ripping the client's face off. And I, for some reason, for various reasons, one was that they awarded me the title of vice president, which was way better than the titles that all my classmates were getting. I thought that was valuable, and they offered me the opportunity to do deals right away. And but what I had failed to understand, and it's just so super important, is that your reputation is everything. And by associating with bad people, you damage your reputation enormously in a way that when you're young enough is recoverable, but it's long and hard and arduous world to recover. And I just didn't understand that one should never, ever associate with people who have a bad reputation, even if you yourself don't have any wrongdoing yourself, which was the case for me. So I was at an investment bank trying to do venture capital deals, and I thought there must be a better way. And that's when I discovered Warren Buffett and started engrossing myself in everything Warren Buffett. But I also had encountered the self-help genre of literature. So self-help from Anthony Robbins to Dale Carnegie, How to Win Friends and Influence People, Napoleon Hill, Think and Grow Rich. And I needed a way to get out of where I was. And so I started applying many of the ideas in those books to get me to where I wanted to be. And so one of the things that I did was I imagined what Warren Buffett would do in my shoes. And I thought Warren Buffett would not be at this place. So it helped me to leave. It also helped me to start visiting the Berkshire Hathaway meetings. And I started reading the annual reports of companies that Berkshire Hathaway had invested in. I remember I did my very best and eventually found my way to own shares in Ruane Cunniff's mutual fund and started attending the Ruane Cunniff meetings. And so I kind of, through sheer intent and putting one step in front of the other, sort of pulled myself away from this really bad orbit I'd gotten myself into early on. I was applying for jobs at Tweedy Brown. I'd gotten to know Carly Cunniff at Ruane Cunniff. I was going to visit the Peter Cundall conferences in Toronto. I got to know a guy called Tim McIlvaine, who now runs a fund out in Victoria on the West Coast of the United States. So I was all over anything that was in any way associated with this view of the world that was espoused by Ben Graham and Warren Buffett. And in my case, you know, I have a family business background, and there was some wealth that my father had built up, and he's looking at me doing this. And I never expected him to entrust me with his savings, but that's effectively what he did, which is the inception of Aquamarine Fund. I think just to go back to the very beginning before I hand the mic back over to you, Divya, is that I could have easily out of Harvard Business School gone and gotten a job at, you know, JP Morgan, Goldman Sachs, McKinsey, one of those well-known brand name firms. And I think that my path would have been far less bumpy had I actually bit my tongue, gotten my ego in check, and accepted I didn't know everything I needed to know, and gone and gotten more experience. And if somebody had said that to me, I'm not sure that I would have listened, but I certainly would have had a better ride.
That's so fascinating, and really interesting to hear how your father kind of entrusted, you know, his accrued wealth to you at, you know, what was a pretty early age. I also think it's interesting that coming from a, let's say, call it a fast and loose firm, that you very quickly adopted, you know, the Warren Buffett philosophy around investing, which is obviously long-term in nature and sort of the opposite of the get rich quick scheme that, you know, I think a lot of folks fall prey to, and actually, like, I would argue, causes a lot of much of the roller coaster ups and downs of the market today, where, you know, there's just so many people who I think are they're not really investing, they're just kind of day trading, and it creates all kinds of problems. So that's interesting to see. Now you're sitting in Europe. I know you've got investments in India. I'm just curious how did India hit your radar screen? And you know, what was the you know, first of all, like, what is your mandate? Are you pretty global in terms of what you can invest in? And if so, then, you know, sort of if you can describe to us your screening process, and kind of how you funneled your way down into India, that'd be really helpful.
And just to, you know, I very much wanted a professional path through life, and I agonized over this offer that my father gave me, and I never sought that out. He kind of observed me and said, "Why don't you do this?" He'd wanted to get me into his business, which he not wanted to, but we both thought it would have been a nice idea, but I would have been in the agricultural chemicals industry, which was not an industry I understood much about. I get a lot of people writing to me who kind of hanker. I don't think that we're better off if we don't ask internally in family type situations for money to manage. And actually, I learned an enormous amount from, I know he's coming on later, from Manish Pabrai about how to approach selling yourself without actually sort of accosting people and making them feel uncomfortable around you. And so there's a way of handling yourself such as the world knows that you're open for business, so to speak, but you're not making them feel uncomfortable at cocktail parties, if you like.
Completely agree. I mean, it sounds like your father saw your passion for investing, right, and he probably agreed with the underlying philosophy himself, and so he felt like you would be a good steward of. And
I think that it's very, there's been about 2 or 3 occasions in my life where I felt so passionate that I want to do something that I've lost sleep over it. And there's this idea that when you have the right passion and you act on it, the world opens up a path for you one way or another, and the resources that you need come to you. And it's some strange combination of dedicating yourself to the idea, being totally convinced by the idea, and then taking the steps in front of you, but then other things happen as if by magic, which is kind of interesting. You know, I applied, my approach, and I think it all along has been to protect and grow the wealth that has been entrusted to me. And I think that all sort of mandates that restrict the investor in terms of what asset classes or what geographies or those are kind of like more like marketing tools, if you like, and you have to be open to everything potentially. And I've explained to all sorts of people that if they're entrusting me to manage their money, the real due diligence is on me. It's not, is to research who I am, what I've said, do I do what I say I've done in the past, in the future, rather than try and put kind of like limits around me in terms of the geographies that I can invest, for example. So all along, I've had complete freedom in terms of which geographies, which industries, even which instruments. And I've learned as I've gone along. I mean, before we get to India, one of my earlier investments was in the bonds of Eurotunnel. And, I kind of was thinking of Warren Buffett's toll gate and the way if you have a bridge across one road across a particular strait that a lot of traffic needs to move across, that's an amazing business. You can charge them a toll, and that Eurotunnel was kind of a toll. But I invested in bond instruments. So for example, I had a significant investment in bond instruments yielding, say, 20% of the cost that I'd purchased them, which were almost not traded in the market. They were only traded over the counter. So I've invested in unusual instruments. I've invested in unusual countries. Perhaps the listeners might be interested to know that despite having a very, very close ties to Israel, for one reason or another, I've not invested in any Israeli businesses, but I have invested in Oman, I've invested in Jordan, and I've even invested in Zimbabwe. And if I think of those investments, none of them made me money. Two of them I exited without having lost much money. I exited all of them without having lost much money. One of them was so small I would not have made much money in any case. But so I think that having a broad mandate of where one can go is kind of daunting and scary for both the manager and his clients, but is also the right way to approach it. And that does not mean that I just jump into having every single investment in sub-Saharan Africa or in frontier markets in Asia. I'm constantly aware that 100% of my family's net worth is invested in the fund. And I ask myself, where would we want to be if the markets were shut and we weren't able to trade or move our positions around? And so I have been asked a lot, because I have investments in China, what proportion of the fund would I want to have invested in China, given that I don't plan to ever live in China, for example. So, but if, as Charlie Munger has said so well, you need to fish where the fish are. And, the fish may not be in your home market. They may not be in the market that you understand the best. And so I think it behooves me to go and look at everything, no matter, and not to have rules that prevent me from looking at things. And I think that it's on that, just to bring it to India, that's the basis on which I started. It wasn't so much that I was looking at India. So in my case, what led me to India was that early on in the life of Acker Marine Fund, I'd had a very, very successful investment in a company called Duff & Phelps, which was a credit rating agency. And Duff & Phelps, I learned through investing in Duff & Phelps that there were different kinds of businesses. Some businesses were better than others. And Divya, I hope you don't mind, because it's just fun to do it. What's so amazing about a rating agency is that despite having very high margins themselves, they actually lower the cost of doing business for their clients. So in many cases, you can't even issue a bond to the markets unless you have a rating from a recognized rating agency. And it's well understood that the cost of the interest rate that a large corporate will pay on their bonds goes down significantly by about 100 basis points if you have a credit rating. And so you're actually saving your clients money in terms of interest costs paid on their debt by having a rating. And so, but it's also a very, very high return on capital business. So that was an amazing ride. And I was very sad to see the company sold. It was sold to Fitch at some point. I wish could have continued on that ride, but that led me on a search for ratings agencies around the world. And for example, in Indonesia, it turned out that there was a private company that was quite interested to sell to us, or at least a share of their company to us. That would have been a bridge too far for me in my kind of like tiny office with a small support staff and not knowing anything about Indonesia. But the situation that arose in India was in an Indian credit rating agency, and hey presto, I could read English and their accounts were in English, which was a real surprise to me, because at the time I just assumed that was the language of the oppressive colonialists, and now all accounts were produced in Hindi or something. but it turned out that I could read their accounts. Now their website wasn't great, but so I went to India not so much because I was looking to invest in India, as because I was looking for credit rating agencies to invest in around the world, and so that kind of reasoning of this is what's worked in the United States, I wonder if there are any other markets where I might work, has been extremely productive for me. I've found a number of great investment ideas by doing that, but that's a very, very long way of telling you why I ended up in India. And just for your interest, Divya, so I can talk about the process by which I ended up buying shares in Crizzle. At that point, I had not met Manish Pabrai. And then when on my first trip to India, I had met him in person once. And I remember writing to him and saying, I'm going to India for the first time. Could you recommend any books for me to read? And he actually gave me a British author then living in India called Dalrymple. I don't remember his first name, City of Jinns. But so that gives a little bit of the history of India, my history with India, if you like.
Yeah. So tell us about the Indian exchange. Is this a current position of yours, or is this something?
What drew me to India was CRISIL, Credit Rating Agency of India. It's an acronym for something, and I don't own that anymore, much to my great pain and chagrin, because it's been an amazing compounder. I think it's 1,000 bagger at this point, and I had sold it when it was a 5 or a 6 bagger. These are lessons that we learn. But there was some, and I'll just talk a little bit more about that before going to India Energy Exchange. There were some structural issues that made it a particularly attractive investment for somebody like me coming from outside of India. And one of the first questions that anybody ought to ask when investing in any market is, what is the probability that I'll get ripped off? And what is the probability that things that I don't understand about this market are going to bite me in the rear end? And what gave me enormous comfort in the case of Crizzle was that the two largest shareholders were, one was ICICI Bank, which is extremely well-known, large bank in India, and the other large shareholder was Standard & Poor's. And they were approximately 40% of the shares each, and there was a minority of 20% out there. So my reasoning, which I think was good reasoning, was that you had two big dogs watching each other. And those two big dogs were the small fry, the 20% of the public shareholding, were too small to worry about. And so the probability that one dog would expropriate the other was extremely unlikely. And so I was mice trading amongst the feet of elephants, but there were to sort of move the analogy over to a different animal, there were two large elephants in the room that were watching each other. So that's a past investment. A current investment in the fund is a company called India Energy Exchange. And to give you the history of that, so 20 years ago when I first visited India, companies like Crizzle, you would go to a place called Nariman Point, which is about halfway down the peninsula that is Mumbai. And I was shocked, even at the time, because finance business tends to happen in kind of gleaming glass towers with lots of money around, and that's kind of a feeling of downtown Manhattan, and that's not Nariman Point. And it was still a different atmosphere in India. The atmosphere in India has changed an enormous amount. I still felt the kind of impact of colonial traditions, if you like. A more modern India, you fly to Mumbai and you don't even visit the peninsula. You go to a place called Bandar Kurla Complex, where there are a number of hotels, and it's kind of gleaming glass towers, more what you would expect from a modern financial center, and incredible conferences that are put on by the various brokerage firms. And so I got the chance there to visit, there were hundreds of companies there, and I got to visit with dozens of companies. But the one that stood out for me was India Energy Exchange. One of the things, so many amazing opportunities in India, but there's always the question that arises for somebody like me, hey, you're not Indian, you don't speak Hindi, you didn't grow up there, you have no understanding of local nuances. So what are the ways in which this could bite me in the rear end? And so I've tended to gravitate in India towards businesses that are highly regulated and over and above that, whose counterparties themselves are highly regulated. And that in and of itself does not protect you. And just to, at the time that last time I visited, there's some really interesting developments going on in the real estate sector in India, where it is in a certain way far more advanced than the United States and Western Europe. But I still knew that I would have to, if I was buying into an Indian real estate company, I would have to have some evaluation of the management and how honest they are. And that was something that I would have a really hard time doing. By contrast, I felt a lot more confident and comfortable in India Energy Exchange, which is, I mean, if you've got an American audience, think of Deutsche Börse, London Stock Exchange, Intercontinental Exchange, those kinds of businesses, which are kind of like the platform that runs the market. And in this case, it's the platform. India Energy Exchange is not the only platform, but it's by far the largest platform that runs India's emerging electricity trading market. And you would say, well, how on earth do you trade electricity? And amazing enough, it does get traded in multiple markets around the world. Here in Europe, we have an exchange called European Energy Exchange, which is owned by Deutsche Börse. And you have an exchange in the north of Europe called Nord Pool, which is owned by the participant companies. And if you imagine that as you move from non-renewable to renewable sources of electricity, electricity supply comes online at intermittent times. It comes online when the sun is shining or when the wind is blowing. And so you need a mechanism by which to match supply and demand and help other suppliers of power to decide whether they're going to supply power into the grid or not. And it turns out, surprise, surprise, that the very most efficient way to do it is to develop a price for power, and that gives a price signal to all market participants. And in order to have a price for power, you need a central clearing, a place where all of the demand and all of the supply is cleared. And if you get to operate an exchange like that, that can be an extremely high return and very, very profitable business, which it is. And it's also happens to be a natural monopoly. So simply understanding that and seeing that India Energy Exchange had solved many of the early problems in setting up an exchange, my next place was to ask myself, what happens if for some reason they get it wrong for a day or two, or there's some kind of abuse of some kind. And I spent a lot of time with former regulators to try and understand how they would rectify when something went wrong. And what became very clear to me is that the regulators are there to regulate. They're not there to take away licenses. They're there to make sure the system runs. And so I then spent some time looking at existing exchange businesses to understand that even when their legal monopoly is taken away, they have such an incumbent first mover advantage that they continue to do extraordinarily well. So in European and US share trading, exchanges no longer have a monopoly. The New York Stock Exchange doesn't have a monopoly on New York Stock Exchange stocks. Anybody can be an exchange in those stocks. But the New York Stock Exchange has, by setting the rules, by providing information, by setting clearing rules, by having interactions with depositories, they have an enormous incumbent advantage, which is what I also believe is the case with India Energy Exchange. And of course, India needs to produce about at least 3 times per capita the energy it's producing right now. And so it's just an amazing business and amazing way to play the future of India. What I needed to do was be willing to pay up for it. So I did not pay a cheap multiple of earnings. I've been thinking quite a lot about the investment that I made and following Manish Pabrai into Fiat. And in the case of Fiat, we had a company that was trading at a fraction of revenues and at the time had no earnings, but it was easy to see in normal conditions it would maybe be trading at 1 time's earnings. In this case, I did the opposite. I paid up quite a lot. I paid above 30 times earnings for the business. But it's real earnings. It's real cash earnings, cash developing on the balance sheet, unlike many of these bubble stocks where they didn't have any earnings. But I'll stop there to see where you want to go.
This is really fascinating. The corporate governance element I think is really interesting. Talking about how it's not only regulated, but having regulated counterparties. I think that's quite an insight. On on the valuation, can you just talk about like what the growth looks like, or if you can put that earnings multiple in context a little bit?
Yeah, I mean,
And is
I
it the
don't
kind of
think.
name that you could sit on forever? I mean, I'm just curious what the duration of the investment is.
Yeah, and so I figured out, maybe not that long ago, that I kind of only want to put companies into the portfolio that I want to sit on forever, because it's just too hard to think of a time horizon where effectively you're trying to sell out at a high valuation to other people, which is some kind of pass the parcel game that you want to kind of be in businesses that are, electricity is a great example. Electricity is in demand, is produced. It's funny, it's very hard to store electricity despite all the conversations about batteries. So you have to produce what the system needs at any one time. And for as long as human civilization exists, it will be powered by electricity. So a bit like, maybe to use a completely different example, like owning a beer company. For as long as humans, Ben Franklin said that beer is evidence that God loves us and wants us to be happy. As long as humans exist, we're going to be consuming beer. As long as we exist, we're going to be consuming electricity. And therefore, you can imagine that the exchange will be around. So the holding period is forever. I just did a simple calculation of what is a calculation. I mean, it's there for everybody to see. It's not even a calculation. In Europe and in the markets in the United States where there are exchanges, they tend to have a 70 to 80% market penetration. So if you take the power generated per capita and multiply by approximately 3 to get it up to developed country standards, and you look at the penetration of the exchanges and say that it's going to be from 10% to 70 or 80%, you got a business that you can easily see will be 20 to 30 times larger. And whether that growth happens this year or next year is not so relevant to me as what the earnings power will be out 10, 15 years when it's at least 10 times larger, if not 30 times larger. Now, there are many things that could mean that the end point is not quite as large as that. So it may be that that the company has been restricted in terms of what it can do. It's a shame, but it is what it is, that they've been restricted from trading in derivatives. So they have to trade physical power, derivatives, energy derivatives, which are a really important commodity in developed financial markets, cannot be traded at India Energy Exchange. So that's a whole area of growth that is not available to them. It's also possible that other exchanges, and there are competing exchanges, will develop some kind of dominance in some aspect of energy trading, maybe in different kinds of contracts. So there are multiple different kinds of contracts that are traded. And so that may restrict the ultimate number to, say, half what I'm expecting, or even a third what I'm expecting, but that's still a pretty good number, and it's still a multiple of the size that the business is today. What's interesting right now is that the conditions of last year created there was little to no growth in volumes traded on the exchange for understandable reasons, but in a market like India, where people don't look too far ahead, that leads, people extrapolate last year's experience and say there may be no growth left. And so the company trades at a far lower valuation than it did sort of 18 months beforehand. But I was amazed.
What's the multiple today?
I believe it or not, I don't look at stocks all the time. And I think that in terms of, it's probably still about 40 or 50 times earnings, something like that. But I haven't looked at it recently, and I tend not to look at these companies all the time. I should have really prepared a little bit better for you. But it's a rich multiple of a very, very interesting earnings stream that has not done much over the last year, something like that.
Yeah. How has it fared in, I'm just curious, because we are, at least in the US, there's such a huge macro headwind with rates going up. What have you seen that pressure on Indian stocks due to what's happening here with the central bank, and certainly for a name that you're saying is at 40 times, potentially 50 times. Do you think of that at all as a risk?
I don't think that interest rates came anywhere near as low in India as they did in the United States and Western Europe, and I don't think that they've risen as much. In my case, I kind of don't think of those, what current interest rates are. I kind of think of about a 4% discount rate as being probably the right discount rate to apply over time. You know, I mean, I don't really look at I don't even look at the index. So I don't really think about it, and I don't try and think of that dynamics because I don't think it's important for the valuation of the business. I see you looking at your screen. I could do the same thing, but I don't think that it would be appropriate to the listeners. I mean, I really do. In my case, I think of myself as an owner of the business, and I'm not concerned about where the interest rates are too much. And I'm not concerned all that much about even, believe it or not, valuation in terms of current earnings, because I'm looking out. And in a certain way, I realize that that's what a lot of people were doing in some of the meme and non-earning stocks in the United States. Only difference being that this company is actually generating real cash earnings, and it's even repurchasing its shares right now. But I'm looking at it as an asset, and what will the asset look like in 20, 30 years rather than what it is today.
Yeah. And do you have a similar thesis, you know, with care ratings, that, you know, it's a monopoly of some sort, or, you know, a company where you can have confidence in 10-year earnings? And
so no, I don't. And that's why I don't own nearly as much. And I've been diffident in buying more of care ratings over the last year or two. Just to give you one interesting sort of like thought about India Energy Exchange and Divya, I'm really sharing this because I'm proud to have figured it out, if you like.
Yeah.
So what's really, really interesting for me about an exchange like India Energy Exchange is that you have these long-term contracts between energy producers and the distribution companies, and those are fixed at certain rates. But then you have an energy exchange that comes along, and you've got people supplying all sorts of alternate forms of energy into the exchange, and you get a different price to the long-term contracts that have been established. Almost all the time, the price on the exchange is lower than the bilateral contracts that have been negotiated. So the buyers of electricity are saying, well, why do we need to buy from you, power company, when we can buy from the exchange at a much lower price, which moves volume onto the exchange, except in a year like last year, where energy prices went through the roof, and the opposite happened, which took a lot of volume out of the exchange when the prices were higher than on the exchange than the bilateral contracts between the power generators and the distribution companies, setting a very, very good price signal for power suppliers in terms of what kind of investment to make. But it drove a lot of volume off the exchange. So the business had a lot of headwinds in the last 18 months, and I have no doubt that they'll be reversed. But so you move me on to care ratings, which is a really, for me, a really, really interesting situation where I don't feel anywhere near as confident in the outcome. And I love making the point that I'm about to make, Divya, especially in Indian circles. So the leading credit rating agency in India is CRISIL. It's a very, very powerful, strong brand, and it is now controlled by Standard & Poor's, which is a well-known global firm headquartered in New York. And although it's not a leading rating agency in India, ICRA is another agency that is controlled by Moody's. And so you have some leading brands in India that rate Indian companies and Indian banks that are controlled effectively by Anglo-Saxon institutions, all headquartered in New York City or thereabouts. The largest homegrown agency in India is a company called Care Ratings, which is the one that we're talking about. And it has all the ratings business has all these qualities that are really beautiful, high returns on incremental invested capital, and amazing customer economics. But it is a homegrown rating agency in that it doesn't have a foreign participation. And in the last few years, it seems to have spilt ink on its copybook, in that it probably allocated too high ratings to some local borrowers that they should not have allocated. And there was a famous case, ILFC, where Care Ratings had allocated an A rating to a company that ultimately went bust. It's a story that we know well. It happened in the United States with agencies like Moody's and Standard & Poor's. But in this case, for example, Crisil did not allocate an A rating to this company. So they spilled ink on their copybook. And on visiting the company, what I see is a company that has not had the benefit of a foreign owner like Standard & Poor's or Standard & Poor's or Moody's to teach them what global standards are. But CARE has something which is really, really important, which is it is not owned by colonial foreign powers. And I use that, I'm probably using that word very loosely, but what I see with CARE is an enormous amount of low-hanging fruit. This is a company that certainly can grow into being a far better processes, far better systems, far better approach to rating businesses, but it's locally owned and controlled. The number one shareholder at Care Ratings is a large Indian pension fund. And the number two owner, which is probably not ideal, but is still okay, is Crisil, is actually a 10% owner. And so a point that I've not been able to make in person to the regulators, which is the Securities and Exchange Board of India, is that I think it would be a great shame if, after having achieved independence from the British and having achieved extraordinarily high growth and lifting so many people out of poverty, and that India would not have global financial institutions that are homegrown. If we fast forward 50 years, India will be the largest English-speaking economy in the world. And I think it would be a shame if all of its rating agencies were controlled out of New York. There should be at least one that is controlled out of India. But long story short, this is a company that has a far more reasonable valuation, is far smaller. There are far more uncertainties as to whether it will develop the way I expect it to develop. But for that, the valuation is lower and the opportunity is great. But I would certainly not, this is very clearly a 5% bet or less, not something I'd be comfortable having far greater proportion of my net worth in.
That's really interesting. What's just to frame it, what's the multiple on this name roughly?
Yeah. And again, I don't, it's interesting because I don't think of multiples, but, and I'm actually just checking it right now to make sure that I don't get it too wrong, but it's about 20 times cash earnings, and I shouldn't really say cash earnings because we should be better than that. But it's actually about 20 times net income as well, and actually, funnily enough, though, Divya, and this is something that I've learned from studying the case of Amazon. If I could control, well, I don't want to control the business, because I'm a foreign shareholder, but I would want the company to invest as much as it possibly can, for example, in employee salaries. I've had conversations with people at the company where I share the example of McKinsey versus a consulting firm in Germany called Roland Berger, where Roland Berger is not as well known as McKinsey, and therefore they pay far higher salaries. Because if you're going to take the risk of going to a less well-known brand, you need to be compensated for it. And one of the most important places for a ratings agency to invest is in its staff, because these staff, when they graduate and go on to become investment bankers, are your most important source of new business. So that's what's very dangerous about looking at kind of things like multiples of earnings. You actually, if I knew that they were spending the money in an intelligent way, I would even be fine with multiple of earnings that was double that if they were spending half of their earnings in, for example, employee salaries.
Are you pretty involved with management for most of the companies you're invested in, or only a few of them, or none of them?
I've not been involved with management, and if somebody reads my book, you will see that I have this statement or this idea in my book that you shouldn't speak to management. I think that that's a really bad idea. If I ever do an update on my book, that's one of the first things that I'll put front and center. But I think that something that I've only realized, Divya, recently is that if you take an antagonistic approach towards management, that word gets around, and very quickly you're not going to be very popular in management circles. So of any company, because they'll find out that that's your nature. by contrast, I think that if I seek to help management achieve their goals, I don't think any management team wakes up in the morning and says, I'm going to rip off the shareholders or I'm going to manage the business badly. None of them really want that. But they are looking for people to help them to get things done. And so I think that I try to amplify the good actions of all the management teams that I follow. And in the expectation and hope that I will constantly be attracted to better and better management teams. This feels like a rabbit hole, but I don't think it will be, but it's easier to describe. Learning from Manish at the back of my annual report, have a page that looks like a company tombstone called Team Aquamarine. And in that, I name all of our suppliers. And even in the case of kind of major accounting and law firms, I name the partners, not the managing partners, but the ones who actually do the work for our firm. And the idea is to recognize the people in my circle. And when they get that recognition, I will attract some of the best people into my circle. So in the case of Care Rating, I've had a couple of conversations with the previous CEO. I've not yet had a conversation with the current CEO, but I've had a very nice exchange with him on LinkedIn of all places. And we're now in WhatsApp exchange. And when I get on the phone with him, it will be more a case of me saying, how can I serve you? How can I help you to achieve what we both want to achieve, rather than starting to try to explain to him that I think I can run the business better. I mean, just to give one example, it may be that the idea of raising employee salaries is a very bad idea that is not clear to me, and I would never presume to understand what is going on inside the business. But I'm sure that Mehul Pandya will understand where I'm coming from and understand the intent, but then a genuine desire to help him. So that might be helping him, attend the World Economic Forum, or having his salespeople attend the World Economic Forum so they can acquire new clients, or there are all sorts of ways in which I can be helpful. And that's just a policy of doing that across all the businesses that I'm invested in. And my friend William Green, the author of Richer, Wiser, Happier, he calls that friendivism.
I like that. I like that term.
Yeah.
Friendivism. I haven't heard that. How concentrated is your portfolio?
Well, it's not an equal weighted portfolio, because my rule of thumb is to invest up to 5% of the then value of the portfolio in any new idea. I'm unlikely to invest more than 5%, because that's just a number that works for me. I've also seen there's a good case to be made for making it 10%, but once I've made the investment, I will allow it to run for a long time. So there are some position sizes that have absolutely ballooned, including BYD, including India Energy Exchange, including Berkshire Hathaway, although over a far longer period. And so there are positions that are of sort of like 15% or more. And there are also positions where I said to myself, I will make this up to 5%, but I never really got past 1%, if you like. And actually, I would tell you that Care Ratings is in that category, along with Alibaba, just to give you two very, very divergent examples. And the reason why Care Ratings is in that category is that I really like the thesis that I've just presented to you. I think it's really interesting, but there's one incontrovertible thing that I can't get away from, which is that ratings businesses around the world are oligopolies, often duopolies between just two businesses, maybe there's space for a third. And in India, there are 5 or 6. And so, I have no doubt that CRISIL is a winner in that oligopoly. They've got a position that is far ahead of everybody else. But whether Care Ratings is a winner is not clear to me. And not long ago, there was an investigatory procedure against a smaller rating agency than Care called Brickworks, where they managed to keep their license, but only just. And so I think that there's, some businesses, it's very, very hard to see why they wouldn't survive pretty much the apocalypse. If you think of Mid-American Energy is a great example of that, or Burlington Northern Railways. This is a business that could easily not survive the apocalypse. And so I want to be extraordinarily careful.
So speaking of hometown companies, hometown heroes, let's talk about Credit Suisse. This, as far as I understand it, is not a position in your fund, but a company you know quite well, has obviously been through a lot and is going through a pretty serious restructuring. For what it's worth, I actually used to work there. I was an investment banking analyst there for 2 years in New York.
Right.
Right after, so I was there not long after they had acquired DLJ. So it used to be called like CS. Well, it was First Boston, then CS First Boston, then it changed to Credit Suisse Group. But yeah, any comments on CS in terms of where they stand? Is this like an investable company now? Would love to hear your thoughts.
Yeah, and so I feel like a lot of people I know personally and care about have been very, very badly burned by the I guess you can call it the bursting of the whatever it was, the omni bubble that we had in 2000, ending in 2022. And there are both commentators and investors who were extremely convinced for many, many good reasons of the qualities of the businesses that they were investing in, which were going to conquer the universe, conquer the planet for sure. And they were buying shares for their portfolio because they were even more enthusiastic about the prospects of the company than the sellers of those shares. And the prospects were extraordinarily good. But my experience has shown, even though it's very hard to do, that we do well as investors when we buy off people who are not enthusiastic. By contrast, we buy off people who are fearful, people who are pessimistic, where the mood is very, very much against the situation. And then if you have the courage to go in there, you can often do extraordinarily well. So just one headline number that is easy for all of us to understand is that the book value, accounting book value of Credit Suisse is approximately 40 billion Swiss francs. And the market cap is approximately 10 or 12 billion Swiss francs. So you have a company that's trading at 1/3 of book. Simple as that. There's a Ben Graham kind of investment, if you like. And obviously it's very, 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 very hated. Having said that, a leveraged financial institution can easily go to zero, and people are sort of focused on the possibility that it could go to zero. So that is the kind of like the downside. I don't think that you can ever get away from the possibility that a financial institution could go to zero or might be forced to raise capital at extremely dilutive rates, the way Credit Suisse has just done. But Credit Suisse has, at this extremely low valuation, now it's acquired over and above Harris Group, which is a well-known shareholder that's reduced their shareholding. It's acquired a shareholding from Saudi Arabia, Sovereign Wealth Fund of Saudi Arabia, and Sovereign Wealth Fund of Qatar, which are now approximately 20% of Credit Suisse. And obviously it has the ability to raise money at the discount window of the Central Bank of Switzerland. And the Central Bank of Switzerland and the Bund, the Swiss sovereign government, have invested very, very significant amounts of money in the previous financial crisis in UBS to the tune of, I believe, 16 billion Swiss francs. So I believe that if they needed a capital raise at this point, between two sovereign wealth funds of some extremely wealthy oil nations with very, very large and deep pockets, and the institutions of the Swiss federal government, that capital would be available. So I don't think there's a shortage of capital to sustain the balance sheet. And there are three clear businesses that the company is restructuring into, which is wealth management, asset management, and it's effectively spinning off the investment banking division in a very complicated series of transactions, but something that makes eminent sense. All of the problems of Credit Suisse arose from its investment banking division, and from the fact that the way the Swiss think and the way New Yorkers think is very, very different. And when you look at the decision making at Greensill, which was the one downfall, and the other one was Archegos, you kind of get a mix of two different cultures that don't really mix very well. But what they're doing is they're sort of hiving the investment bank off into a separately capitalized vehicle with a separate board, very clearly run out of New York by this guy Klein. And so I think it's a sensible restructuring plan, and you're getting the bank at a very, very steep discount to any valuation measure you look at if the business is sustainable. And I think that the business is probably sustainable. So it's a very, very interesting idea, and I keep picking at it, and we'll see where it goes.
Has the problems at the investment bank sort of affected kind of customer traction at the private bank? Have you sort of seen spillover where there might be sort of permanent brand damage that could affect kind of how individuals use the bank itself, the private bank?
And so we are, the fund itself that I run is custodied at Northern Trust at a different bank, but I as an individual and the kind of day-to-day running of my investment business, we use Credit Suisse. And at the time that the first of these crises hit, I went and polled internally. So this is kind of focus group of one. I was a little angry, very angry with the bank for starting its reputation in this way, and asked internally whether this wasn't a reason to move. What was really amazing to me was that at the granular level of day-to-day banking, even in a financial services firm like we are, the considerations are simply, do I like my client service rep? Does the IT system work? When I set up wire transfers, when I need to look at my accounts, how easy or how difficult is it? And my impression, based on that and a few other conversations, is that the franchise is extraordinarily strong. The bank did lose far more assets than I expected it to. I think in terms of wealth management, it's gone from, it's down by about 12, 13%, I believe, sort of 600 billion to 500 billion. Although I guess I was going to say, Divya, don't quote me on that, but you don't have to, because here I am revealing, perhaps I don't have those numbers completely under, I would have liked to have double checked them before being asked them, but that's fine. They're rough numbers. So there has been outflows, and that certainly is of concern. But my experience with banking and understanding of banking is that one cannot underestimate the way in which banks are kind of like the plumbing to the power of plumbing was the idea that was expressed to me originally by Manish. If we were to look internally here at moving banks, it would be a project for half a year, and it would entail an enormous amount of work that most people, I think, are extremely reluctant to do. So I think that when we talk about a banking franchise, you really can talk about a banking franchise. And I think that in the case of Switzerland, there are some smaller private banks, but the two largest banks, UBS is well known to have the culture of the Swiss Army, and many people who used to be in the Swiss Army go to UBS. And Credit Suisse has a culture of being far more entrepreneurial and being far more client-oriented. I think there probably is space in terms of a global audience that are interested in Swiss banking for those two kinds of cultures to exist. I would also say that there is certainly, there's no doubt in my mind, there is a precision around Swiss thinking that also comes into banking, and there are many people around the world who want that precision. And that precision hasn't gone away. In fact, it's been enhanced. I don't know either of the two leading characters who are leading this transformation at Credit Suisse, Axel Lehmann and Ulrich Körner, but they are rational, reality-oriented, hard-nosed managers who want to get things right. And so I think that there's plenty of reason for people to want to trust the Credit Suisse that will be in place going forward, in contrast to the Credit Suisse that was, which was still a very, very good place. It's just that there was this disconnect between the investment bank and the way they took decisions, and the corporate office in Zurich and the way they took decisions.
And they still have Roger Federer kind of at sporting events repping the name.
I mean, if you think of brand Switzerland and you're a Roger Federer or other people who are kind of associated with Switzerland, when it comes to financial institutions, there are very few that you can go to. I don't know if Roger Federer is still being employed by Credit Suisse, but I can tell you that the brand Switzerland is an extremely powerful brand, with or without Roger Federer. You've got the White Mountains, but even if you take away visually, I mean, the leading engineering school of Europe is well recognized to be the Federal Polytechnic Institute, or ETH, which is based here in Switzerland. And if you look at Swiss architecture, that architectural school is, so there are qualities in Switzerland that go far beyond Roger Federer that I think behoove Credit Suisse, if you like. Having said that, it's not in the portfolio for similar reasons to why K Ratings is not a huge position, because as somebody wise said, take care of the downside and the upside will take care of itself. And for all of my nice arguments, I cannot rule a downside that is zero for the shareholders. And that might still not be, that doesn't mean that the clients of Credit Suisse don't have safe assets and they continue to do their banking activities, but can you rule out a very dilutive capital raise? No, you can't.
Yeah, very interesting. Guy, we had a question from the audience. Somebody wanted to know, how many investments do you typically put on each year?
Oh, so last year was the most unusual year. I didn't buy one new investment. The only thing I did was sell Twitter. And I was writing my investment. Yeah, I was writing my investment letter recently with William Green, author of Richer, Wiser, Happier, helps me with the letter. He was up in Foster's and we were holed up in our sort of ski getaway, writing the letter. And it's like, how do you justify to your investors that you didn't do one portfolio move other than sell one company? I mean, what are they paying you for? And in my case, the answer is they're not paying me. So there isn't a management fee. So I don't feel as bad as about doing it. I think that, but to answer in a more helpful way to the questioner is that I think that it's an 80-20 type sort of distribution, a parallel distribution in terms of how many ideas one looks at in a year. And there'll be some ideas that one discards very quickly. And there are some ideas that one continues to review and mull over for potentially years before one gets to them, or before they ever become a buy for the fund. And so I think that, I mean, if you talk about casting one's eyes over a list of investments, I mean, I run screens where there are hundreds of companies that come out the other side, and I have watch lists where there are anywhere from 20 to 100 companies in those watch lists. And but the rules and the real question is, which are the companies you're reviewing very, very closely, and which are the companies that you're kind of glancing at once a year? And so I would say that, it's a cursory glance at maybe 600 companies, but intensive study on maybe 5 to 10 to 20. And part of the reason for this next to zero turnover last year is that I liked what I had, and I felt like that it was kind of like the right vehicle to carry me through a period of extreme economic uncertainty, if you like. And in general, and there is extreme uncertainty from my perspective, I kind of find the best modus operandi is to do nothing, sit and watch. And that doesn't mean go to cash and sit in a bunker and be scared that the sky is going to fall in our heads. But that also means that I don't have to kind of move the portfolio around enormously, because whatever I buy, I plan to hold it forever, if you like. So, so I think,
yeah.
The one other thing that I would say for the listener that is really kind of interesting for me, and we're starting to work on it internally, is, I'm a scatterbrained Divya. I'm good at thinking about things, but I'm not good at keeping on unless I'm super interested in something. My brain can go all over the place, and to have processes in place which enable me to continue to do in-depth research on particular businesses and bring them up to my mind is both a question of personal knowledge management that I could get into, but also what kind of processes I structure around me within the group of people that I'm working with, which is kind of an interesting question that we're starting to grapple with here. Sorry, you were going to ask a question.
Yeah, there's one other question about sort of country leadership, which gets back to the governance question. Manish is going to be talking about Turkey later today. And I think so. The person who asked the question also mentioned that in the past you've mentioned a hesitation to invest in countries where you've had issues with leadership, be it a prime minister or president, have you. And he brings up an example of some pro golfers not wanting to golf in Saudi Arabia.
Right.
I'm just curious. I mean, do you think of, is sort of, the ruler of a country typically, is it a black and white thing, or is it more of a, very much a case by case scenario, or are there countries where you simply just won't invest no matter what the business is?
It's a really interesting question, because I came to that kind of conclusion on Turkey. I certainly came to that kind of conclusion on Russia. I mean, I don't think I could have invested. There are two ideas that, I mean, I think it's being disloyal to the West to do it, but there are people that I know who have investments in Russia. If you're not a citizen of a blacklisted country and you do it in the right way, you can invest in Russia. And two very interesting investments. One is Sberbank, which is the JP Morgan of Russia, that's more than 100 years old and has lasted through the Russian Revolution, World War II, all sorts of things. The other is the Moscow Stock Exchange. I don't think that I want to invest in countries that are at war with the West. For example, I would not do that. You can't do it if you're an American regulated fund anyway. And then the question arises, well, Turkey versus China, and China abuses human rights. The plight of the Uyghurs and other peoples is really questionable. And so why would you not invest in Turkey, which imprisons journalists, and invest in China? And I can't give you any simple, clear answer. I mean, I can go into endless discussions, but it's not a simple, clear answer. Look, 2 years ago, I was aware that Manish was investing in Resus, and it may come up in my letter as a kind of a mistake of omission that I have to analyze, because there is no reason why I could not have put 1% of Aquamarine Fund into Resus after I knew that Manish owned it and after I did my own work on it. And I believe that that is up about 20x for Manish, which is really shows what an extraordinary mind and what an extraordinary investor he is. I had principled reasons for not wanting to invest in Turkey, and it's quite possible that if I'd invested in Turkey, the results would have come out differently. I think that, very briefly, on Russia, which is a human rights abuse, sorry, China, which abuses human rights, and Turkey, which abuses human rights, somehow China's capacity to lift so many people out of poverty somehow diminishes the significance of their abuses of human rights, which all the human rights people that I know would tell me is a terrible, terrible means of reasoning, because it's basically saying, well, if it's expedient, it's right. And one should never engage that kind of reasoning when it comes to human rights. It's, and I can make a case as to why China and Turkey are different. It may just be that I have personal experiences with Turkey that led me to decide not to want to invest there. I had a very successful investment in a Filipino company called Alaska Milk, which had 98% of the condensed milk market, even though many people told me that Imelda Marcos was one of the most corrupt politicians on the planet at the time that she was around, and that the Philippines is a highly corrupt country. The company I invested in was not corrupt. So I can't claim to be more rational than anyone. All I can do is try and observe and explain why I did those decisions, but they may not have been the right ones.
So fascinating. Actually, Guy, just to close, because we're running short on time here, is there any company in America that you're invested in or have started to circle around?
I'm going to say this at the possible expense of a whole bunch of people looking at it and driving the price up. It'll be a good test to see if anybody pays attention to me or not. I mean, I have investments in Moody's and in Berkshire Hathaway and some businesses that are extremely well known and understood. But so I ran a screen the other day, and I modified the screen slightly, which threw up some really interesting companies. One of which is a brand that I understand really, really well, because my son loves wakeboarding and I've enjoyed growing up water skiing. And those of us who know water skiing know that, probably most of the boats that we want to water ski behind are either brand name Chris-Craft or Mastercraft. But it turns out Mastercraft is a publicly traded company that buys back its own shares and is a powerful brand and is sitting there at a very, very small. I think it's on the borderline between micro cap and small cap, something like that. It's a $500 million valuation. It's a very interesting brand just sitting there. So I'm circling around that and taking a look. But there have been so many companies that I've rejected. And you got to be careful in the United States because it is the world's most picked over market. But there, I've thrown that name out. I wonder what will happen to it.
Guy, that's a great that's a great way to close. It's been an honor, a real privilege, and thank you so much for taking the time. This has been really fascinating, and I think everyone can appreciate your candor. So thanks so much, Guy. We'll be in touch.
Divya, can I just say one thing about Divya to the assembled audience? You may not know, you certainly don't know this, but a few years ago, I contrived a fun exercise for my niece to get to know people in the finance industry in New York, where I emailed a whole bunch of friends and acquaintances in New York and told them that my niece would personally deliver probably some chocolates, some Toblerone chocolates or something. And you should know, Divya, that she was so impressed by meeting you, and she had such a nice time.
Oh, that's so nice of her.
So gracious to do that. And I think that you may have changed her life, actually, because it gave her the confidence that she could go and knock on somebody's door and be personable. And so thank you for doing that. There was an extraordinary act.
Oh, anytime. And if she ever wants to chat again, I'm available.
Well, not too much, but
yeah.
And thank you so much for having me on this. It's a real honor and a privilege. I hope that it adds value to everybody's lives. And my apologies for not having the numbers right at my fingertips. I should have been better prepared.
No worries at all, Guy. And feel free to listen on to the rest of the conference that's going on all day till 4 p.m.
Thank
Eastern.
you.
Appreciate it. Thanks, Guy.
So now we'll be hearing from the winner of our mid-cap category, Mitchell Scott of Choice Equities Management, who will be discussing one of my personal favorite companies, Crocs Inc. So to give a little background on Mitchell, Mitchell founded Choice Equities in 2017 after 5 years of investment experience at KDI Capital Partners, a 2014 Barron's Top 100 hedge fund, where he was an analyst and the PM of the focused distribution strategy. Previously, he was a senior analyst with Anchor Capital, a boutique investment management company focused on micro to small cap U.S. equities. His professional experience also includes time at Edgeview Partners, a boutique investment bank focused on mergers and acquisitions, in various positions at KCIC, a consulting firm specialized in litigation support and insurance-related asset and liability management. Mitchell graduated cum laude from Clemson University in 2003 with majors in economics and English, and he received his MBA from the University of North Carolina in 2008. Finally, he earned the Chartered Financial Analyst designation in 2014. Mitchell, very much looking forward to hearing this pitch. The floor is yours.
The mute button. Thank you guys for having me, Christian. I appreciate the intro. Divya, love the platform, what you guys are doing with SumZero. I'm a big user of it. And so really just thank you guys for having me. It's a pleasure to be here. I should also say before I go, it's just really cool for me personally to have this time slot after Guy Spire and before Manish Pabrai. As you mentioned in the intro, Christian, I've been a buy-side analyst for a number of years, and your books, Guy and Manish, I was reading at the time, 2014, 15, kind of 16, really thinking a lot about whether I wanted to go out on my own and start my own fund. And so, a lot of what I picked up in those books was very influential to me. And so thank you guys for writing them. So as I was evaluating whether or not to launch a fund of my own, Choice Equities, you obviously put a lot of thought into, how do I want to run the portfolio? What sort of structure should it have, et cetera. Not all that shockingly, I came up with a pretty tried and true formula. It's a long biased concentrated portfolio, small mid cap US equities are our focus. It's typically 10 or 15 names. I try to underwrite to a 2 or 3 year hold period and sort of solve backwards from there. Yeah, so let me share my screen. Let's see here. All right, is that live? Can somebody point me in the right direction?
Yeah, you're live and expanded.
So you guys are seeing the deck?
Yes,
Yep,
sir.
looks good.
Awesome. Oh, screen share stopped. Is the deck back up there?
It's just the desktop, the background.
Okay. Let's see. All right, how's that?
There it is.
Cool. All right. Without further ado, so yeah, tried to figure out if this is something we wanted to do, and determined, if we could outperform by 5 or 10% a year over a meaningful time horizon, that'd be a worthwhile endeavor for everybody. And so, we've been fortunate to follow through on those goals. We've compounded, I guess, high teens since inception of early 2017 versus the Russell 2000, which I think was our primary benchmark, around 7. Stock pickers portfolio, 10 or 15 longs, started as the one-man band. Recently, I've been able to add some team members around. So now we've got a team of 3, which is, I think really good for us and for our investors, hopefully, as well. So, if anybody wants to reach out, if they have any more interest in learning about us, we're an open book. We'd love to chat. So our contact info is on the slide. So please just reach out. Anyway, so enough about me and choice equities, and we'll talk now about what we're here to talk about, which is Crocs. And so it's the funny looking shoe with a funny looking name that people love, or that people hate, or that people love to hate. And I think everybody's probably fairly familiar with the company. It's one of the few multi-billion-dollar shoe brands out there. But what we're going to do today is really just talk about the investment case. And so to me, what that means doing, particularly in this case, it's always helpful to see and understand sort of where they're coming from and where they're going. So we'll talk a little bit about how the company was founded, just briefly gloss over sort of the global financial crisis years. And then really we'll hone in on kind of the last 6 or 7 years. And so there's kind of 3 or 4 pre-pandemic years and then pandemic years. And then I think that can kind of set the stage for us on what we think is to come and why we like the investment here. So just briefly, it's 20 years old or 21 years old now. Founded in 2002, 3 founders went on a fishing trip to Mexico. One of them had a prototype foam clog with him, and his buddies tried it on, and it was super comfortable and very durable, and had a lot of use cases. So from there, they got together, went into business. That foam ultimately became Croslite, their proprietary, rubber-based material. And they put that together with a highly efficient rubber injection molding manufacturing process. And next thing you know, Crocs, as we know it, were born. They IPO'd in 2006, bit of a boom bust on the back of the financial crisis, and then some spotty execution thereafter for about 6 or 7 years. And then over the last, call it 7 years, 6 or 7 years, execution and performance and life for the company in general has just really been a lot better. So today, or as of last year, Crocs Legacy was doing $2.5 billion in sales. Hey Dude, a company they bought a year ago, is on a run rate basis for about $1 billion. Excluding Hey Dude, they sold 103 million pairs of shoes last year, averaging something on the order of $50 or $55 at retail. So overlooked, unloved, misunderstood. I've characterized some of our investments this way in the past. I think if anything, from our vantage point, this probably falls into the category of misunderstood the most, which is also my favorite category. So frequently, you know, if you just arrive at a different view, a different way of looking at the company relative to consensus or the street, you know, you have an opportunity often to buy them cheaply on existing cash flows. And then, you know, if our view proves out to be right, we can buy that with a margin of safety, and then also have an opportunity for a really attractive return and rewarding return stream over time. So where is Crocs today? It's trading at 9 times EBITDA, 11 times this year's earnings, 2.5 billion brand globally. You know, I think probably the place to focus is the short-term stock price chart there over the last 5 years. And basically what I think people are looking at is they're looking at the chart and they're looking at the pandemic boom. And they're really just assuming this is a pandemic beneficiary, and perhaps earnings are going to fall off a cliff, or the company's best days are behind them. And that's not really my view. You know, I think we'll kind of go through why that's not the case. But certainly, if you were to just look at the trailing financials, that would support the case. You know, earnings went from almost $2 in FY19 to 10 over 4 years. So certainly wouldn't want to imply that the pandemic was bad for them. Just that life on the other side of the pandemic is probably going to be pretty good too. So as you peel back the onion, you know, beyond the misunderstanding, our view, company's well run, the stock is cheap, has promising growth prospects, and together, you know, I think you can buy this, and with strong prospects for mid-teens annualized appreciation from here. You know, or if you look out a little further, maybe there's multiple expansion, make a pretty reasonable case for a double or triple over a 2 or 3 year time horizon. So short-term pain for long-term gain. That's how I think a little bit about this Hey Dude acquisition that they announced in December 2021. You can see on the stock chart, the market did not think kindly of that at the time. So really just kind of moving back to 2021, consumer boom period. And then all of a sudden everything starts rolling over. Inflation's becoming a real issue. There's a whiplash effect for a number of consumer goods companies who have over-ordered inventory, and then demand is declining, and really just a nasty soup for a lot of these companies. So facing tough end markets, most of these stocks were facing meaningfully declining multiples, meaningfully declining margins, both gross and operating margins. You know, somewhat interestingly, on average, so many of these branded and retail companies actually experienced earnings, operating margins lower than 2019 after steady step functions higher from 2019. So a real big hangover for a lot of folks. You know, one thing I would add is that this prior boom bust cycle that they went through in 08, 09 probably created some of these perceptions as well. So the acquisition they did of Hey Dude, that's sort of the backdrop for the timing of the acquisition. They announced it in December 2021. Nobody had ever heard of the company before, except for people that were buying their shoes. And it, you know, sort of makes sense. It's a interesting story how it came about. So it was founded by an Italian based in Italy, manufacturing shoes in Vietnam and selling shoes in America. Entering 2020, they had close to only 100 million in sales. And then Crocs paid 15 times trailing EBITDA for this company. They had been in a steady share repurchase capital allocation plan. Instead, they levered up to buy this. They did use, I think, about 3 million shares. levered up to 3 times to buy this. And it was a big bite. And Crocs was trading fully valued at the time. It had 21 times earnings multiple. Market cap was 9 billion. They were going to do about 700 million in EBITDA that year, and they paid 2.5 billion for this company. So it was a precipitous decline, about 2/3 over the space of 2 or 3 months there. And then subsequently followed by a number of insider purchases. And so this past spring is actually where we became interested and began building a position. And so, just talking a little bit about the company, some of these perceptions that I think have kind of followed the company around really stem from that price chart that we were just looking at over the company history. And it really suggests that it's a fad-driven boom and bust type business. But as you peel back the layers of the onion, our view is that's not really what the case is. So there's a few things that kind of support our view, and one of which is not a panacea, but it is interesting to see that Crocs shoe volumes have grown on a year-over-year basis, and at all but 2 of the company's 20-year history. And even those 2 declines were just 2 or 3% type declines. So, that doesn't necessarily foot with the boom bust cycle narrative that a lot of people, I think, hold. Additionally, I would say that Crocs is an international brand. Much like all other brands today are becoming international brands in an increasingly globalizing world. So pre-pandemic, for most of that period, North American sales were closer to 40% of the average. That's certainly changed here recently, but that kind of factors into our growth projections for the company going forward. Finally, one other thing I would say is, this company looks to be benefiting from the expansion to the direct-to-consumer channel, just broadly on kind of a secular basis. I think this enables companies with good brands. It gives them tighter inventory control, better brand management, generally more profitable, higher returns on capital, and just on kind of a secular basis, I think there's a strong case to be made as making good brands more valuable. So here, let's talk about these kind of 6 to 7 years prior to the pandemic period. Really what I want to do is just kind of call attention to a couple of the bubbles on the box in the graph there. So Blackstone came on board in 2013, $200 million investment. Somewhat interesting. So, Crocs actually had cheaper financing available, but they wanted to go with Blackstone. And, primarily they wanted people on the board with real restructuring expertise. And so, basically what to me we're seeing today is the fruits of those labors 4, 5, 6, 7 years ago. So, they were involved in 13, basically. Some of you may remember golf shoes, Crocs golf shoes floating around that you basically couldn't give away. The company had just overexpanded on the back of kind of 12, 13, and 14. So the restructuring effort, one of the first things they did, they cut the SKUs in half. Then they shrunk the store base by 1/3. And that's kind of the standard sort of playbook for restructuring overburdened brand, overburdened retailer. So Andrew Rees had been president since 2014 rather, and he became CEO in 2017. So want to just highlight sort of the 17-18 period. What you see is the gross margins kind of leveling out. But then you look and see just a few incremental sales really driving much higher EBITDA margins. So really going from 5 to almost 15 in the space of 2 years because of those cost outs. And then the other bubble I've drawn is the pickup in sales in North America. And so when Andrew Rees came on board, one of the first things he did is he made a really big push into digital marketing strategies. And so relying on influencers on social media, on Instagram, whatever the channel, to really connect with the customer. And so they had done all these things right, and they just were not getting the lift that they had thought that they would get. And so they were they were strategizing about what to do, how do they drive sales, how do they connect with the customer. They knew that they had a strong brand, but they were just not driving motivation. And so they came out with this marketing program called Come As You Are. And that was really kind of the jumping off point for them. And so, to me, that's a major part of the secret sauce that I think the team has put together. So where does that leave us today? What does the business look like today? Just kind of call out some of these things. So, Hey Dude, the recent acquisition, we'll talk plenty about that in a minute. That's about a quarter of sales. Crocs is the other 3/4. Clogs are about 55% of sales. Interestingly, we're thinking that going forward, North American clogs are probably closer to 40%-ish of the business. So they're doing a good job of diversifying the company around geographies and brands and silhouette styles. Hopefully just becoming a broader, better company. The Americas is 71%. Digital penetration is growing, and then the direct-to-consumer channel, which is stores but also digital, is about 45% of the mix, and they think they can take that to 50% in the coming years. So here's a look at the company's plan. It was most recently updated late 2021. And this is what they'd unveiled. They wanted to grow legacy Crocs to $5 billion in sales. And so basically that would have been a 17% compound annual growth rate to get there, which is certainly which is meaningful growth. But they did call out a number of critical growth paths to get there. So, the way that we've kind of looked at it, we see sort of 4 under-penetrated vectors for growth that can help them achieve that plan. In addition to, continued relevance with the North American consumer. Additionally, they bought this Hey Dude company, and that's somewhat sort of separate from these plans. As far as their stated intentions, they haven't really updated it other than to say that they hope to have $1 billion in sales by 2024, even though the recent run rate is about $1 billion. So probably some conservatism there. We'll dive into each 4 of these things somewhat quickly. Before I move on, I would just add on this slide, management plans, we tend to evaluate with a heavy dosage of salt. We've certainly seen plenty of pie in the sky plans that seem overly optimistic. What I would say to that is they put one plan like this before investors before. They executed very soundly on it. They've just done, since this management team has been there, a really good job of communicating with shareholders, creating a strategic plan that makes sense for the business, and then executing on it. And so they've just done a really good job of doing that thus far. So sandals have been met with somewhat mixed success for the company. They haven't had a tremendous amount of focus there, but they are beginning to focus a lot more on that. So they're close to almost 500 million in sales this year. They're mapping out, $1.2 billion in 4 years. And so that's a nice area of expansion for them that comes with a large addressable market. Here we're going to look at both Asia Pacific and EMEA. We're going to kind of draw the same conclusion. This is a little bit more just support for, the case that they've made some really good moves prior to the pandemic. So the playbook, digital marketing, expanding direct to consumer, reducing stores. What you see is the store count has come down, the margins have come up. Here they're actually fairly evenly represented across India, Southeast Asia, Japan, and South Korea. And China today is really less than 5% of company sales. So that's the second largest shoe wear market in the globe. And that's just a meaningful opportunity there. So it's also somewhat sort of interesting to see, this has been in their comp plan, growing sales in China for the last couple of years. So they've taken a number of initiatives to just kind of take a long-term planning framework to growing sales there. And I think we're starting to see the fruits of those labors here. The EMEALA region, same thing. Mid-teens growth here is what they're targeting. You see the store count come down, you see the margins come up. Gibbets, these are worth talking about. You know, it's interesting, you know, you see what, 3.5 billion of sales on an LTM basis and 162 million of sales, and maybe it's not all that important, but this is particularly interesting to me. You know, what a great acquisition this has turned out to be for the company. They bought it for $10 million in 2006. There was another $10 million earnout. And it was a bit of an afterthought for the company for quite some time, but recently they put a lot more emphasis into these. And so the Gibbets do two things. The first is just from a brand engagement perspective. It's just a tremendous positive to continue to create this continuous engagement with their customers. So, you know, you buy a clog and then you buy a 7-Eleven Gibbet and you stick it on there, or you buy a Lucky Charms Gibbet, or, you know, Captain Crunch, if that's your cereal. And so you just rotate them in and out, and you basically accessorize your shoe and, you know, create some permanence to the relevance of that shoe, so their customers can sort of accessorize it. The other thing that's very interesting is they come with very high gross profit margins. Management's always a little squirrely about pinpointing exactly the numbers, but you know, we think they're about 90% gross margin. So very accretive to the op margin with minimal incremental cost to deliver those. They're looking to double that by 2026 because they haven't really focused on expanding that too much internationally to date. So, Hey Dude, arguably the biggest growth vector of them all, is what, a little more than a quarter of sales now. And this is, I think, certainly responsible for creating a lot of a decline in the stock, regardless of whether or not it was the right thing to do over the medium and long term. I'm sure there were some shareholders in the short term that were frustrated by it. As I said, up until now, I think it was mostly unheard of brand with kind of an odd, unorthodox history. But it's incredibly profitable. I mean, so they basically bootstrapped it from nothing in 2008. And they had less than 200 million in sales entering the pandemic. Then they had 191 and then 580. And now we think they're going to come in just under $1 billion. And so we don't really know what's to come here as we go forward, but it's highly profitable, 30% EBITDA margins plus when they bought it. You know, they're going to put the Crocs playbook into effect here. And there's a couple of real positives here. So Crocs are, you know, polarizing, as we kind of discussed. But the loafer category is a little different and not quite so polarizing and dramatically larger as well. So it's a $120 billion category. This gives them, you know, less than 1% share of that. They recently brought Kevin Blackshaw on, who's the former head of the Sperry brand. And there's just a ton of white space. So this is sort of interesting to contemplate. You know, it's really only known to date mostly in the Midwest and somewhat here in the South and kind of East Coast. But the brand awareness for the company is really around 20%. And if you think about Crocs, that's kind of around 90%. And they've just now started to really roll out the Crocs playbook. So they're doing the influencing marketer strategy and the other things that follow with that, not to mention the distribution to other Crocs partners. So really, really promising start for this brand in a very large category. Well, whistle here a second. So thinking about the margin trajectory of the company, that's something that we really need to do to have that discussion. There's a lot of margin volatility that we've seen over the last couple of years. Basically what you see is moving up to 55 from lower discounting in 2020, and then 21 was a was a very strong year. 22 featured kind of a regular amount of discounting. They had several hundred basis points of air freight fall into that depressed the gross margin. And now we're looking at sort of the company's always engaged in some level of discounting on their products just to keep things fresh, as have all companies. So we're kind of contemplating a flat to downish gross margin going forward. Hey Dude, now 28% of sales, has a margin dilutive impact at the gross margin line. We think it's in the high 40s, depending on which quarter you're looking at. So we wouldn't be too terribly surprised to see the gross margin come in a little bit. But we do have a lot of confidence in the EBITDA margin. We're using EBITDA here because of the amortization that's come on board with the acquisition. But the company's mostly spoken to historically 26% operating margin bogey or better. They've expressed a lot of confidence around that. Kind of as you go through the buildup that we sort of just went through, I think you see reasons to suggest that could continue to be the case. So here's just kind of our forward-looking kind of return possibility matrix. As I've highlighted the plan, that's down there in the bottom left corner. But as we look at the projections going forward, as I said in the write-up, there's a surprisingly defensible upside price target for $500 in 4 years. And I'll just kind of walk through the math on how we get there. But so the midpoint over there is really just the company plan. So, that's a 17% CAGR. We're just using that as a plan. Hey Dude is a little harder to gauge. It's off to just an incredibly good start. Seems like there's a lot of opportunity. I mean, independent of the projections and whatnot, I mean, it's worth asking the question if it could maybe one day be bigger than the Crocs brand itself. But just thinking about the here and now, we're kind of modeling to a 25-26% CAGR. Then we took a little bit of a haircut to the operating margin targets just for conservatism, and then put a tax rate on it. And then we incorporated something of a buyback, and that's basically spending within the cash flows. And they basically had said, they expect to, by this level, be generating about $1 billion in cash annually. This is just an incredibly cash generative model with these best-in-class operating margins. CapEx is sustainably low, around 3% a year. So you put all that stuff together, you go to the bottom right box over there, 15 times, $33 of earnings in 2026. That's $500. I think that's your upside case. It's nice to think about that. We're certainly not banking on it by any means. And so it creates what we think is a pretty interesting risk reward here. Lastly, just on the share repurchase, so they levered up to 3.25. They just paid down $300 million of debt in the quarter. They have not entirely completed, so they spoke about it at ICR. So they've already paid down $500 million of the debt, and they're basically like just over 2.3 times leverage, we believe. They've stated an intention to get back into the market and start repurchasing shares under 2 times gross leverage. So we think that's coming sometime this spring or this summer. And if you really do have this sort of growth, and you put a meaningful share buyback on it, which they've done before. They bought 20% of the float, 18, 24 months ago, and then again from the Blackstone days. It's in their DNA, and so they're serious about re-engaging with that. So here we are, just looking at them relative to their peers. Overlooked, unloved, misunderstood. One of them, all three of them, maybe just misunderstood. I'm not sure, but we think if they're going to be able to continue to grow, the valuation's just really attractive for the company. Basically what you're seeing is, their EBITDA margins best in class, and their earnings multiple is the lowest on the chart. So, and I'm now seeing the clock up there, which looks like 29 minutes in. So let me stop.
Awesome, Mitchell. Thank you very much. It's funny. I've actually seen, I have a few friends who own, a pair of the Crocs, and one of them just recently got those Jibbitz that have headlights on them. So the guy's walking around with headlights on his Crocs. I figured that was relevant. We do have a question here from the audience. And they say, hey, dudes are extremely popular in southern states, similar to Sanuk a few years ago, which was acquired by Decker. Do you see a similar trend happening with them as with what we saw with Sanuk?
Certainly could be the case. It seems to me that the valuation would suggest that most are taking that view, or they're just still kind of getting familiar with things and what we think are the growth prospects there. To me, we're on top of this stuff on a day-to-day basis, channel checks, etc. But to me, if anything that gives me confidence is that's not going to be their fate here. It's just the engagement that the management team has driven with their customers on their other products. And so I just see what I think is this kind of secret sauce of them being able to connect with their customers and drive the brand. Whether it's the social media or the digital marketing or whatever it is. And they've just got a really good track record thus far of having done that. So it's a great question. It's something I think about a lot.
Got it. Thank you. And one more, there's actually on your report, and I know you touched on this, maybe they've been kind of burned in the past, trying new things like golf shoes. But this one person asked, why hasn't or will it leverage the Crocs brand into apparel or something else?
That's a great question. Moderation in all things, right? And they've got really good things going that are within their core competency right now. And they've laid out a plan that they're focused on executing. So, if they execute on the plan as they've laid out, I mean, that's a really promising plan. I don't really want to see them deviate from that. So they've got enough in front of them by sticking to their knitting. Now, maybe much further down the road, that's something you could consider, but there's just a balance, right, that you got to strike. And, that's certainly what happened with the golf shoes, is they overexpanded in the SKUs that nobody wanted and stuffed the channel, and the brand got diluted. And the people that are there now, the board, the management teams, they live through that. So that's top of mind.
Awesome. Mitchell, this was great. Thank you so much. Congrats again on the win, and, appreciate you coming on and, giving this presentation.
Thanks, guys. Really appreciate it. Love being here with you guys virtually. Thank you for the opportunity.
Thanks.
Mitchell, thanks so much for walking us through that opportunity here. I think for everyone that's a member of SumZero, his full report is up on the platform. If you care to chat with Mitchell directly, feel free to ping us. Access@sumzero.com. or we can help put you in touch.
Everybody, it's a great privilege, obviously, to have Manish back on SumZero. Manish, you're a bit of a value investing legend. You've got Guy Spear here, who's himself very well known in the community. Kind of itching to hear what you've got to say. In the past, we've chatted. I guess this was like last summer. I forget exactly, where we kind of went through a whole bunch of sort of different themes. Big tech being one of them. Turkey being another one. And so I guess we can start with Turkey. Obviously super tragic what's going on there right now. It seems like every time I open up a web browser, I see like the death toll rise by a few thousand. It's just kind of hard to believe. But you've been an investor in Turkey. You've been to Turkey, you visited it. I'm assuming you've spent a decent amount of time there by this point. Maybe just first off, like before we even get into Resos, do you have any just sort of reflections on what's going on there recently? If you have any thoughts, feel free to sort of share them with us.
Yeah, I mean, it's very tragic. I think the death toll numbers, and one thing that disappointed me in the media is that we keep seeing the death toll rise, but what they don't report is the number that are missing. And the number that are missing will unfortunately eventually approximate the actual death toll. I mean, we are going to see some miracles, and I hope we see a lot of miracles. But, it's been more than 3 days. And so as the time goes by, and the missing, my friends in Turkey tell me, could be as much as 100,000. And
Wow.
So it's a very large number. What I would just say is that SumZero has been very generous to Dakshina. I would say that anything you're planning to do this year for Dakshina, you should redirect to Turkey, to the relief efforts. And if it comes to us, then we'll redirect it anyway. So, and also the same to your viewers, I think, to the extent that they are thinking about Turkey, I would say think about the relief efforts and such, and any way we can help, because it's a serious human tragedy, and I don't think the scale is known yet, but it's really bad.
Yeah, I think that makes a ton of sense, and we'll certainly follow up with you on that.
Yeah, I think that the Turkish market, they closed the market until the 14th because it was so in Turkey, basically stocks can go up or down at most 10% a day. And for a couple of days, they hit the 10% lower limit. It didn't really matter which stock it was. I think almost the whole market was hitting the lower circuit, even though a lot of the companies are not directly affected or may not be that affected by the tragedy. And so I think the regulators felt that, give it some time for people to not do panic selling or whatever else.
Right.
But when the market opens up on the 14th, prices are likely to be more attractive than they were a few weeks ago.
Yeah. Well, it's a good thing we have Guy on the call here. One of the questions that one of the listeners had for Guy, which is sort of a philosophical one, is how do you think about investing in certain, getting comfortable investing in certain countries, and to the extent values may be different from the West, whatever, people have lots of different views on this. Guy had at least previously sort of passed on Resos, even though he knew you were invested in it, just because he wasn't as comfortable with the region, the jurisdiction, governance, things like that. So just taking a step back, we've talked about Resos before as being just the way you described it is sort of an unbelievable value. But how did you personally just kind of get comfortable with Turkey as a market? what was it that kind of helped you get over that hurdle?
Yeah, I mean, I think in investing, we're always going to be looking at a number of different factors around an investment. And one of the difficulties that comes up in investing is what weight we give to those factors and how we think about them. So if I go back to 46 years ago, 1977. So 1977. Charlie Munger got a phone call from a friendly broker offering him 300 shares of a company called Belridge Oil, which was a large oil field in Bakersfield, California, for $115 a share. And Charlie said, "I'll take it." It was a very thinly traded, pink sheet stock, and that was about $35,000, and he made that investment. And Charlie knew from what he knew about Belridge that it was probably trading at 10-15% of liquidation value. It was really cheap. And 2 days later, the broker called again and said that he had another 1,200 shares at the same price. And this time, Charlie didn't have the cash, and so he would have to either sell something or borrow the money or something. So he told the broker, "I'll call you back." And he thought about it, and he decided to take a pass on those second 1,200 shares. So the first 300 shares, Belridge had a market cap of about $115 million in 1977. And 2 years later, 79, Shell Oil bought the company for $3.6 billion. It was about a 30x plus the very fat dividend that he collected for a couple of years. And so his 35,000 became about $1 million in 79, which he then proceeded to put into Berkshire at approximately $300 a share, which is now close to $500,000 a share. That's about a 1,500x. And so the million today is about $1.5 billion. And so the 35,000 became about $1.5 billion. It's about a 45,000x over that period. Now, Charlie says Belridge was his biggest mistake because the 1,200 shares that he chose not to buy, that he knew were worth at least 5 or 10 times what they were being offered at, would have given him about another 4 million in proceeds, and that would have converted in about 6 billion and counting into Berkshire shares. And he said that, the CEO of Belridge was a bit of an alcoholic, and so he said that he knew the oil field was spectacular, and actually, this was an oil field that actually they owned all the rights, which is very unusual. They owned it into perpetuity. Just to give you a sense of what happened with Shell from 79 till today, Shell has pumped out and collected more than $60 billion from that oil field since 79, buying it, and it's still pumping. It is still producing oil for them. So it's a very prolific field. And Charlie knew that. So he said, when he reflected on Belridge, he said the oil field didn't drink. Okay, he said it was the CEO who drank, and he needed to, what he didn't separate was the oil field from the CEO, right? And so basically, he said, I overweighted the CEO's alcoholism, and I underweighted the basic economics of the field, which you couldn't really screw up whether the guy running it at the time was alcoholic or not. So when we look at Turkey, obviously you're going to see macro issues. You're going to see, very high inflation. You're going to see monetary policies that don't make sense. You have all these things going on at a kind of high level over the country. But then, when you look at individual businesses, so let's leave Resas aside for a second, and let's talk about the Coke bottler in Turkey, because that's a business that everyone will be more familiar with. I think you can understand what the bottling business looks like around the world. It's very similar. So the Coke bottler in Turkey has an exclusive right to sell all Coke products in Turkey. Not only in Turkey, they're in 12 other countries, including Pakistan. So they do all the Coke bottling and sales in Pakistan. They own 49% of the Pakistani Coke bottler, and the Coca-Cola company in Atlanta owns 51%, which they probably in the next few years will sell to the Turkish company. And Coke sits on the board of the Coca-Cola bottler in Turkey. It's Coca-Cola ISIC. So Coke owns 20% of that business, and they sit on the board of that company. And basically, when Coke has bottlers that come up in the region, for example, they had one in, I forget, I think it was Turkmenistan, one of those Central Asian countries where the government was the bottler, wasn't doing that great. And basically what Coke did is they arranged a sale to the Turkish company, and they even subsidized the sale for them. So they are so I would say that when we look at the Coke bottler in Turkey, and you look at another Coke bottler, in Europe or in somewhere in the US or Latin America, they are very similar businesses. They have very similar economics. And unless Turkey did something strange, like, put capital controls or something else, these businesses should be valued very similarly. But they are not. So the Coke bottler basically, trades at barely hitting double-digit multiples now. And it used to be less than half the price a year ago, trading at 4 or 5 times cash flow. And so when we look at businesses in places like Turkey, and I met them twice actually. The Coca-Cola bottler company in Turkey, and there's a video I had done a few years back, a talk at UC Irvine. It's about 2 hours just on the Coke business model, and I asked them to look at that video, which they did. And when I met them the second time, they didn't really want to talk to me about the merits of investing in their company. They really wanted to pick my brain on the strategy they should adopt, which was kind of fun. So they were actually asking me a bunch of questions about, different folks in the road and what they should do and so on and so forth, which was good. But that business is owned, the promoter of the business in Turkey is one of the highest quality families and management teams in Turkey. They have 2 other listed businesses. They have a beer business, which they have 50% market share. They have a very dominant supermarket. All 3 businesses are very high quality. The people that I met running these businesses were the highest quality management team of any team I met in Turkey. They were exceptional. Some of them had Ivy League educations in the US. The CFO of the Coke bottler used to work in Atlanta for the Coca-Cola company. He then worked in Delhi for the Pepsi bottler. I mean, he'd been all over the place. He's actually Ukrainian. He's not Turkish. So I found with that particular company a great management team. I found a monopoly business, or a duopoly business, you could say, in terms of the dominance of the brand. And then you have the overlay of Turkey. So I think that when you, as an investor, look at these things, it's important that you weigh the factors correctly. And there is some weight that you should give to the fact that it's in Turkey. But to say that I'm going to reject it because it's in Turkey is like Munger saying the CEO drinks too much. So I think this is one of the interesting things about investing is that we don't usually get pure, pristine bets that we can make. There's always some hair on them. We talked, actually, time flies, but the last time we spoke was about a year ago. I know it seems like it was shorter, but when we spoke about Meta, even a business like Meta, there are very great aspects to the business, and there are some not so great aspects to the business. And, you have to weigh those factors, and we won't always get it right. But the more rational we are in looking at those factors, probably the better decision we end up making.
Yeah, Manish, the interesting thing about you is that you're known for taking pretty concentrated bets, and you're also known for holding on to positions without any kind of like hard line or bright line cap in terms of, a lot of times people are, oh, well, this stock's now 10% of my portfolio, I better sell it so it's back down to 5% or something. Like, as far as I understand it, you're not of that school of thought. So when you were looking at Reysas from a weighting standpoint and trying to handicap it for the fact that it is in Turkey, how did that affect your position size?
Well, the problem I had with Reysas was that when the day I met them for the first time, the market cap was $16 million. So no matter what I tried to do, at that time, we were managing around 700 million. And I ended up, by the time I finished buying the position, I ended up owning about a third of the business for 7 million that we invested, 7 or 8 million. And so I didn't want to make it a 1% bet. I ideally like to make 10% bets, but there just wasn't an opportunity, on a $20 million position to put 70 million into it. I couldn't do that. And so now Reysas, since then, I mean, now with the earthquake, it's dropped a little bit, but it's, hovering around 250, 300 million now, so it's moved up a bit, but their liquidation value, which used to be about, 600 or 700 million when I was making the investment, is probably north of 1.5 billion now. So that's also moved up quite a bit. So it's no longer at 2% of liquidation value. It's probably more like maybe 20, 25% of liquidation value, something like that. And it's not the liquidation value that really interested me. What interested me was that this was a company that was extremely smart about reinvestment. The father-son team that run the business, they really don't want to make investments if they're not getting the money back in dollars in 2 or 3 years. And so their reinvestment hurdles are 25 to 35% IRRs. And they're very creative. They've entered a number of businesses in the past, which they weren't in. They start small, get competence. And so they've, moved into a number of different businesses, and they've gotten scale in those businesses. I didn't even value all those other businesses because those were harder to value. All the numbers I gave you is just for their one real estate business. And so if a business is reinvesting at very high rates and, the leadership is relatively young, my take on Reysas was that we're going to let this ride for about 20 years. It might be 10, 20 billion, 30 billion, who knows what it is in 2040 or 43. So just leave it alone. Now, if I look at my funds, in one of my funds, the offshore fund, there are 2 bets in Turkey that collectively made up about half the fund. Not because we put half into it. I mean, one was Reysas, which went up, and the other was TAV Airports, which is another great business. And we've, for the most part, closed the fund to new money coming in. And I told my investors, look, it's very concentrated. We're not going to lighten up because when we look at what we own, they're very cheap and very good assets. And even if it gets to 80% in these 2 stocks, we don't plan to lighten up. So I told them that if they don't like that approach that I'm taking, they can get off the bus and they can redeem and move on. But I'm not going to change my perspective on that. So the way I look at it is that, if you look at the Walton family and the ownership in Walmart, Sam Walton's passed away a very long time ago. And no Waltons are really running that business. There's only one Walton on the board. They don't have control of Walmart. Most of them have kept the stake. And for most of the Waltons, the Walmart stake represents, vast majority of their wealth, probably in many cases, more than 90%. And so you would say that's not diversified, but if you talk to them, they would say it's perfectly fine. They're very comfortable with that. So the way I look at Reysas is we are not the founder or the promoter or the owner of the business. But we can think of it like that. And so, or if we own the Coca-Cola company's bottler in Turkey, we should think of ourselves like a minority owner. And if we were a minority owner of a high quality business like that, we shouldn't even sell it if it gets fully priced. We should not even sell it when it gets overpriced. We should sell it when it's egregiously overpriced. If Walmart went to something like, 100 times normalized trailing earnings, yeah, maybe the family should look at selling. But at 40 times, 30 times, 20 times, it's a good idea not to do anything.
Just because you think the earnings will continue to compound and that multiple will compress over a longer time horizon?
There are very few businesses in the universe of listed companies that would qualify as great businesses. Probably, I would say less than 5% or 3% of listed companies would qualify as great businesses. If you find yourself in the very happy situation of fractional ownership of one of those businesses, hang on for dear life. And this is one of the biggest mistakes I've made over time. Guy owns a stake in Ferrari. Thanks to Manish. Thank you, Manish, for giving Guy the Ferrari stake. And Manish doesn't own Ferrari. And when I made the investment in Fiat Chrysler in 2012, when the market cap was 5 billion and their sales were 140 billion, Fiat Chrysler was trading at less than 4% of revenue. Okay, it was just the equity was, and 80% of Ferrari was inside that 6 billion. And plus there was all the, Jeeps and Ram and Maserati, everything else in there. And at that time, Pabrai funds owned something north of 1% of Ferrari. When I looked through the Ferrari stake. And we made a lot of money on that investment. And one of the dumbest things I did was Ferrari looked optically expensive to me. And I sold, and we would probably have 3 times that amount of money if I just kept the position. And so, like Charlie says, old too soon and wise too late. So one of the lessons I've learned the hard way is that, very few businesses have the characteristics a Ferrari has. The higher the price of the product, the greater the demand. They recently released their SUV, which they don't even want to call an SUV. It's going to start at 421,000. You're not going to be able to get one for 421,000. By the time you option it out, it's probably 600,000 or something. And you can't get one at 600,000. They're all sold out. And so if you actually try to buy one from someone who's got one, you're probably going to spend over $1 million on that. I mean, that's an incredible business.
Yeah,
80% margins.
I was a little annoyed by the SUV, but I know they had to do it. So putting aside Ferrari for a second, so do you still own a third of Resos? Is that roughly kind of your stake at this point?
I hope I go to my grave with it.
Yeah. Do you feel like as a large shareholder or minority shareholder that you have some say in terms of how again, getting back to corporate governance, I mean, do they see you as sort of an equal or close to equal?
Yeah, I have a good relationship with the founders, and in fact, last year they came to Omaha for the Berkshire meeting. The son did, which was excellent. I thought that might help them in their journey to understand Berkshire more. And Buffett says that if they need my help, we're both in trouble. Basically, I think that if I'm a lazy guy, Divya. I really don't want to serve on boards. I don't want to be telling companies. I mean, the management team at Resos can run circles around running that business better than I ever could. And I don't think I could come up with any strategy that would be superior to what they are doing.
Yeah.
And basically, I think that business works because of the incentives the team has. And so I am happy to be a cheerleader on the sidelines. And I don't have any desire. I haven't seen them do anything dumb in 15 years.
Wow.
I just see one smart thing after another. And these
What
are
was the
much smarter than I would have done if I was running it.
Yeah. Who was the broker that you used to build the position in the first place?
So Turkey is difficult to access. You can access it if you have a prime broker relationship. We use UBS, but I think any of the major prime brokers would be able to get you access to Turkey. For retail investors in the US, there is only one way that I'm aware of to invest in Turkey, which is through Fidelity. And so if you open an account at Fidelity or an IRA or whatever, and you can't really trade it on their platform, but you can call their international desk and kind of place trades on the phone with them. And they have its higher fees. I think it's $80 or $90 per trade, and there's like a FX conversion fee and all of that. So there's some frictional cost, but it's still okay.
And speaking of FX, I think you mentioned this to me. You mentioned this to me via email, but the lira obviously has had a tough time over the last year or so. You don't, as far as I understand it, you're not hedging FX at all, right? You just
no. I think Resas has gone from the 16 million to the 250 odd million in dollars over the last 3.5 years. I don't even know how much it's gone up in lira, probably 4 times that. And and the lira was 5 lira to the dollar when I invested. It's now approaching 19 lira to the dollar. So we lost 75% of value in the lira. It was not relevant to me because I knew that the asset was automatically inflation indexed, because a warehouse is steel, iron, concrete, cement, land. All of these things are going to move with inflation. And so basically their rents are inflation index as well. And some of their leases are in dollars or euros. So basically there was really no reason. And these are the only investments I'm interested in Turkey. So even when I look at the Coke bottler, they have the ability to raise prices, to keep lockstep with inflation. So I don't expect inflation to have a big detrimental impact on their business.
What was the other?
There's no need to hedge the lira if you are invested in a sliver of the companies in Turkey that are unaffected by inflation.
Right. What was the other Turkish name that you're bullish on?
It's TAV Airports, TAV, and TAV is another wonderful business. They have 15 different airports in 8 countries. And the airport business is a fascinating business. It's a complicated business actually, because it's like 10 businesses in one. But these are very favorable economics if you don't overpay for the right to run the airport. So typically with airports, what happens is it's a BOT model, build, operate, transfer. So you will get a 25, 30, 50-year concession with some airport where you say, okay, I'll build a new terminal, I'll do the XYZ, I'll give the government $500 million, and against that, I get the right to run the airport for 30 years or 50 years. And there are portions of the revenue that are regulated, like the passenger fees and all of that. And there are portions of the revenue that are not regulated, like duty-free and food and beverage and that sort of thing. So when you blend it all together and you look at the economics, especially if you don't overpay for these things, it's a monopoly asset. It's a cash cow. It's just, and in the case of TAV, they have a very unusual situation. They acquired one airport during the middle of the pandemic when air traffic was close to zero in Almaty in Kazakhstan. Almaty is the largest city in Kazakhstan. And that was an outright purchase. It is the only airport I'm aware of in the world, major airport, that's privately owned forever. So this wasn't a 30-year, 50-year concession. It's a permanent concession. They own it permanently. And that's a very unusual situation. And that deal, which got done when there was no traffic, there was $400 million for the airport and another $250 million for the capex. They're building a new terminal. Just that airport alone in 2026 or something is going to be cash flowing north of $200 million a year. It's going to be increasing that cash flow close to 5 or 7% a year from there on, almost to perpetuity. And it has no competition. And Kazakhstan is landlocked. It's actually got a very high per capita income. I mean, basically, it's an asset that was purchased for 3 times cash flow. And airports like that should trade at 30, 40 times cash flow.
Really interesting.
And something like that would not be available at those type of prices on the New York Stock Exchange.
Yeah. So this is another airport or asset that you could see yourself owning for 20 years?
Again, extremely high quality management team. You know, like I said, I mean, I looked at the business. I thought it was an exceptional business. The risk you run with airports is animal spirits. So when some new airport comes up for bid, if it gets compared and people are not willing to lose it and they overpay, then it's not going to work well. So that's always the risk with, I think that's the biggest risk with TAV, is there will be only about 4 or 5% of the airports in the world are private. And privately run airports run a lot better. You know, LaGuardia now is a private airport. And you look at LaGuardia 5 years ago, you look at LaGuardia today, and you can't even compare the two. And that would not happen under government ownership.
Mm-hmm. So moving beyond Turkey for a second, you've been in the news a little bit about recently about your investment in Brookfield. Is that something you can speak to a little bit?
Well, I mean, we have an investment. I don't think we have anywhere near the upsides we have in places like Turkey, a company like Brookfield.
Yeah.
It's a very high quality business. It's a very high quality team. They actually give you, you know, kind of 5-year outlook on what they expect their business to look like in 4 or 5 years. And they've been doing it for a while, and they were actually exceeding what they set at their targets in the past. So if the management team is to be believed, and if we buy into their targets, it'll be a great investment. And it's a, you know, Brookfield is a very strong recurring revenue business. It's got multiple facets to the business. One side is asset management, where they have, you know, other people's money that they're putting out to work and, you know, getting fees and such. They also have their own balance sheet where they co-invest and so on. And they've got, you know, minority stakes in other companies they've listed in the past and so on. And, you know, they've just got the quality of the assets that they own across different industries is truly exceptional. I mean, they've gone after the very best real estate properties. They've got great hydro plants and, you know, railroads and a number of different interests. You know, recently they did a deal with Intel to partially own foundry that they're going to set up together. And they've also now entered the music business, you know, the music licensing business and such. So I think it's a very good team. I've always liked Bruce Flatt a lot. And so, yeah, we have a stake, and we think they'll do fine.
Why Brookfield over, say, a Blackstone?
Yeah, so I think you could probably buy a basket of these and do well. I think if you bought Brookfield, Blackstone, KKR, Apollo, all of them, if you just put them all in a basket and bought them, they would all do well. I think Brookfield may do better than the rest, mainly because of the DNA differential between them. So if you look at KKR or a Blackstone, you know, they come from a private equity world. You know, if you go back to the history of the original kind of funds and deals and whatever, you know, it was a, you know, classic, you know, LBO private equity type starting point. Brookfield's starting point actually goes back a long way, several decades. And they really were not a a manager of other people's money. They were really investing their own money. And when Bruce Flatt came on the scene and became CEO maybe more than 2 decades ago, he got rid of all the businesses which he didn't think were that high quality. They were in a bunch of mining and different things. He got rid of those businesses, and he focused on extremely high quality, long-lived infrastructure assets. And the private equity world, generally speaking, because it's so competitive, has not recently and even historically has had very high filters on the quality of the business. They always felt that they could buy a mediocre business, do some financial engineering and still make a good return. Brookfield didn't take that approach. Their approach was that at the core, they want to have a great asset. And then later they want to look at what, how they can finance and do other things with it to make it great. So I think the KKRs and Blackstones of the world have moved towards Brookfield in the way they think about it. But I think that when I look at just, long-term DNA of how these companies think, I just think that Brookfield just from day one had the right DNA.
Was there anything about sort of the valuation of it that appealed to you? I mean, how do you just kind of think about it from a pure valuation standpoint?
Well, I think it's not optically cheap. None of these guys are optically cheap. They're not expensive either. But I think if you look forward, so if you're a sovereign wealth fund, let's say you're like the Qatar Investment Authority, Abu Dhabi Sovereign Wealth Fund, and so on, you have very large amounts of money to put to work. And there are very few entities or places that you can put this capital with, which are very high quality places, very high quality teams, and they can be there with them for a very long time. So it's an oligopoly type business where there are like 3-4 players that all these guys have to come to. At the end of the day, when they want to invest, they have to come to one of these 3 or 4 toll bridges to make the investment. And so the assets under management they have is going to grow a lot. The carried interest is going to grow a lot. The fees are going to grow a lot. And they are creative about entering new areas like music or, semiconductor foundries and so on. So it's fine. And
has the work from home trend affected them at all? Or I think
clearly, trophy, I would say office properties in general across the world are facing much higher vacancy rates than they did before because of this trend. And so obviously the demand has gone down because Brookfield sits at the very top end. So they've always wanted to invest in tier 1 cities in the very best properties, the kind of the trophy properties in these, like Brookfield Place or Canary Wharf and so on. And so these would be the last ones affected, and so their rents will go down, but the ones at the periphery will just have high vacancy, whereas the trophy properties will just have lower rents. And so, yeah, I think they've got they have some challenges with their properties, but also, these are long leases, so it takes a while. So even if a tower is, got a lot of vacancy, Brookfield may still be collecting rent on it. And like, for example, Meta has a big, the largest, the tallest building in Austin now. They signed a very long lease for that, and it's still not going to be ready for, I think, a year or 2. And they've already, put it all up for sublease. So they're on the hook for that rent. But whoever the landlord is not affected by Meta's decision that they don't need that space.
Yeah, they take like a $2 billion charge last quarter just on office consolidations.
Yeah.
So no, we actually have a guy who's going to be speaking about alts later in the session. to talk about Apollo, but some of these other names as well. So it'll be interesting to get his thoughts on some of the stuff you said. One kind of question, somewhat related to Turkey. What are the other countries where you're seeing just, huge discrepancies between fundamental asset quality and price? I know I feel like I've heard you mention South Korea before, but what are the other countries that screen well for you in terms of just, places where, things are not as picked over?
Well, I find the whole world is very heavily picked over, so it's difficult to find. I think that I haven't found any market with the characteristics that Turkey has. I think that's a very unusual situation. Who knows how long that'll last? Korea is always cheap. And I think one of the big challenges we have with Korea is that their birth rates are now well below even China. And so, we need couples to have 2.1 kids to keep population at break even. Korea is actually alarming. It's down to 0.7 or 0.8. Japan is at 1.4 and they have a declining population. So the Korean population decline, quite frankly, is alarming. It's going to, and that's a very strong headwind in investing in any country if you're going to see negative population growth. And China also is facing that, and it's a serious issue even in China. But Korea, out of all of them, between China, Korea, and Japan, Korea has the most extreme problems with the birth rate, and they're trying to press a bunch of levers. It's not working very well. In Japan, there's been an attitude change towards immigration. They're trying to bring in more people, and I think all three of the countries, in the long run, this is one of the huge advantages of the United States. The United States is the only developed nation which has population growth. No other developed nation has that dynamic. And we've had that dynamic for a very long time. And we still have population growth going on today. And I wish Congress would get its act together and fix immigration and so on, and continue to get the best of the world coming into the US. But so I think for a lot of the China, Japan, Korea, especially Korea, that's a big headwind.
So speaking of China, the last time we chatted, you were bullish on Alibaba. I don't know if you at the time had a position in it or not, but I think you may have.
I switched the Baba position to Prosus, which is basically a 10-cent bet. I had studied Baba, and then after that I studied Prosus. I actually studied Tencent, and I just found there was a big difference in business quality and leadership. And so we had a loss in Baba. And so instead of taking the tax loss and buying it back, etc., I took the loss and just switched it over.
And you've kept your position?
Yeah, for the most part. Yeah, we kept the Prosus position.
Have you noticed just on Baba, any sort of change in approach, just given kind of all of the stuff that's gone on in China over the last year?
Well, I think a number of things with Baba would, in my opinion, for me, would fall into the too hard pile. So it's very hard to handicap, what the CCP does with them. So I think Tencent is a little bit different in the sense that they've always been they've been very cooperative with the government. They've had very great relationships with the government. And I think Baba, for the most part, from what I can tell, has fixed a lot of those issues. But I don't believe their relationships with the government is as good even today.
Yeah. The other thing that's interesting is India. So have you looked at, Guy's invested in India Energy Exchange, Care Ratings, and he was talking about because I asked him about corporate governance, and what he mentioned was that it's highly regulated, and so are its counterparties. I know in the past you've said India's been difficult for you to invest in. And I'm just curious if you have any new thoughts on.
Well, we have an investment in an Indian Energy Exchange, and I think we own like 1 or 1.5% of the company. And I think it's one of the highest quality businesses I've seen anywhere in the world. Extremely good management team, very creative, and extremely good execution. And even when I bought it, I mean, one of the things, the sad thing, like Ferrari, is that before the pandemic, I owned 4.99% of Indian Energy Exchange, which is the maximum the government allows foreign investors to own. And I paid up significantly, 30, 40 times earnings for that stake because the business quality was so high. And so today, for example, about 8% of all the power that is consumed in India is going through IEX. And approximately 1% of the value of that power is their fees, their revenue. And about 70, 80% of that is just drops the bottom line. So that 8% of power that's going through is probably going to end up somewhere between 15 and 30%, 15 and 25 and 30% of the entire country. And India's per capita power consumption today is really low. There's the movement towards EVs and all of that. So I think power usage will go up a lot in India. It will go up. So Indian GDP is expected to grow up like 6, 7% a year. Power might grow up 8, 9% a year over a relatively long period of time. And with that type of growth, with a complete monopoly position where they are at 8% of the pie today, and it becomes 25% or something in 5 or 10 years, that's an exceptional business. They started a second business, the Indian Gas Exchange, which really shocked me in terms of their traction. So they just started the gas exchange about 2 years ago, 2.5 years ago. And now they're hitting some months where 5% of all the natural gas consumed in India is running through the gas exchange servers. And already, even though that business doesn't have the scale of the power exchange, something like 2/3 of the revenue is net income, pre-tax.
Wow.
And that 2/3 will probably go to 80%. And Guy, when Guy talks to them, I think Guy and I visited them last year. Was it last year? I think that's when we visited. So Guy's telling them, is there a way you can hide the profits? Is there a way you can not show the profits on your income statement because your regulator can see them, and you can see what kind of amazing mousetrap you're running. And of course, they're not going to do anything of the sort. It's a very high quality team. And but that's Guy's biggest worry, is that all the economics are visible. But the thing is, I think that the regulators really love IEX and IGX, and they really look at it as a national asset. And I think that part of the reason they do so well and they put so much to the bottom line is just how well the business is run. And I think the regulators understand that under different leadership and ownership, they would not have those numbers. And so it's just a really good business. And I am looking at it again to see if we should increase our stake. I think the gas exchange, they are being forced to divest their position down to 25% in a couple of years, 2-3 years. And so they'll do an IPO of that. And the market cap of that in a few years is probably going to match or exceed what they have for the whole business.
Have you been following this fiasco with the Adani Group?
Oh yeah, sure. Yeah. Indian mutual funds, by and large, other than the index funds, don't own Adani, don't own any of the Adani companies, even though it's a very large portion of the market. I don't know any investors, value investors, any investors I interact with in India who've ever had any stake in Adani. So, I think.
Is that because of his reputation, or just or valuation, or some other
reason?
Well,
I mean, I think that it's clearly optically and otherwise it's very expensive. It's always been expensive. And so it's difficult to justify those numbers. And so even the Hindenburg report, they start off, the first thing they say is valuation,
Yeah.
And they bring up a bunch of other things. Now, I have no idea, how real or not real those other aspects are. It is true that the quality of the businesses and the quality of the assets they own is exceptional. They own most of the private airports in India, ports, and a lot of the petrochemical infrastructure, pipelines, transmission lines, and so on. These are really very high quality assets. But the questions are swirling around the rest of it. And so I don't need to have an opinion on 98% of what goes on. I only need to have an opinion on stuff that we were actually going to invest in. So it's really irrelevant from my point of view. We'll buy some popcorn and watch the movie.
Yeah. As far as just following up on kind of our previous discussion, you've always been a big fan of Jeff Bezos and Andy Jassy and all of that. Have your thoughts on Amazon changed at all over the last year?
I mean, I think it's probably the most exceptional business ever created in the history of mankind. It's an amazing what they have put together and so I think the DNA of Amazon is just an incredible DNA. And under Jassy, I've always not liked their retail business where they take ownership of the products. That business, I've always hated retail and stuff. And he seems to think like that too. He's not a big fan of that business. And I think it's easy to not be a big fan because when you look at the numbers, they're not look that great. But other aspects of the business where they're doing fulfillment and advertising and all of that, those are great. And so I think Amazon, I mean, to think about a business which was a consumer commerce business, to have this massive footprint in enterprise core web infrastructure, that's a big leap. Okay. And they made that leap and they, ran circles around everyone else. Amazon is the kind of company where you don't even know what businesses they'll spawn and be in 10 years. And that spawning engine is very much alive and kicking. So I think under Jassy, he's going to de-emphasize the businesses that, have lower returns on equity and all of that. And I've even now seen they're looking at buybacks and things where they're actually starting to generate more cash than they need. So incredible business. And like I said, I've always been too dumb to buy it, and I'll probably be too dumb to buy it forever. We'll see.
Well, so I was going to ask. I mean, the stock's obviously struggled for the last 2 years, and it's not at its lows over that period, but it's certainly got a long way to go before it gets back to its highs. I mean, do you have a price point in mind where you would potentially take a position?
One of the mental blocks I have, which probably hurts me more than it helps me, is the law of large numbers. So when I look at businesses, 500 billion, trillion, 2 trillion market caps, which are the highest they've ever been for any business in the history of mankind. And then when I look at, how many businesses, large businesses like that survive for 100 years, 50 years, and that sort of thing, the death rate is really high.
Right.
And these companies, if you look at a business like Apple, I don't think I can see anything on the radar that's going to affect Apple for 10 years. I think it's just a great franchise. It'll keep going. I don't know if I can make that statement for 20 years or 30 years or 40 years. I can make it for 10 years. But when you're trying to buy Apple at the 2 trillion, whatever it's at, you need to have a view 15, 20 years out. You need to have some view on that. I mean, I know that Ferrari will be cranking 15, 20 years from now. I know Hermes will be cranking 20 years from now, 40 years from now, 80 years from now. I was having a discussing with Charlie a few months back where I told him that, if I look out 100 years or 200 years, I think the railroad in Berkshire will be intact and doing great. Even if we get to maglev or some new technology, the right of way and the need for humans to move goods, that's probably the most efficient way to move goods. So that moat is almost a indestructible moat. And I said most other things I see in Berkshire, I can't make a comment that 100 or 200 years from now they'll still be there. And Charlie corrected me. He said, well, our power business is pretty good too. And he's right. Yeah, the utilities and power business that they have is another amazing business. And again, that's unlikely to change, in terms of how we get our electricity and power and all of that. And so, but insurance, Apple, a whole bunch of other businesses, Seas Candy and others that Berkshire is in, hard to make a statement that they'll be around 100 years from now. They will maybe, but I don't know. And so when you get to these very large market caps, this is the issue that bothers me, is that, you look at something like LVMH, huge market cap. I would say someone like LVMH has a much stronger chance of being with us 50 years from now than Amazon does. Even though Amazon looks just totally dominant today. So my take is that when I get to some of these really large market caps is really, and Tencent was an exception for us, is to really go back to trying to find the next compounders at smaller market caps that can get, long runways and get there. So that's kind of where I end up.
You'd put Microsoft in the same bucket as Apple?
No, I think Microsoft, between the two businesses, I'd be more interested in Microsoft than Apple. And one of the reasons is that, so if you think about the iPhone, it's actually a very kludgy device. And this is kind of where Mark Zuckerberg is going to. So the iPhone, most of us don't really particularly care about the phone part of the iPhone. That's really irrelevant. It's really a computer we carry around, right? And if I'm using it, to map where I'm walking to or where I'm going to, it's kind of a kludgy thing to have this thing in my hand or whatever, or have directions being fed to me in my ears or whatever. So I would say that the human factors in the long run of how we interface with technology, which is, we get to your favorite subject, the metaverse, is, I mean, there is a unpredictable direction that we will be heading to at some point. Okay. And when we head in that direction, it is a big unknown where Apple fits in. Okay. It may well fit in and it may not fit in. We don't know. I know at some point, this technology of all this stuff, a lot of it goes into the cloud, some of it is with us, and some of it becomes wearable or whatever else. Where that whole thing sorts out is unknown. And that's why I say we don't know 20 years from now. Microsoft's business is a lot more enterprise driven. And so to me, that has more resilience than a purely consumer driven business that Apple has. And Apple has a lot of goodwill amongst the consuming public, a lot of trust, great brand, but it doesn't have the same kind of nuance with, all those companies in the App Store giving them the 30% and all of that. So there's animosity with that group. And Amazon, for example, doesn't have that animosity. All the enterprises that work with Amazon don't have a negative view on the company. A lot of the App Store developers believe that the 30% is too high. And they think for what they add was what Apple adds So that part of the business is not a win-win in my opinion. I think their take rate is too high. And on the consumer side, they do a great job. So Apple's a great business. I think 10 years, like I said, I don't see anything, might be doing well in 20 years, but I wouldn't want to make that bet.
Manish, before we close, you'll find this interesting. My wife is going to be talking about inflation. She's the head U.S. inflation strategist at JP Morgan. And I was going to ask you, we live in a world right now where there's just enormous geopolitical risk, and macro has just absolutely dominated the markets over the last, really for the last year. I mean, all of 2022, I feel like was a write-off thanks to the Fed. For all of us who are not invested in Turkey. So I was curious, do you have any views on where inflation is heading, how quickly it might be contained? I don't know if you have thoughts on wages, which is a big sort of part of the problem in terms of, just being stickier than other parts of inflation. I'm just curious if you had any macro thoughts for us on and if any of it keeps you up at night.
Yeah, probably not my strong suit, but I would just say that we've got a great central bank, an independent central bank. They may not always get everything correct. They may undershoot, overshoot, all of that. That's part of the deal. But I think they will look at the data, and for the most part, they'll act prudently. So I think over time, we'll get to where we need to get to. And I don't know if that happens in 1 year or 2 years or how long that takes, but the U.S. economy, surprisingly, with all the amount of money that's been pumped into the economy, the inflation is still pretty benign relative to all that. The unemployment rate is unbelievable. It's the economy is cranking really well, and it's still firing on all cylinders. It's a great engine. I wouldn't have predicted all of these things given, where we are coming from, but here we are and we're doing great.
You don't foresee any sort of recession coming anytime soon, it sounds like.
I would probably be a really bad person to make those types of calls. I never saw 2008 coming either. I did see the bubble in 2000 before that happened. So I was able to sidestep that one, but I took the full brunt of 08, 09. So yeah, I'm not a good guy on that front. I don't know where things end up on that front, and I'm trying to make bets where those types of events don't have that much impact. I mean, I think that's why I have an interest in things like IEX, and I have an interest in things like RASAS and TAV, and the Coke bottler and so on. So I think those are more interesting to me because I don't have to think about these things too much.
I think it's a fair point. Manish, this was great. Super interesting as always to hear your thoughts on the world and obviously your portfolio. We'll certainly follow up regarding the Turkey donations. But thanks again for your time, and looking forward to chatting again soon.
Likewise, it's always fun, Divya and Guy. Thanks for attending.
Awesome.
All right.
And Manish, by the way, feel free. You can stay on. This is going on till 4 p.m. Eastern time. So if there are any segments you want to listen to, feel free to join in.
Sounds great. Thank you,
Manish. That was great.
Welcome to SumZero. I'll just give a quick background. So for everyone listening, Phoebe White is the head U.S. inflation strategist at JP Morgan. She has been at JP Morgan for, I want to say, like 8 years, but she also spent some time at the Fed, or the Federal Reserve Bank in New York. And so she's been kind of in the policy sphere for most of her professional career. She was summa cum laude in economics from Princeton, where she also was on the varsity crew team, and has been covering inflation and tips for a number of years at JP Morgan. So Phoebe, welcome to SumZero. I just want to set the backdrop. Over the last year, obviously inflation has dominated headlines, and has started to come down, both in terms of headline CPI and also core CPI. But we every time Powell talks, it's always he's very much, he always acknowledges the fact that there is sort of stickiness to inflation. And anyway, if you can maybe just give us, kind of your thoughts on what the inflation outlook is, what are the different components of CPI that, I think folks should be focusing on, what the impact might be to equity markets. I'll give the floor to you, but just wanted to set the backdrop a little bit.
Great, thanks for that. So yeah, I mean, I think the term that's now being tossed around markets is disinflation, and I think that's the new narrative. I mean, it's pretty clear we've passed the peak on inflation. Headline inflation is, well off its peak, above 9%. Now sitting around 6.5 in headline terms. Core PCE, the Fed's preferred measure, is still around 4.4%. So it's still elevated, and I think the question now is really just how quickly does inflation come down? How far does it fall? Are we going to see this kind of straight line down to the 2% target? And even though I think the possibility of outcomes from here has certainly sort of narrowed the distribution, I think there's still plenty of uncertainty, and I think you can see that in the way that markets are priced. The Fed, as of their latest projections in December, had penciled in a PCE inflation forecast of 3.1% this year. Markets are pricing in around 2.3% in PCE terms. And actually, I'm just going to share my screen. I have a few slides here that we can go through, which maybe will sort of help demonstrate this. Here we go. Here we go. So hopefully you can all see this screen. And so you can see this divergence. So again, looking out to the end of 2023, that gap was more than 100 basis points last week. We've seen a repricing after the payrolls data last week, but still nonetheless quite a bit of a divergence here. So I thought it would be...
Phoebe, it's a little hard to see this. Can you just explain what folks are looking at?
Sure. So this black line here is CPI, blue line is PCE. The Fed only provides PCE inflation projections. The inflation market is based on CPI. So we've just tried to translate that to PCE terms. And you can still see for 2023, there's quite a bit of a gap between what, the market is projecting and what the Fed is projecting. And when we think about, why this is relevant, the inversion in the yield curve, right? The markets are pricing in quite a bit of cuts starting later this year into next year. I think there is sort of this degree of complacency that, disinflation will continue. We're going to get right back down to 2%. The Fed can start cutting again. This came up in Powell's press conference last week, where he really didn't push back against the cuts that are being priced into rates markets, instead kind of chalking up the divergence versus their own forecasts to differences in inflation expectations. And at the same time, I think he didn't really kind of justify why he sees inflation staying higher. I thought it would be maybe useful to kind of dig into the components of inflation to sort of highlight some of the dynamics that could make it challenging for inflation to continue falling. To all the way back down to 2%. So this next slide here is, I know it's a lot of numbers, but it's the PCE, core PCE basket broken out into all of its components. And I guess the three components I just kind of want to talk through. This is really the way the Fed's been talking about it and the way they're thinking about the inflation process. The first component being goods prices, and then within services, looking at housing prices, and then core service prices ex housing. So on the goods side, we're seeing prices falling. We've seen easing in supply chain constraints, falling commodity costs, things like that. And that is providing a really important disinflationary force right now. But, just as we saw kind of the surge in goods prices being sort of this transitory development, we also don't think goods prices are going to fall forever. and eventually they'll reach more normal levels and kind of stop falling. And that is a reason why we could actually see core inflation ticking up later this year. And that's also something that Powell alluded to in the press conference. Within goods, I don't need to get into all these details, but there's been a lot of attention on vehicle prices. That has certainly been the most volatile component throughout the last couple of years. We saw used car prices surging through the beginning part of last year. We have in recent months been seeing used car prices falling pretty considerably. On a 3-month annualized basis, used car prices are down 28%. And it has been our expectation, and I think most of the market's expectations, that car prices will continue to fall. There's been some kind of questions around this, given if you look at kind of leading indicators on sort of the industry data side, things like the Manheim Used Vehicle Index, that's actually ticked up in the last couple of months. So there's some questions around whether maybe demand for cars is staying pretty well supported here, and at the same time, car inventories are still sitting at very low levels. So, we think that we'll see inventories rising throughout the year, but this is going to be gradual. And, for now, we could actually see that decline in used car prices maybe slowing. So that's just something to keep in mind. But broadly, on the good side, I would just point out that's, this transitory disinflationary force that will disappear later this year. Meanwhile, on the services side, that's typically what we think of as more tied to labor markets and a little bit stickier. On the housing front, I'll touch on that first. That's, again, close to 20% of the PCE basket. It's much more significant part of the CPI basket. That is a component where we've seen inflation continue to accelerate. So we really haven't seen slowing. In fact, it's been an acceleration. Rent inflation in both of these indexes is running close to 8% over a year ago. But, I think there's been better acknowledgement on the part of the Fed that this is a really lagging indicator. When you look at rent inflation and CPI or PCE, rental leases are renegotiated usually only once a year. This is kind of slow to pick up changes in, the actual rental market. So instead, the Fed has been paying attention to, more timely data, measures of what's happening on new leases. What's the rate of change in rent on new leases? So I'm on this next slide on the left, you can see the Zillow rent index is one measure of that. We've seen rent inflation by that measure fall from a peak above 17% down below 8% on a year ago basis. So, certainly we are seeing signs of slowing there, and that's a reason why the Fed has been able to kind of ignore rent inflation and expect that rent inflation will come down later this year also. So, that's our projection. We're using data like the Zillow index to kind of help inform where the official rent measures go. But, what I'd highlight is we also don't think that rent inflation, either in the industry data or by the official measures, is going to come down back to pre-pandemic levels, even by the end of this year. I think there's kind of technical factors really supporting rents here. The fact that rental vacancy rates are still near multi-decade lows. Demand for rental units is still very high, just partially driven by the fact that purchase affordability right now is so stretched, and that's supporting kind of this relative demand for rental units. So our expectation is that we'll see kind of the pace of rent inflation turning in these official measures, but that it will stay elevated through this year at the least, and probably into next year. So those are the first two big components. Again, components that so far the Fed has sort of been disregarding because of, on the good side, the transitory nature, but on the housing side, some positive signals coming from the industry data. The third component, and I'll just actually flip back to this big table, the third component would be services excluding housing. And this is the component that the Fed is most focused on because it's seen as the most persistent, the most tied to labor markets, and the best kind of gauge of underlying inflation. Now, this component really hasn't shown softening at all in recent months. It has in the CPI measure, but again, this is a component that actually tends to diverge between CPI and PCE. And so in the Fed's preferred inflation measure of PCE, we've seen core services X housing still running around 4% on a 3-month annualized basis. So, we would agree with the Fed that this is a category that's likely to be tied to the labor markets. So where does this go from here? I mean, there have been some sort of positive signs in the labor market. We have seen wage inflation coming down from its peak, and that's what I'm showing here on the next slide. On the left-hand side, you can see it in a slowing pace of wage inflation in average hourly earnings, the employment cost index, the Atlanta Fed wage tracker. So these are a few, key measures of wage inflation, and we have seen that softening. And I think that has also contributed to some complacency among markets, saying, we're seeing wage inflation come down even without the unemployment rate moving higher. In fact, the unemployment rate has only ticked lower. So, what's going on here? I think what we would point to is that even with the unemployment rate ticking somewhat lower, we have seen evidence of cooling labor demand in recent months. The fact that the pace of payroll growth has, through December at least, was slowing. We saw job openings as measured by JOLTS coming down, sentiment measures. If you look at the Conference Board's labor market differential, that's jobs plentiful versus hard to get, that had moved down. So, a bunch of different signs that labor demand was cooling and really softening. One other thing I would point out, even in the employment report, we look at, the average work week, demand for temp hires. That also had ticked lower as of the December report. So, lots of kind of signs to look at to see that labor demand was coming down. But I think the concerning thing to us is that all of those measures actually moved in the wrong direction as of the latest reports. So this chart on the right here, I'm just plotting job openings versus hires, which we think is a really good metric of tightness in the labor market. Again, that had shown signs of moving down, but it ticked back up really to its highs as of the latest report. So, then we got, last week's payrolls report, a really blowout number. It's really showing that there's still, significant labor demand. There's still tightness in the labor market. And I think because of that, it could be hard to see wage inflation continuing to come down. Because of that, the Fed is going to have to continue sort of leaning against labor demand and continuing to hike rates. So, our forecast now for the Fed is that they will hike to 5.25, another 225 basis point moves. That is in line with what the rates market is pricing in right now. But, as Manish said, the Fed is going to stay data dependent here. And I think for them to feel comfortable pausing, they're going to have to see the pace of job growth slowing probably below 100,000 per month. And that's what they're going to need to see, even if core inflation is coming down, because they are, again, trying to disregard some of these transitory signals beneath the surface. So,
can you just quickly explain that January report? So for those who maybe aren't familiar with the exact number, it was like 517,000 jobs were added in January, which was what was that, like 2.5 times December numbers? So where did that come from? Like, how is that even possible?
Yeah. I mean, no one was expecting it. So when we look kind of into the details, what we read from this is that 517,000 gain was a seasonally adjusted number. If you look at the non-seasonally adjusted change in payrolls for January, it was actually negative. Basically, January has been a contraction month for employment in every year. And what this shows is that basically January of this year was the smallest contraction we've seen for a January going back to the 1990s. So how do you read that? I think it's, again, the story of labor hoarding. It's the fact that, with kind of shortage of labor, that companies are more reluctant to lay people off, thinking that it could be harder to rehire again. Why do we have this shortage? If you look at the participation rate, especially for prime age workers, that participation rate has actually gone back up to pre-pandemic levels. I think that's not the issue. It's more that there's been a lack of immigration over the last number of years. We've seen a ton of early retirement throughout the pandemic, and those workers are not coming back. So, if there's a supply issue, it's just, the Fed has to lean against demand here.
Have you heard any reports about the weather being one of the reasons that those numbers were higher than usual? Maybe related to travel
yeah, weather around this time of year can always add some noise, and it's a little bit difficult to extract signal when you're dealing with those weather effects. I think that's something that we've been thinking about in terms of the degree of cooling, not only in the labor market, but in growth overall into late last year. We've been discounting that somewhat, given it could have been due to weather. So maybe kind of the reversal from the December number could partially be reflecting weather effects. But, essentially, we're seeing the strength in January, not only in the jobs report, but in other, signs of consumer spending and momentum, and even the survey data, everything sort of looking stronger here as we start the year.
So to kind of tie it back to equity markets a little bit, is your view that equity markets are, maybe overly optimistic about what the Fed is going to do, or I'm just curious, like,
well, so why don't I tell you what I think the implications are for the rates market, and then you can extract what it means for equities, perhaps. But I think, again, I think there was some complacency in the rates market, that we were at the end of the tightening cycle. That kind of gave fixed income investors the green light to sort of put on these end of cycle trades, and pile into fixed income. And I think what we've learned is that the Fed is not done. They do have more work to do. And, if we are seeing resilience in the labor market, that it means that they probably, once they're done tightening, will sort of stay on hold for a while. So I think that means rates markets probably have more room to back up higher. Would that be a negative for equities? Maybe not, if the Fed is being much more gradual and data dependent here. I think we're not in that world that we saw last fall, when they were guiding markets to much larger hikes, going severely restrictive, and there was a lot of uncertainty around the pace and the end game. So maybe they hike to 525, maybe they hike to 575, but if they are moving slowly here, I think there's just going to be less volatility, and hopefully, that means that equity markets won't see as much volatility either.
And then on the yield curve, like, what are your favorite and least favorite parts of the curve right now?
So I don't know if there are sort of rates investors on the call. I think the way we've been positioning, we think that sort of positioning for like a long end 10s 30s curve steepener makes sense, because that is the part of the curve that tends to steepen first as you approach the end of the hiking cycle. I think 2s 10s could see more inversion here, just depending on how far the Fed has to go. So we're more cautious on, taking a stance on steepening further in. But I think, medium term 2s, 10s, 30s probably first and foremost has room to steepen. And then, it's kind of an outside in kind of curve steepening that tends to happen as you approach the end of the cycle.
That's great. Thanks, Phoebe. That was super helpful. I don't know if we have any other questions, but I think that covers most of what we wanted to chat about. Anything else you wanted to add, or any final thoughts?
I think it's just, this story that the first phase of disinflation has been the easy part, and it's going to be interesting this year that, as we get closer to 3%, this is potentially the harder part of disinflation. So we'll see what happens.
Awesome. Thanks, Phoebe.
Thanks, everyone. Bye.
So we're going to talk about Chat GPT and AI. It's obviously been in the headlines a lot over the last few weeks. I guess what's happened recently. So Chat GPT, obviously chatbot that was launched last year. It's taken off. I think the last I heard, it had something like 100 million users. And interestingly, Microsoft obviously made its investment in ChatGPT. I think they own 10% of the business. I forget exactly. Google shares and a number of the other advertising names have taken pretty significant hits, and all the AI-based stocks, or at least stocks that have mentioned AI in their marketing materials, have gone up a lot as well. We've seen positive reactions to announcements made by Baidu. They've released something called ErnieBot. Google is launching a tool called Bard. So there's a lot kind of happening in the space, and we thought it'd be helpful to kind of address it. Today we've got, I think, a really knowledgeable person in this space. His name is Jason Rosenfeld. He's a former Millennium analyst and also a data scientist who has a degree in data science from UC Berkeley. Jason is also the co-founder of a company called CrowdScent, which does, among other things, kind of model building and leverages AI kind of for his for a lot of the models that he builds. Full disclosure, SumZero actually has a partnership with CrowdScent to figure out how we can leverage some of this AI technology ourselves. But Jason, welcome to SumZero and the 2023 Top Stocks Investor Summit. If you could just give folks who are listening just a sense of like let's start with ChatGPT, because this is kind of the topic du jour right now. What is it? What's so special about it? And kind of like, why is it sort of struck a chord? I'd love to get your thoughts.
And yeah, thanks for the background. I think that all foots. I brought some props and slides because I know we have a tight window, and otherwise you and I would probably end up talking about crypto somehow. But the first prop here is a machine generated investment write-up that we built like over 2 years ago now. So I guess the point here is this stuff has always been around. It kind of had this moment with ChatGPT, but the core tech behind ChatGPT has been here probably for like 4 or 5 years. So we generated this investment write-up. It's pretty good. It's only gotten better. I think we can keep doing this. You can add in external data. You can have it make up companies. But I guess my takeaways from this is basically that the sell side is dead. At least, some of the equity research that I did. I remember having models where I tried to concatenate text and net income fields to try to pre-write my earnings report so I could go home earlier. This is that times 1,000. So I think a lot of that work is going to be automated here. And then probably the core takeaway is that if you can generate this text, you can understand it. So basically the breakthrough here is we're encoding text and we're learning a representation of it so that we can then do arithmetic on it. We can compare it to other text and we can build other applications that we haven't really been able to think of to this point.
Jason, just sorry to interrupt. What did you feed your model in order for it to generate this write-up on Tesla?
Yeah, so I guess the way all of this stuff works, which is good for the next slide too, you have this upstream model that's trained on basically the entire internet. So it learns basic concepts. Then you can fine tune that model. So we fed it other write-ups. So, we have this relationship with you where we fed it SumZero write-ups, and it learns kind of the structure. It becomes a bit more financially oriented. And just from that, it's able to write some kind of uncanny investment write-ups.
And what is the underlying model that you use here? Is it just is it called GPT, or what's the name of it?
Yeah, in this case, I think it was an early version of GPT-3. And there are a bunch of these. So I guess to this slide's point, there are probably, I don't know, 6 or 7 of these models like GPT-3 that are these base models that encode knowledge about the world and semantics. GPT-3 is one. You have BERT and some others from Google. Stability, AI is working on like open source ones. So there are a number. We used GPT-3 for that.
So I guess one question a lot of people might have is, how is Chat GPT different from the latest version, the latest GPT-3 instance?
Yeah, I mean, ChatGPT, from like a technical standpoint, there is a little bit of a nuance where they've added reinforcement learning, but in some sense that almost doesn't matter. Like the base models here are the same, and what really matters are the applications you can build on them. So GPT-3 is OpenAI's core model, and let's say BERT is Google's core model. Those are almost fungible. Like downstream application developers are gonna try both on their applications and just see which is better.
So like the fact that Google stock has completely tanked on the news of them putting out this advertisement using their bot that didn't quite answer a question accurately is probably an overreaction.
Yeah, it's still early days. Like we really, we need to see what people can fully build with this. ChatGPT and that Google demo are just like very early iterations of apps. Those things, like that error they had, is going to be fixed pretty quickly. Yeah, I don't see an issue with that.
Yeah, I just find it fascinating because Google, I mean, from everything I've learned about them following the company for all these years, has probably invested far more into AI than Microsoft ever did, and has somehow lost its credibility as being kind of AI forward over a very short period of time, which is pretty incredible. But does feel like a completely erroneous conclusion to draw based on what I'm seeing on the news, at least.
Like from the core model perspective, Google is still leading the way, like on the research side, and their core model is just as good as GPT-3. Again, it's like always going to be just how it's implemented downstream to the user. I don't think they've lost anything in that sense.
That's fascinating. Cool. I didn't mean to interrupt. I know you had a couple slides to show.
Yeah, I mean, this is thinking of language models as a secular trend. Like if you want to invest in the space, what is the landscape? And we already talked about most of the companies, but once again, the core takeaway here is like we haven't seen anything yet. It's going to be all about the applications. In some regards, Google, OpenAI are going to build their own, like ChatGPT and Bard are like examples, but I think there are going to be far more. This was a good tweet I saw recently. Like the question is not whether it's ChatGPT versus Bard. It's just, who can multiply matrices at a lower cost.
Yeah. What's a TPU?
A TPU is a tensor processing unit, which is sort of the data structure that underlies all of this stuff. In some sense, GPUs are probably misnamed at this point. There's probably more non-graphic processing done on GPUs now. Yeah.
I mean, is the future going to involve kind of like sort of a paradigm similar to what we have with cloud computing, where there's an oligopoly, maybe it's like AWS, Google Cloud and Microsoft, where they're giving you kind of the raw tools, and then there's just an ecosystem of applications that use those tools to leverage that kind of like processing horsepower, if you will.
Yeah, exactly. At least in the near term. So it takes like tens of thousands of GPUs and a few $1 million to train one of these base models. So there are barriers to entry. If you've been building a data center business over the last 10 years, you're in a pretty good spot. Yeah, there are only a few companies that can even do this in the first place. Moore's law and price compute performance is going to keep going. So at some point, the base models will be democratized, but that will probably take quite a while.
So like I know Meta has been building like very AI specific data centers. It seems like all of their CapEx is going into AI. Is it essentially like whatever excess capacity they have that, where they're not using their service for their own purposes, they could in theory lease out to folks who want to build stuff, on that platform essentially?
Yeah, I don't know how Meta is doing it specifically. That makes sense to me. Like if you have a data center with excess capacity, I think that's how it should always work. I don't know what they're doing exactly.
Yeah, but it sounds like all of the big players are going to be probably integrating this into their own products, but then letting startups and other companies use their infrastructure to build applications that they would want to build for themselves.
Exactly. And there are some startups that do want to build these base models. So they're just developing partnerships with the cloud data centers. So Anthropic, I think, is working with Google Cloud Platform. And so there are going to be some of those as well.
Super interesting. Before we kind of close this, because I know we're going to have Zach Buckley talking pretty soon. Just wanted to say, we at SumZero have done quite a bit of research on this with Jason's help at CrowdScent. And if any of you guys want to learn about how SumZero is leveraging this AI tech to sort of screen for investment ideas, please reach out. I think it's absolutely fascinating. I think one of the most interesting things about the tools is that like we can essentially help folks assess investment ideas across what is a global community, across numerous markets, all industries, market caps, with a level of sort of a rigor that like takes away a lot of the human bias that comes into play in investing. So in terms of trying to figure out, which SumZero ideas are most likely to outperform the markets, I think that's where these tools become super interesting and really helpful. And we've been testing a lot of these tools over the last couple of years now, and so we've actually learned quite a bit about how AI can be helpful in terms of investment screening itself. So if anyone's listening and interested in that sort of world, please feel free to reach out to us. I think with that, Jason, I don't know if you had anything else, but
yeah, I just to add on to that a little bit, to the point that how these models have sort of been able to encode and understand text. We're just doing that with the SumZero write-ups themselves, and I don't think people have fully realized exactly what that looks like until this chat GPT moment that has shown how well we can understand text. But like building these investment decision pipelines from text right to investment decision has been pretty cool. So yeah, we have that up on SumZero strategies. It's been working pretty well, and we'll see how it continues.
Awesome. Thanks, Jason.
So now we're going to move on to the winner of our small cap category. We're going to hear from Zach Buckley of Buckley Capital Partners on his thesis of Exponential Fitness. To give a little background on Zach and the firm, so Buckley Capital is a value and special situations focused long-short equity fund. They employ a fundamental approach that is research intensive and concentrated, generally with about 10 to 15 core positions that are focused primarily in small cap equities. While long biased, the fund does occasionally short companies in situations with highly asymmetric risk reward potential. So with that, we'll pass it over to Zach Buckley.
Thanks so much for the introduction. I'm going to share my screen and get started with the presentation. All right. Okay. Yeah. Thanks. Thanks for having me. Appreciate it. And yeah, appreciate the introduction. Yeah, just jumping sort of right into the firm. I'm the CIO and managing partner. And I'll kind of go over an overview of our firm and fund today, and then I'll jump into Exponential Fitness. So yeah, as a starter, we seek investments that combine high business quality, double-digit earnings growth, and a low valuation in our investments. We're typically looking at small and mid caps with a concentration in North American securities. So we're typically looking at consumer stocks, financials, healthcare, and industrials, which tend to be 4 sectors with structurally lower valuation multiples. And then I think what differentiates us is our data and primary research. So we spend about $400,000 a year on data. We have a full-time data analyst who filters and sorts that data. And then we have significant primary research as well. We do about 1,000 management team calls per year, over 1,000 store calls per year, and we do over 100 expert network calls per year. Combining those two, I think, is really what makes our research process differentiated. Here's our annualized returns since inception. So we've beat our benchmark by about 600 basis points since 2008. And in the last 3 years, using the integration of data and primary research and focusing on our core North American markets, we've managed to outperform our benchmark by over 20% annualized. So we're pretty happy with the last 3 years. In terms of the firm overall and just kind of executive summary, so we typically have 12 to 15 core positions in the portfolio. We're long biased with opportunistic hedging to reduce market exposure. So net exposure since inception has averaged around 82%. Today, the portfolio trades at about 9.5 times earnings with a 17% EPS growth rate, versus the portfolio or versus the S&P is at about 17 times earnings and a 7% EPS growth rate. So we think our portfolio shapes up well relative to the S&P. Our goal is to generate a 15% net annualized return for our partners over the next decade. Certainly, we hope to do better than that, but would be quite happy if we do 15% net. I founded the firm in 2011. I work as an analyst at Baker Street Capital for 1 year. I have over 95% of my net worth in the fund today, so I really don't have any other options. So going into our underwriting process a bit, we make extensive use of alternative data such as credit card panels and web scraping tools. But we're using this data only rarely to trade around quarterly announcements. Instead, we're primarily using it for idea generation. So an inflection in a business might lead us to identify a catalyst in a specific company. So At Home is a good example of that. At Home in April of 2020 was comping negative 40% on a year-over-year basis. If it had continued at that rate, it would have likely gone bankrupt. That inflected to positive 40% on a year-over-year basis by early May. And that inflection was a huge change in the intrinsic value of At Home. We spoke to the former CFO and realized that a 40% comp on a relatively fixed cost base would lead to the best margins in the company's history. And we projected they would do about $2 in EPS when the stock was trading at $2.50. So it was trading at just over 1 times our projection for 2020 earnings. At that point in time, we made it a meaningful position, and it was while it was running, we got an average cost of $4 a share, and it was acquired 14 months later at $37 a share. So it was roughly a 15x from our initial purchase price and about a 9x from our average cost. And so that can highlight where, of course, data is priced in, and there's many people looking at the data. But when you combine it with primary research and do fundamental analysis, you can come up with some really rewarding situations. MTY was a similar circumstance. It was a Canadian restaurant that was down about 75% and fears that they were primarily a mall-based roll-up. The reality was they owned a pizza business. 30% of their system was a pizza business in the United States called Papa Murphy's. 20% was an ice cream business called Cold Stone Creamery. And the combination of those two actually were comping up 20% on a year-over-year basis. So we were able to predict MTY's revenues using credit card data and open table data within 1 to 3%. And so we knew that the business was only down 15 to 20% on a year-over-year basis and would recover and actually do quite well. When the stock was actually down 75, that was up about 200% for us over the next 12 months. So just another very successful investment, combining alternative data and primary research. On the primary research side, I think this has become even more important to our process than data over the last 12 months. We conduct over 100 expert network calls, 1,000 management team calls, and 1,000 store calls per year. We gain access to industry experts using LinkedIn, GLG, GuidePoint, and thesis. From an idea generation standpoint, sector coverage, I've been doing this for 15 years, so I cover and know a ton of companies just from investing for a long period of time. We do proprietary financial screens. I started my career screening my first year as an analyst. Most of what I did was Cap IQ screens, and I still love to do that today. And then there's many mispricing themes for selling. We look at companies exploring strategic alternatives in various activist situations. So there's a ton of different ways to generate ideas, and those are many of the ways that we do it. In terms of our process itself, we have a value-oriented investment process. We typically look at businesses generating a 25% IRR or greater. We then create a detailed unit economic model. We do comp and data reviews, look at how fast a company can grow over time, and then compare our forecast to consensus and look at the expected variance relative to consensus. Typically, we will start selling positions when the IRR is 15% or lower. So we look for about a 10% difference in IRR over a 5-year period between when we enter and when we exit the position. So today I'll be talking about Exponential Fitness. So Exponential Fitness is the leader in the boutique fitness market. They have a rapidly growing footprint, a large recurring revenue base, and a significant total addressable market relative to their size and strong competitive barriers. What we like about Exponential is the growth over the next 5 years is very guaranteed. So they have over a 3-year contractually obligated pipeline of new studio openings, which translate into a high degree of revenue and earnings growth predictability, with over 20% organic growth projected for the next few years. The company's asset-light franchise business model is highly scalable, and this should translate into a significant increase in adjusted EBITDA margins on a trailing 12-month basis to over 40% in the next 3 years. So despite recessionary concerns, the business we think will do quite well. Their average consumer has a household income of about $130,000 relative to a gym membership, which is less than $2,000 a month. We don't think they will lose many consumers if there is a recession. They also do very well with inflation because they're primarily a franchisor. They're getting a percentage of the top line revenue of the gyms. And so therefore they actually benefit as sales go up. We also think management's long-term financial targets are conservative, especially relative to their revenue growth, which I'll get into more detail later. So given the scalable operating expenses, we think EBITDA should grow at a compound annual growth rate of 30% or greater. And given where the comps trade, most franchisor comps typically trade at anywhere between 18 and 25 times EBITDA. The fast growing ones, such as Wingstop, trade even higher. Given all this, we think Exponential should trade at 30 times earnings or greater, which translates into a $75 to $90 target price in the next 5 years, or a 25 to 30% IRR. So let's get into their brands. So XPOF has grown to 10 major brands and is the market leading brand in 5 of the industry's largest verticals. So that's Pilates, where they own Club Pilates, which is 826 studios. Bar, where they own Pure Bar, which is 638 studios. Indoor cycling, where they have Cycle Bar, which is 282 studios. Yoga, where they have Yoga 6, which is about 170 studios. And rowing, where they own Row House, which is 96 studios. Additionally, they have Stretch Lab, which is 305 studios. So just going into the background of the business a bit, Exponential Fitness was founded by CEO Anthony Geisler in August of 2017. Tony's background was He purchased LA Boxing and grew it up to 200 locations in 35 states and sold the company in 2012. He then acquired Club Pilates in March of 2015. And that, like I mentioned, has grown to 826 locations today. He saw an opportunity to create a platform. And so he formed Exponential Fitness to acquire and consolidate various boutique fitness brands. He then partnered with the current chairman, Mark Grabowski, who left TPG in 2018, founded Snapdragon Capital, which became a major investor in Exponential Fitness. Tony owns about 16% of the shares today, and management owns an additional 5%, which shows significant alignment with shareholders. Exponential Fitness has a first mover advantage. They're by far the largest operator and owner of boutique fitness studios in the United States. The second largest is Orange Theory, which is privately owned. And the third largest is F45, which is a public competitor, but has executed significantly less well than Exponential Fitness since they both IPO'd in 2021. So we think they will benefit significantly from being the largest player, and we've seen that so far in the results. We really like the boutique fitness industry. It's growing at just under 6%, or projected to grow at just under 6%. It should grow at about a 5.8% CAGR through 2025. Like I mentioned before, Exponential Fitness has a very resilient customer base. Given it's a 20 to 60-year-old female with a household income of $130,000 annually, we think that this customer will prioritize fitness and continue being willing to spend $1,000 to $2,000 a year on fitness. And so that even in a recession, they shouldn't be significantly impacted. Additionally, 90% of XPOF members are on recurring memberships. And I think this resilience really showed, during the pandemic, XPOF had no gyms close, and they opened an additional 350 new locations. We think opening up a studio is a compelling value proposition for franchisees. So we think the primary reason for the rapid growth in franchise licenses sold is the appealing studio level economics. So on average, a new franchisee would spend about $350,000 on an investment. They would ramp up to maturity in the next 6 to 12 months and achieve 25 to 30% operating margins. So on the average AUV of about $522,000, that's about $150,000 in pre-tax income, which will generate a 2.5-year payback on average and a 40% cash on cash return. Management also has very high standards for the franchisees, only approving about 2% of applicants. And we think this has been very successful. And to date, like I mentioned, no franchise locations have closed. Exponential Fitness is also an attractive business model for investors. Given that they don't operate any studios, they are just receiving primarily recurring revenues tied to the top line of the studios. So it's asset light, it's a high margin business that generates strong free cash flow. Adjusted EBITDA margins today are over 30% and should grow to over 40% by fiscal year 25. Additionally, XPOF has low capital requirements with only 2 to 3% of sales spent on CapEx. They have a largely recurring revenue base with about 70% of revenue recurring. Free cash flow has grown significantly as the business has scaled, and we believe free cash flow will continue to scale and grow rapidly from here. So looking at the recent trends in the business, as you can see, system-wide sales have increased every single quarter, as well as AUVs. And same-store sales have maintained at a very high rate, with same-store sales in Q4 of 22 at 17%, which is significantly higher than what management has guided at mid to high single-digit rates. Since the pandemic, since 2019, they have been able to open studios at a 20% CAGR, which is quite impressive given most of that period was the pandemic period. System-wide sales at 23% CAGR and adjusted EBITDA at a 64% CAGR. As I mentioned before, they have a large recurring revenue base with about 70% of their revenues recurring. So it's a highly predictable revenue that also has highly predictable growth, given the contractually obligated openings of gyms. So licenses sold for gyms have grown at a 29% CAGR over the last 5 years. And we think the combination of growth in studios with same-store sales should lead to highly predictable 20% organic growth for the next few years. As of today, they can roughly triple their base to 7,900 studios. And on top of that, they have international growth as an additional growth driver going forward. The only brand that they are truly saturated or close to saturated in at this point is Club Pilates, which has about 826 locations done out of the 1,000 that are projected. As of now, they have contractually obligated just under 5,500 licenses. And so that provides them with basically 5 years of growth at the 500 plus new studio openings per year that they have guided to. We think this implies a 15 to 20% CAGR in new studio openings over the next 3 to 5 years. International growth is also very exciting. Exponential partners with experienced master franchisees. They focus on partnering with top-tier master franchisors in attractive international markets that give them the largest opportunities. As of now, they have visibility to roughly 3.5x growth, growing studios from 312 to roughly 1,100 studios over the next few years. Additionally, we think the international growth will enhance their margin expansion. In international markets, the licenses are sold to master franchisees, where XBOF takes a take rate of roughly 50%, and we estimate their international licenses are highly profitable pass-through revenues, and we think it's over 80% margin. Just given XBOF doesn't have the same support infrastructure, and so therefore it can be higher margin business. This should provide more tailwinds for margin expansion over the next few years. We also really like their high margin B2B partnerships. So a few years ago, during the pandemic, Tony was trying to figure out how to grow revenue more rapidly, and how to find some revenue for, obviously, the business, while things were of course harder during the pandemic. So he hired an executive in charge of basically brand sponsorship at the LA Chargers, and used him to leverage the success that major sports teams have with these partnership agreements. So now XBOF has digital experiences with Lululemon and Mirror. Celsius has a brand partnership, so basically advertising within their various studios. And then they also are working with Princess Cruises, where their various concepts will be available both on the TV in each person's room, as well as in studios on board. We think the Princess Cruises specifically is both free advertising and free customer acquisition, and they're actually getting paid for it. So we think all of these opportunities are very interesting and could lead to significant growth going forward. Like I mentioned before, we think management's targets appear conservative. So their long-term growth targets include 500 annual new studio openings, which gives us a runway at that level to at least 5 years of growth. They're targeting mid to high single-digit same-store sales growth, which right now, or in Q4, they grew at 17%, so they've been significantly above that. They're targeting low to mid-teens revenue growth, which when we combine the growth in new studio openings, which are in the high teens, and the same-store sales growth at mid to high single-digit, we already get to 20 to 25% revenue growth. So we think their estimates are quite conservative. I sort of went through this on the last slide, but yeah, just to reiterate, when you walk through the math, it seems like there's a significant degree of conservatism baked into their revenue growth. I think the other thing I could mention is the increasing AUVs as the newer brands continue to improve to levels that are already achieved by older brands should also help them quite a bit from a revenue standpoint, as well as the high margin B2B partnerships. Our financial estimates are a little bit above consensus. We think, generally speaking, consensus has done a nice job of modeling the company. We're a little bit more bullish because we think management's targets are too conservative relative to growth. So we have about 103 million this year, which is pretty close to consensus, but we're above consensus in fiscal year 24 and fiscal year 25. So on our estimates, the shares are valued at an EV to EBITDA multiple of 15 times our FY23 and at less than 9 times our FY25 EV to EBITDA estimates. Now, we believe this valuation is attractive for XPOF because it has high margins and is growing EBITDA at a 30% CAGR. It's a meaningful discount to other fitness comps, Planet Fitness being the best one, and rapidly growing consumer franchise companies, or even slow growing consumer franchise companies. So looking at the peers, you can see Exponential is roughly 15 times FY23 and only 11 times FY24 EV to EBITDA. Planet Fitness, which we think is the best comp, is just under 20 times FY23 and 17 times FY24. Planet Fitness has historically traded at 20 to 25 times EBITDA, even though it's growing slower than Exponential. Companies like Domino's or Yum Brands are typically growing EBITDA in the low to mid single digits versus XPOF growing it at 30%, and yet they still trade at a higher EV to EBITDA multiple. Wingstop is actually probably the closest peer to XPOF from a growth standpoint, although we don't think XPOF should be valued at 44 times EBITDA. So not arguing for that, but just think it should be higher than the current valuation today. So we're wondering, if XPOF could be the next Planet Fitness. There are a lot of similarities between XPOF and Planet Fitness. Planet Fitness IPO'd in April of 2017, and their share price showed little appreciation during the first 18 months of trading. But in the following 2-year period, the shares of Planet Fitness jumped roughly fourfold. XPOF has experienced something similar, and we've recently started to see it re-rate, but we still think it has a long way to go. So here's a few comparisons that Piper did between Planet Fitness and XPOF. As you can see, the valuation has been quite similar, at least in the initial phase, post IPO, and we're hoping to see a relatively similar setup where XPOF starts to be able to re-rate significantly the same way Planet Fitness did. All right, we'll go to questions. Thanks so much.
Awesome. Thank you very much, Zach.
No problem.
Appreciate it. So going to steal a few questions, from the report you put on SumZero. And I know you touched on this a bit with the kind of time to maturity for new franchises. But one user was kind of asking about how do new franchisors kind of perform relative to the early adopters?
So far, the cohorts have been pretty similar. So the new franchisees have been in line, or ahead of where former franchise cohorts have been, and you've seen that through increasing AUVs, and then as the base is maturing, you're seeing the more mature brands like Club Pilates have a significantly higher AUV than some of the younger brands.
Got it. Thank you. And if anybody has any questions, obviously feel free to put it in the chat. And another one was asked, what gives you the confidence in the staying power of these franchises? How do we know that it isn't just a fad?
Yeah, I think that's the biggest question that people ask. There's obviously no guarantee that any one particular concept is going to maintain, the stability that it's had, but we think they apply a portfolio approach that gives it a high degree of stability and visibility. We also think that, this is a growing industry, 6% CAGR roughly. And so while it's certainly possible that, one of their businesses or one of their concepts doesn't work over time, so far, I think there's been a lot of staying power. There's a lot of people doing yoga, a lot of people doing Pilates, a lot of people doing bar, a lot of people like indoor cycling. And so, yeah, we think those verticals have staying power. There's no guarantee, of course, one of them, one of the 10 brands could end up being faddish or could end up not doing well. But I think overall, as a portfolio, they're going to do really well.
Awesome. Great. And we have another question from the audience. How has pricing trended over the past 2 years across their studios?
They've been able to, increase pricing with inflation. So yeah, they have raised prices somewhat over time. kind of as you would expect.
Got it.
Yeah.
Well,
and that's
awesome.
also what we like about them is, they're taking a percentage of the top line revenue. So that's obviously really beneficial in an inflationary environment. You'd much rather own the franchisor that's taking a percentage of the top line revenue than the operating business. So that's, a great part of their business model.
Yeah. Very cool. So, okay. Last question here from the audience. They asked, what's a risk that would have this company's value 5 years from now?
Meaning like how would the company decrease in value over the next 5 years?
Yeah.
It's hard. Yeah, I'm not sure, honestly. I mean, I guess if people stopped doing Pilates and stopped doing bar and stopped cycling inside, I mean, it just doesn't seem very probable. And then I guess, if franchise business multiples change dramatically, for one reason or another, again, we think there's some of the best businesses out there, so I don't think that's likely to happen. So I guess the answer is it's hard to envision an environment where that occurs, but certainly I guess anything is possible, but I don't think it's very likely.
Got it. Thank you. Well, Zach, thanks so much for the presentation. That was great. I think that's all the questions we have today. Congratulations again on the win. We're now going to hear from the winner of our special situations category. We're going to be hearing from Mike Ryback of Burford Capital, and he's going to be discussing his thesis on natural resource partners. Mike is a partner at Burford Capital, which was launched in 2018 and is a long-short fund based out of Los Angeles, California. The fund has an acute focus on identifying idiosyncratic single-name shorts and has generated a roughly 60% spread between long and short since inception. Prior to launch, Mr. Ryback spent more than 7 years at Ivory Capital in LA. As an analyst at Ivory, Mr. Ryback identified, researched, and managed investments on both the long and short side in a generalist capacity. Previously, Mr. Ryback worked in media and telecommunication group at Houlihan Lokey with a focus on M&A and financial restructuring. And he earned his BS in accounting, finance, and marketing with a minor in psychology from Truman State University. So, Mike, on to you. Happy to have you.
Does that work?
Yep, can hear you just fine.
Okay, cool. I just want to make sure. All right. Okay, awesome. Well, look, I appreciate the introduction. Yeah. So just to kind of recap, partner at Butler Hall Capital. We're about nearing 100 million right now. The fund was launched about 4.5 years ago, and prior to launch, I spent about 7.5 years at Ivory Capital, which is another kind of long short fund here in LA. It was about 4 billion at peak. I know kind of you guys gave a brief introduction, but just to kind of recap, so Butler Hall, I would sort of characterize us as a bit more of a value-oriented long short fund. We specialize in two fronts. First, we pride ourselves on having a robust idiosyncratic short book. So our short book predominantly is constructed through single name shorts. We don't use much hedges, ETFs, or indices. We focus on accounting irregularities, competitive incursion, declining unit economics, and cycle inflection points. And since launch, our shorts have underperformed the market by more than 50%. And actually, we've generated positive return on our short book as a whole since launch. The second area, and the area of the pitch today where we focus, is we spend a lot of time on these small to mid cap ideas in special situations, a bit like NRP, right? We pay a lot of focus to accounting, to capital structures, and helping us identify business where the underlying cash flows and earnings power are not properly reflected in embedded stock price valuations. So with NRP, I'll give you kind of the summary to start and then dive right in. So for NRP, right now it's about $54 a share. We pitched it in the low 40s. But for $54 a share, we believe you're getting about $11 of free cash flow associated with the royalty stream. It's a coal free cash flow stream. So, even if you're bearish on coal, you could easily put a 16% free cash flow yield on this. So that's about $66. They own 49% of soda ash mine. I'll get to that as well. And that 49% is worth to them at least $42. There's actually been a public transaction that's been announced and finalized for the other 51% that they don't own. And then for those that are looking to gain ESG exposure without paying ESG multiples, there's also a significant carbon sequestration opportunity where we value it at $15, but there's a pie in the sky type scenario where it could be 10 to 20x that. So what is NRP? NRP is an MLP. They own about 13 million acres in the Powder River Basin, Illinois Basin, Appalachian, and then some in the Northeast, Northwest, and kind of along the eastern border. Now, most of us are probably familiar with coal producers. These guys are not a coal producer. They're sort of a royalty-based business. So coal producers are their customers. So the core business is actually lending the land, right, renting out the land to the coal producers, right? So the Alpha Mets of the world, the Ramco, the Peabodys, the Warriors, those types of customers or companies are their customers. They pay NRP about a 5% royalty of what they sell the coal for, net of any transportation costs. That 5% is more or less the average, whether they're selling thermal coal or met coal. Kind of quick facts you should know, though, and we'll probably field some questions on this at the end. But right now, the business is about 50% from a volume perspective and 70% from a sales perspective, met coal related. And to draw the distinction, for those maybe that haven't spent much time between thermal and met, but put it simplistically, thermal used for electricity generation and coal plants domestically and abroad, and then met coal is predominantly used in steel making. It goes into, there's two ways of making steel, blast furnace. Essentially, you melt the coal, you make coke goes into steel, and then you have electric arc furnaces, which you scrap. So met coal goes into the blast furnace production of steel. We don't know the useful life of their mines. People have asked me this before, but we do know that their entire reserve base, right, is about 1.6 billion tons, right? Their customers right now are producing 30 million tons. So you're talking about potentially 50 years of production. It's probably not that long because we don't know it on a mine by mine basis. And then contract wise, thermal typically runs shorter contracts, so 1 to 3 years, and then met runs longer. So you could have most met contracts are kind of like in the 8 to 10 years, I'd say. Now, I want to again come back and draw the distinction of why a royalty company is way better than a coal producer. So first, the free cash flow here to us and to everybody else, the market is much more valuable for a couple of reasons. Number one, as I know, they rent the land, right? They bear zero responsibility for the OPEX, for the CAPEX, right? For getting the coal out of the ground. Because they bear zero responsibility there, there's very little operating leverage, right? Now, it doesn't help them on the way up, right? Like a lot of these coal producers have been benefiting from the big move up in spot pricing, but it doesn't hurt them on the way down. Right. And you can actually see that it oscillates around a very narrow band. Like I think from like 15, 16 to 21 pre-COVID, despite all these moves in coal pricing, right, met and thermal, their gross profit per ton was as low as $6 and as high as $7.70. So literally $1.70 per ton. And then the third thing that makes this a much more valuable cash flow stream is there's minimum contracts. So coal, if coal goes to zero, they still get paid, right? And that's worth a lot. You could see how this business model plays out because despite the volatility we've seen over the last 6 years in the coal market, this company has been able to pay down $1.3 billion of debt. That speaks volumes to the recurring nature of its free cash flow stream. So this business, and I'll get into the assumption later on, but this business from on a conservative basis, we think that coal pricing reverts back to pre-COVID levels. We're not coal bulls. I want to make that clear. We're not coal bulls, but based on our assessment of volumes declining in line with EIA projections, which again is going to be conservative, I'll get to that, and a reversion in coal pricing, we think that this business generates about $11 of free cash flow, and exiting 24 into 25, right? if you have a bearish view on coal, right, you have to keep in mind that at that point, about 80% of sales volumes are going to be met coal related, right? Met coal is driven by global GDP growth, right? You know, cars, buildings, etc. So industrial production. About, you know, at that point, 20% or 15% is going to be domestic thermal coal. Domestic thermal coal, we assume, is going to continue declining at, you know, 3% a year. And then the rest, 5 to 10%, is going to be seaboard thermal coal, right? And now you have to remember, you know, while we're very negative on coal in the US, coal is a massive low-cost resource, right? It's the only global energy that is affordable, abundant, reliable, and secure. So if you're thinking about getting countries like China, like India, like Africa, you know, and countries along Southeast Asia out of poverty, you need coal. So that $11 free cash flow stream still, you know, we believe could be growing if you look further out. But even putting a very conservative 6 times or 16% free cash flow yield gets us to the coal business being worth $66. So that's the first part. The second part is they own 49% of a soda ash mine in Sisecam, Wyoming. This is one of the largest soda ash mines in the world, right? You can make soda ash 2 different ways, right? The natural way, you use Trana ore. Trana ore is what's in this mine. And then you can make it synthetically. Most people prefer naturally, right? You know, the natural way is the cheapest way. It's the cleanest way. It's the most environmental friendly. Right now, about 30% of all soda ash is produced naturally, and the other 70% is produced synthetically. And what is soda ash? Again, simplistically, soda ash is a key component that goes into glass, goes into detergent. So it's, you know, kind of a GDP plus business in the past. But what's really, really boosting growth going forward is it's part of these big green initiatives, right? It goes into solar panels. It's a big product that goes into the production of lithium carbonate for EVs. So going forward, this is a GDP plus business. Now, we've all done some of the parts, and you know, a lot of us still do the sum of the parts the same way. Is they're more like theoretical, hypothetical sum of the parts, right? Company X should be worth you know, a certain price because, you know, peers are trading at X. There was a precedent transaction. There was a speculative investment in the past. Somebody else that looks like them got taken out. There's no theoretical exercise here. The other 51% was owned by this company called Sisecam. Sisecam was owned, it was an MLP, it was a public MLP, and 75% of it was owned by its GP. Sisecam just got taken out by its GP. The value at which they got taken out implies a fair value per share to NRP of $42, right? So today, NRP's 49% stake is worth $42 based on that Sisecam transaction. But even then, that understates the true value of the transaction for a couple of reasons. Number one, Sisecam had one true buyer, and that was its GP. Number two, they had a very onerous IDR structure in that if Sisecam wanted to, I'm trying to remember off the top of my head, but if Sisecam wanted to increase distributions by 15%, the net contribution to them would actually decline. The GP would take a much bigger cut. So Sisecam held the distributions depressed because there was zero incentive to increase them. If you look at NRP right now, they're getting about 45 million of distributions from the soda ash business. The coverage ratio is 1.6, 1.7 times. So going forward, we actually think that they're going to see a massive increase in distributions because now the GP is just going to say, why would I keep the cash here? I'm just going to distribute it out to me. So that 45 million that NRP was getting could actually step up to 65, 70 million. So while we're putting a $42 valuation on this business, right? Because that's where the Sisecam assets got taken out. In reality, you could argue that this could be worth $60 to $70 because you have many buyers, not only one. Now, Sisecam does have a right of first refusal, but they can go to anybody else. And then number two, that distribution of $45 could be more like 65, 70 in a couple of years without any underlying growth for the soda ash business at all. So you got the $66 conservatively for the royalty business. You got $42 conservatively for the soda ash business. So now you're talking about $110. And then this is where the fun part comes in, the carbon sequestration. Now these guys haven't been talking about it a lot, but you have to realize this is sort of a new frontier for a lot of companies, right? That are trying to kind of ride this IRA wave. They've actually generated 20 million of revenues, and majority of that profits from carbon sequestration projects over the last year. They don't tell you anything going forward. We don't model it, but just to put some numbers on paper, right? So right now, they've struck contracts for about 140,000 acres, and those 140,000 acres have about 800 million tons of subsurface CO2 capacity under lease. So think of this as a landfill, right? And then companies are going to pay them, right, to inject CO2 because they are getting the benefit of sequestering the CO2. So 800 million tons. Now, NRP has told you that, you know, they could be getting paid about $2 per ton, right, for this capacity filling up. So if you think this is an 800 million ton, you know, landfill, and it's got a 40-year useful life, and you assume, right, so that's about 20 million tons a year, and you assume 20 million tons garner about a $2 per metric ton revenue opportunity to NRP. Majority of that is profit, right? You're talking about $40 million of cash flows a year for the next 40 years. This is not going to start up anytime soon. Maybe this is 5 years away. So let's just haircut that by 50%. So that's, you know, that's $200 million opportunity, right? If you, sorry, let me backtrack. 40 million a year, you capitalize that at 10 times, you could say it's worth 400 million bucks. You haircut that by 50% because you don't know when it's going to start up and you want to be conservative. That's 200 million, right? 200 million of incremental value is about $15 per share. The pie in the sky opportunity is that this is 140,000 acres, but NRP currently has 3.3 million acres of additional carbon sequestration rights. So this is potentially 5% of their true carbon sequestration opportunity, right? Just to put it in perspective. Nonetheless, you know, we think that this business on a conservative basis is worth 15 bucks. So now you're talking about, you know, you add that up, you're talking about a $125, $130 stock price. So you ask yourself, well, you know, that's fantastic. Many different ways to win, a lot of conservatism built in. Why is it trading where it's trading, right? That's the question we're always trying to figure out because, you know, from that, we know kind of what leads the re-rating. And there's a lot of reasons. And I think a lot of these reasons fix themselves over time. Number one, there's no coverage, right? It's small cap, you know, people aren't covering it, but now it's getting a lot more eyeballs. Number two, it's an MLP. And if you think about it, MLP, you got to deal with the K1s. If you're a smaller investor, you might not want to deal with these K1s. If you're a larger investor that has swap lines and large PBs, you know, you can deal with buying MLPs because you don't have to deal with K1s come tax season, but it doesn't trade enough for you. And so it's in this in between. And then what makes things worse, which we actually think is a positive, is management owns 25% of the stock. So it doesn't trade a lot. And it's kind of this in between where it doesn't necessarily fit well for the large guy, it doesn't fit well for the small guy. Then the third reason it, you know, if you go on Bloomberg, it screens poorly, right? Like I think like Bloomberg has like an extra 250 million of preferreds that they don't have, right? This is a $1 billion EV company, 250, it's 25% of EV. Number four is, you know, one thing we're all doing right now, I'm doing this in my analysis all the time, is we look at, you know, it's hard to figure out what is run rate free cash flow for a business. And we tend to look at saying, okay, well, what did they do pre-COVID, right? Very simplistically. Right? What did they do pre-COVID? What do companies traded pre-COVID? And one pushback I've always had is like, well, look at, you know, people said, hey, you know, Mike, you have 200 million of free cash flow for these guys, free cash flow in 25 on a normalized coal environment. But if I look back at 2017, right, or 2018, these guys were only generating 90 million of free cash flow. So you're telling me that if coal prices revert back to 2019 levels, they're going to be generating 2 times the free cash flow they did in 2019? Like, I think your model is wrong. And what people don't realize doing this kind of cursory screen is back then they had 1.3 billion of debt. They've eliminated almost 100 million of interest expense, okay? So if you look at it on an unlevered free cash flow basis, which is not as readily available on Bloomberg, their free cash flow that we're assuming conservatively is the same as the free cash flow they were earning back then. It's just not getting absorbed by the interest expense running through the business. Another reason. The fifth reason, which actually we think is going to start to subside, is they have these preferreds. They have about 250 million of preferreds. These are floating exercise price preferreds. And you know, most companies in the queues, when they show convertible securities, especially like warrants, they'll show them on a treasury stock method, right? With the implication being, as warrants come due, they're going to take the cash and they're going to try to buy back as much in the open market to eliminate dilution. These guys don't do that. I don't know why. Their accountants don't allow them to do that. So the concern has been is that, hey, you have these 250 million of preferreds that are convertible, and this is a big potentially dilutive equity raise for these guys, and they're not going to be able to use cash to take them out, right? Akin to what they can do with warrants. But in reality, if you read kind of the structure of the preferreds, they can take them out, and they can take them out at par. And even though a lot of people have been telling me like, look, you know, that's not the case, I can't read it. You actually saw that play out 2 days ago. So 2 days ago, Blackstone, these preferreds are owned by Blackstone and Golden Tree, but Blackstone decided to take their fair share of what they can convert this year. You can only convert 1/3 of the preferreds every year. Their fair share of what they can convert this year, they decided to convert them. And immediately, NRP took them out in cash. So it shows you that not only is can NRP take them out of cash, but they're also willing to take them out of cash. And that's important because there's this notion that, you know, there's going to be this huge dilutive event in the future as more of these preferreds come due. And in reality, there's not. Like NRP has the free cash flow today, will generate significant free cash flow the next 2 years, that we think that there's zero dilution from these preferreds. Also, just another thing to point out, the funky accounting for this. So these preferreds, you can only convert 1/3 of these preferreds a year, and they can only be converted at a price above $51. In the queue, this is not going to be an issue this coming quarter, but in the queue last quarter, it showed these preferreds being 9 million dilutive to NRP. They only have 12 million shares, so it's a big dilution. And the reason they were shown like that is because, you know, for some odd reason, they showed them as being able to be 100% converted at whatever the prevailing price was. So like, you know, the trailing price, I think last time they did this was like $30. So they just assumed all 250 million of these converts could be able to convert all at once at $30. So again, when people are reading the Qs and they're seeing that, it begs, you know, it leads them to, and I would do the same, it leads them to conclude that, hey, perhaps, you know, you can't take these out with cash, and they're much more dilutive than we let on. So that's kind of the capital structure thing. And then look, I'll address the other thing. we're not bulls. We're not coal bulls. Okay, we're far from it, right? But there's this notion. So, you know, that first coal was this massive beneficiary in COVID. Why? Because you had coal pricing. I'm talking about spot pricing shoot through the roof, and because of that, you essentially had all these zombie companies that couldn't make money before starting to ramp up production. But because of labor constraints, because of ESG constraints, because of capital constraints, that wasn't the case. And you can look at this period relative to what happened back in 2016, 2018. That's the last time we had a spike, right? So in 2016, 2018, I'll look at thermal and met separately. But in 2016 to 2018, you know, met coal pricing was up 20, 30% over that time period. Met coal production was up 30%. This time around, again, I'm talking spot, met coal pricing is up 100%, production's only up 10. Thermal coal is even worse, right? Back then, depending on what basin you look at, but like if you look at the Central Appalachian Basin, pricing was up 60% from 16 to 18, right? And production, right, in a secularly declining industry was up 20%. This time around, again, spot was up 110% in the Central Appalachian, similar for the other basins, but production was down from 2019 to 2022, right? So you didn't actually see that ramp up of these zombie producers that people are worried about. So that's the first part I'd make. The second part is, hey, you know, isn't this a secularly declining industry? And it is, right? We're not going to argue it's not. In fact, we're looking at what EIA says. But again, you have to keep in mind that once we get to 24, 25, you know, 75, 80% of sales are going to be met coal driven, right? I don't believe that that's a declining industry anytime soon. I mean, I guess if, you know, global population and, you know, middle class starts declining, we can talk about that. And then, you know, 5-10% is going to be seaborne thermal. That's not declining anytime soon. And then the other, you know, whatever, 15% is domestic thermal. And domestic thermal, we're not experts, so I'm just saying, like, look, you know, EIA, they look at domestic thermal as a percentage of total energy consumption going from 25% to 10%. Over the next 25 years, it's a 3% decline. We're assuming the same thing. So I think a lot of this is already baked in. The estimates we're using is conservative. And then I'll just leave you with one thing. you put this together, and I think I walked you through like $125 to $130 stock price. But there's what we like about the situation is, again, that's conservative. That's conservative for a couple of reasons, right? We talk about the soda ash business, right? We're valuing this at $42. I could argue, I could look you in the face with a straight face and say, this business could be worth $65 to $70, right? We're not assuming increasing distributions to help them pay down the preferreds quicker and build up their cash flow quicker from the soda ash business, right? We're just kind of straight lining the 45 million, but I think that goes to 60 million. The coal business, if you look at every single basin that they're in, they've massively outgrown industry data, right? The reason they've outgrown industry data is because they're tied to the lowest cost producers, and the lowest cost producers are the ones that are either able to sustain their current levels of production or grow production. We're not assuming that that's going to continue. We're just simply saying, hey, we're going to assume that their business continues to grow at industry projections, even though we believe that their producers are going to continue to take share. And then finally, the carbon sequestration piece, like I said, we're putting $15 on it. That's much tougher to figure out. But, if you're a carbon sequestration bull, you can easily say, why can't this business be worth $150, right? I mean, we're only talking about this being 5% of their properties, right? So maybe it's worth 150, not 15. So lots of different ways to win, lots of margin of safety. And that's really what gets us excited about this name. So I know I probably rambled a bunch, so I'll turn it over for questions.
No, that was great. Thank you, Mike. Yeah, if anybody has any questions, obviously just type them in the chat. A lot to digest here. I guess I had one. Just looking at your report, you said kind of in the wake of the SizeCam acquisition, you said, we believe the onus is now on management to help the market recognize the significant valuation uplift from this asset. I guess what steps would you want to see the management team take?
So it's funny you asked me that, because right now I don't want them to do anything. They have these warrants. They have about 3 million of warrants that are already in the money, right? If 100% of those warrants came to market today, right, to take them out, it would cost them $60 million. If the shares go up $20, over the next month and a half, because they're talking about the SizeCam deal, and everybody's like, oh my God, this is an amazing asset. Those same warrants that come to the market, it's going to cost them an incremental $50 million. So what I would love for them to do is continue doing what they're doing, execute, generate free cash flow, and hopefully a lot of these warrant holders are going to convert right now, right? And then once these warrant holders convert, they can talk about this deal, right? I honestly don't think that they need to be doing anything different than what they're doing today, right? This is not, there's so many different ways to win, and you're getting paid 6% dividend to wait. So I actually don't want them to talk up the SizeCam deal anytime soon. I want these warrants to all convert. I want them to take them out right now. And, hopefully after they convert, if they can talk up the deal, it's great. But I would be shocked if they don't get interest in the soda ash business at some point in 23, right? And look, these guys own 20, like we're all, we're all kind of capitalists at heart, right? They own 25% of the stock, right? You don't think they're sitting here and they're saying, guys, 80% of our value, right, which only makes up 10, 15% of our profits, is now in an asset that we're a minority holder in. Like, they're probably going to start having conversations with somebody, right? Especially when we see kind of demand for soda ash continue to pick up because of a lot of these EV initiatives.
Got it. Awesome. Thank you. And then we have another question from the audience here. They ask, who owns the nearest coal mine, and how many major mines are there in neighboring states?
When you say the nearest coal mine?
Yes,
so they don't own. So maybe I think maybe I know what they're asking, but so they don't own coal mines. They rent the land. Their big producers are, their two biggest producers is Foresight in the Illinois Basin, and then Alpha Met in the Appalachian. So those are but they have a bunch of properties across the board. But those are the two biggest ones. Illinois Basin. What's interesting about Foresight and why is Foresight went bankrupt. Foresight went bankrupt. So now Foresight is sitting with the lowest, cost structure of most producers because they went bankrupt. So it actually aids them. It actually hurt them. They were a customer of theirs about 5-6 years ago. They went bankrupt. You saw a big drop in production, but we're in chapter 7. It was a chapter 11, so kind of came out with a much lower cost structure going forward.
Got it. Very cool. Let's see. I guess final question also comes from a comment on your report. Someone asked, are there any tag along rights or squeeze out rights for the soda ash business?
No. Separate company, separate decision makers. Like I said, the only kind of so they're a minority holder, right? Ultimately, and then they can go and if they want, they can shop this asset to someone else. The only thing is SizeCam has right of first refusal. So if they want to sell it for $100 or whatever the implied $100 is to them, they can do that. They just have to ask SizeCam if they want the 51% first.
Awesome. Well, Mike, thank you so much. That was fantastic. Appreciate you coming on, and congrats again on the win in the contest.
Cool. Thank you so much for having me. Really appreciate it.
So just really quickly, I thought it'd be great to get both of you guys on the same segment because Rabia, Iqbal, like you run a crypto fund of funds, and your sort of mandate is investing in Web 3.0, kind of finding new applications of blockchain technology. And your background is really interesting because you kind of come from the traditional hedge fund arena. You've worked at Co2, you were at Mubadala, the Sovereign Wealth Fund, and so you've seen a lot of I guess traditional equity investing. And from what I understand, you kind of got into crypto in 2017. And then Jeffrey, your background's fascinating because you used to be the chairman of Intermix, which was the parent company of MySpace. So you've seen sort of social media for the last I guess 2 decades now, and kind of been at the center of it. And now, as CEO of MeWe, you're spearheading kind of MeWe's transition towards leveraging the blockchain. And I think MeWe is a very interesting example of just how Web 3.0 is evolving. We've obviously, had a pretty tumultuous last 12 months for technology with, frankly, most tech companies in the U.S. getting, cut in half or more in terms of valuation, and the same could be said for crypto. There's been an enormous amount of, sort of pain in the crypto industry with like many crypto businesses going bankrupt. So I feel like, there's the saying, trouble meets opportunity. It's always, I think, interesting to see what opportunities arise when there's a huge amount of volatility in any industry or sector. And so, Rabia, maybe we should start with you just to get a little bit of a backdrop on kind of your thoughts on the industry. Maybe to start, if you could just first tell listeners about your fund of funds, Neural Capital. I'm sure they'd love to hear kind of the general, kind of the purpose of the fund, and then we can get into blockchain a little bit.
Sure. Well, thank you so much, Divya, for having me. And it's kind of an understatement that you said there's been some pain in the industry. It's really been one of the toughest times in the space right now. But I do think that the silver lining there is that tough times do make you more resilient. And we hear this a lot in crypto and blockchain, that it is an anti-fragile technology. And so that's only becoming more and more clear after 2022 and everything that's been happening with the drawdowns. And so kind of rewinding and going back to how I started in the space, like you said, I started in 2017, kind of tinkering around and investing, kind of just from my PA. And one of the things that I really understood at the time was we were really on the brink of something. This technology is going to be transformational, and there is definitely going to be a place for blockchain and crypto in the future. We might not know what that looks like. It might not kind of manifest in a cryptocurrency type of way. It might kind of go back to the blockchain and the applications, but there needs to be more emphasis and focus on it. And I saw very early on that most of the opportunities were only going to a handful of VCs who are already connected in the space. Very few individuals could even access those the space kind of beyond opening an exchange account. And the whole thesis behind Neural Capital was to link individuals and family offices to great fund managers who were finding really great opportunities in the space, and giving them access to be able to participate and put their dollars to work in this transformational technology. And so basically what Neural Capital does, it is that it's a fund of funds for mostly venture capital funds in the crypto space, but some liquid funds as well. And we try to build a broad diversification across all different subsectors. We cover NFT, gaming, metaverse, DeFi, CeFi, infrastructure, Web3, and we try to bring the underlying LP access to as many portfolio companies as possible in this space. And truly, we don't know what this is going to look like in 10, 20 years, but we do know that this technology is here to stay. And by participating and learning from as many different aspects of it, you have a better chance at participating in the upside, but also educating yourself as this becomes the future of of how we interact every day. And so it's a typical fund structure, a fund of funds, and LPs kind of commit getting access to everything. And then kind of through our reports and through our webinars and different publications, they're able to learn and educate themselves as well about the space and what's going on, what's happening, and what to look out for.
So in addition to the funds that you guys are invested into, Neural also does direct deals, right?
Yeah, exactly. And that was kind of important to us because, you know, traditional fund of funds, you know, find great fund managers and have them kind of invest in everything. But because crypto is a little different and blockchain is a little different, there is an equity and token component as well. And specifically investing in some tokens can get LPs liquidity faster. We wanted people to kind of participate in that upside because that's a very important part of what we're trying to build and how we're trying to introduce people to the space. And so there is a direct component of the portfolio that has some equity and token exposure as well. It's a smaller piece than the fund of funds part of the portfolio, but it is an important part of the story that we're trying to tell as far as diversification into the space.
Yeah. So when you're evaluating these managers, how much transparency do they give you in terms of what they themselves are invested in? Like, do you have to diligence like their underlying investments as well? I'm just curious how that process works.
Yeah, I'd say that transparency has increased quite a bit recently. You know, there was a period of time where there wasn't as much transparency, and it was difficult to kind of really understand what that manager was trying to do and kind of what their thesis was. Because this is a nascent space, people are constantly changing also their investment philosophy. And there are things that cause you to change that, right? There's regulations that are coming out. There's guidance that's coming out that can cause you to change how you think about the world as well. But to our core, what we try to do at Neural is we try to kind of combine the different managers who have slightly different investment philosophies, so there's not so much concentration overlap in the underlying portfolios. So, you know, what we offer to people versus if you were talking to a fund yourself is like we can get really deep into what their thinking is, and then we can make an assessment of what types of things that they're going to be investing in, what types of portfolio companies, what thematic parts of the blockchain are they're going to focus on. Because, you know, as an LP, you know, you can only do so much to kind of guide a GP in what they're investing in, and so a lot of times these their investment policies are very broad too, and so it takes a lot of knowledge of the space, knowledge of that person's investment style, and kind of their background as well. One thing that we have at Neural that really makes us special is that we are actually partnered with Kinetic Capital. They were our earliest backers. And my partner, Jahan Chu, who's the founder of Kinetic, is also a GP in Neural Capital. He started investing in this space in 2013. Kinetic is known to be one of Asia's oldest blockchain venture funds. They have compounded knowledge of this space, and they've invested through many different cycles, and they've invested alongside many of these fund managers. So because we have that institutional knowledge, we can kind of take a educated guess on where people are going to be investing, what we like to call it, what tribes they're investing in, right? So like there are different tribes within crypto that kind of interact and invest together. And so, you know, we can make more educated guesses to what people are going to be investing in. But I mean, it is a good point, you know, there historically was not that much transparency because we knew people intimately. We were able to kind of guess that a little bit better and kind of like model that out. But now we're seeing a lot more transparency. We're seeing a lot more reporting. We're seeing a lot more communication from fund managers, which is only better for the industry.
Yeah, I mean, was that something that came about because of the FTX collapse, or, I mean, there've been so many collapses that it's hard to keep track of, but would you say that was kind of the main, like, I mean, at least it feels like one of the bigger kind of pivots in the industry, but yeah, I was just curious to get your thoughts on the impact of FTX.
Yeah, I mean, it really started with 3 Arrows, and that's when people started really kind of asking a lot of questions. Investors and institutional investors who were playing in the space got really concerned with custody and just management and risk management in the entire space. And so that's when like questions started percolating and like due diligence became a bit more front and center. And with FTX, that was kind of a real push. And you know, you see now a lot of institutions have kind of backed away or are building more rigorous processes internally because they were directly impacted by the FTX events. And so transparency now, it's people don't even question you, you know, but before you would ask about service providers and people would just be like, oh, look at page, you know, 12 of the deck. And now people actually spend the time to be like, well, we diligence these 5 service providers. This is why we picked this custody solution. So people are, you know, it's not an afterthought anymore. It's very much front and center.
Yeah, that's definitely a good thing for the future of the industry. In terms of the different trends you're seeing, at least putting FTX aside, you know, you had this explosion in DeFi that's probably been muted somewhat over the last year, but certainly as far as like the decentralized applications that were taking off, like DeFi was, I'd probably put that as number 1. You had NFTs, then you had kind of this, I guess this like stablecoin world. Then you have these this other category of decentralized applications across a variety of industries, communications being one of them, social media being one, that I think are still pretty nascent. But I guess of the various pools of decentralized Web3 apps, like where are you seeing the most real like user traction that kind of goes beyond hype?
Yeah, so that's a great question. We actually, so where we've seen CFI be put really to the test in 2022, I mean, you're looking at firms that raised unprecedented amounts of capital in previous years, 2020 and 2021. FTX raised 420 million, BlockFi raised about 500 million, Celsius did like a 400 million round. I mean, these were crazy numbers, and what's the common theme there is that those companies no longer exist. And so CFI really was put to the test. I mean, you saw Coinbase's stock price kind of plummet as well. So there's going to have to be a reworking of centralized finance and the way that it plays into this space. And one of the things that we've been seeing a lot now is like proof of reserves. Binance is showing that regularly. Other platforms are as well. And so, you know, there are things that are coming front and center now to kind of help prop CFI back up, because CFI is a really important player in this space too. You know, you talked a little bit about
it's the on-ramp to this whole world in a sense, right?
Exactly. And when we take our thesis of how things are going to work in a few years, we're not DeFi maxis, right? Like, we don't believe that like everything should be decentralized and get rid of all the centralized institutions. Like, that's not practical in today's day and age. We think of everything being kind of in this hi-fi, like this hybrid finance. And so we need a strong DeFi to achieve that. And we've had a lot of bad actors wash out, and there's going to continue to be washout in that space. And CFI will continue to kind of move in the right direction. But what we have been seeing that's promising for DeFi is actually that one of the biggest players in the space, Uniswap, just even after kind of Three Arrows and all of this market turmoil, raised a significant round from one of the top blockchain venture funds, Polychain. And JP Morgan actually recorded its first DeFi test transaction in the fourth quarter. So, with Uniswap doing so well, in fact, its market share is now 70%. They're averaging a little over $1 billion of daily volume every day, which is great to see, kind of post FTX. It is heartening to see that there is a trend and DeFi is not dead. And then with the tweaks of CFI, there will be like a middle ground. And, with the fact that these kind of established institutions like JP Morgan are coming in and also testing out the blockchain, that's comforting too. So, while things are tough and it has been a challenging couple quarters, there is a light at the end of the tunnel. It's going to take a little longer to get there. I'd say that's kind of on the.
I was going to say, do you have a view? Because I mean, the reality is a lot of the frontier stuff in blockchain is still largely indexed to Bitcoin and Ethereum pricing for whatever reason. I think it's hard to separate like what's going on with underlying crypto pricing and what's going on with like the broader ecosystem. Although I would say in the future, those things should be somewhat divorced. Like how much of like, I'm just curious, do you have a view on where, like which of these blockchains, if you were an investor in like liquid tokens, like, do you have any views on where people should be looking just from a return standpoint, if they're interested in liquid tokens?
Yeah. So, this isn't investment advice by any means, but one of the the areas that we are actually very excited about today is a investment that we did on our direct side of our portfolio. We invested in the seed round of Aptos, and you know, while there are obvious challenges with layer 1 and layer 2 infrastructure, we do have a strong belief that Aptos is going to be a strong player going forward. I mean, already in 2023, they've shown, the token price has shown strength, and they did a tremendous rally in January, and you know, they've raised a decent amount of capital. They are spun on, and for those who don't know about Aptos, they were part of the team that spun out of Facebook and Meta, and what we really like about them is that this team is coming from actually coming from a like real world application, Facebook Meta, that had very strong user engagement, and so the team really understands kind of how to master that. On top of that, they're built on the Move programming language, so they have a leg up on attracting great developers as well. And kind of marrying those two things together, we think that Aptos will be able to build strong infrastructure in the long run. To onboard the next billion users into the space, we're going to need better infrastructure. I mean, using Ethereum, and I mean, I love Ethereum. It is one of the smartest tools that's been built, but using Ethereum today to transact, and it just isn't practical. And so we are going to have to adapt to that. And I do think Aptos has all the right components of that to get us to that next billion-dollar user infrastructure. So that's one of the ones from our portfolio that we feel strongly about. But you know, there's a lot of other strong players too. You know, Solana's taken a big hit recently, but you know, their developer numbers are very strong as well. And you know, there's great things happening on the layer 2 side with Polygon as well. So you know, it's gonna take a little bit of everyone coming together to really prop things up.
Super interesting. Jeffrey, tell us about MeWe. I feel like this might be a good segue. I think most of the folks in the call probably aren't familiar with it, so maybe you can give a quick summary of MeWe, and then we can talk a little bit how you think MeWe may benefit from blockchain technology.
Sure. First, I want to acknowledge what a wonderful sweater you're wearing there, Divya. It's fantastic. I really like it. I feel like I'm overdressed over here with my collared shirt. And I also want to just thank you. Divya serves on our board, so shows a lot of confidence in what we're doing by having you participate, you know, given who you are. So it's interesting. MeWe is something that if you talk to a bunch of people, since there hasn't been a lot of marketing done in the past, it's a platform that has 20 million users on it. And we are based in a completely different business model than Facebook and Snapchat, whom we compete with. And our business model is more based upon the subscription side of things. So we don't company surveil you. We don't influence your feeds. We allow you to have direct and authentic interactions with your friends. We're private. We have 600,000 groups on the platform. Most people don't know that. So it's really a group-based platform that way. And as we started to look at the market, we thought, well, we don't have tens of millions of dollars out there to start competing with, the Facebooks, the Snapchats, and Twitters and the like, although we think our tech is better. What we need to do is really change something fundamentally the way social media is looked at. And as all of you know, with children and this world, 15, 20 years ago, when I was at MySpace, that was the beginnings. You, Divya, with Facebook and Harvard Connection and all that you were doing. The governance didn't exist at that point in time. So, but people weren't spending so much time on social. And today we have to be so much more responsible to users. And so what we're trying to do is change the paradigm, shift the paradigm on how social media will take place as we move forward. So we partnered with Frank McCourt and McCourt Global. And Frank, we had a commonality of values to really, we look at this as a movement we're doing to Web3. So we looked at it and said, on Web3, there's an opportunity. Because we're subscription-based and not driven by ad revenues, and because I don't sit in a chair like Elon Musk or Zuckerberg or Dorsey or whatever and make a decision to throw people off the platform or keep them on the platform, we believe the governance and we believe it should be more of a democracy. So our thinking is by partnering with McCourt and his Unfinished team, that we would move MeWe over time onto the blockchain. And our bet, Rabia and Divya, was a little different. It was Unfinished wrote the tech based on the Ethereum platform. But in reality, we, in discussions with Gavin Wood, who was a co-founder, obviously, of Ethereum, we found Polkadot to be a much more robust platform for growth. And so, because we believe there's going to be hundreds of millions of people as we move towards this social web, the new social media on the web, that are it's got to be scalable, and the costs have to be a certain way. It has to be cost effective. In addition to that, we found Polkadot to be much more content and user and creative friendly to that community. And my background, I come from the production world, the entertainment world, in addition to being a KPMG guy. So I'm trying to get to a place where we can take those creative aspects to make a technology platform more compelling and more usable. So moving to Web3 with Polkadot as our foundation, with our partner Unfinished, we just believe that we're the first in moving this way. We believe we're the first in, and that we have a real head start in what we're trying to do. And if we have the proper capital to market and share what it is we're trying to do, there's a whole plethora of opportunity that before us in this whole Web3 space.
And Jeffrey, can we just talk a little bit about why the transition to Web3 it makes strategic sense, and how that would work? I mean, so is the idea that the 20 million MeWe users would be able to, essentially be compensated for their engagement with the platform through some sort of, some sort of virtual token? Is that sort of at a high level kind of what you guys are gunning for?
Yes, it's similar to that. I'm not going to get into the token economy of it right now, the token economics of it right now, but essentially we're responding to what our users want. They want control of their data. They want control of their own social graph. They don't want big tech hijacking it for their own ad revenue benefit. So what we're doing is we're communicating with our 20 million community, getting as many of them via tokens and just the desire to double down on the privacy aspect of what we're doing to move them over to this blockchain. And like I said, this frequency layer that sits over Polkadot. And so that's number one. It is a movement and it's a network effect that we're hoping takes place to draw lots of people there. And we're hoping we are not going to be the only ones on this platform. There'll be other companies and so forth. And we're going to first, and this is happening really within the next 90 days, is we're going to have a universal login protocol. And so that'll be launched in 90 days, 4 months at most. So sitting on the blockchain, you're going to be able to go in and out of our app to other apps that exist there or developed on Polkadot. That's number one. And then moving forward a little bit later on, your social graph, your entire structure and footprint of your interactions will be on the blockchain. You will control that yourself. and we'll be able to help you leverage that with tokens and other things.
I think it's super exciting. And I think what's also interesting is that whenever this transition occurs, MeWe will be kind of overnight the largest community of its type living on the blockchain. I'm not aware of another app that has that kind of scale, but maybe you can expound on that.
Sure. So we will be the largest on this whole Polkadot Web3 in this largest world in terms of our user base. Obviously, the folks that convert will determine what the usability of it is and the true numbers that come from it. But we are definitely the largest platform moving to it.
Rabia, this is for you. I mean, I think it's interesting that Jeff's team kind of chose Polkadot as their foundation. And this is obviously a big debate, like which layer one is going to win. Do you have a view on that, or do you see sort of a world where there's numerous layer ones, and maybe they have specific use cases that they're better suited for than others, and that they can all kind of be successful? Like, I'm just curious what your thoughts are on that.
Yeah, I mean, great point, and kind of similar to what I was alluding to earlier, is that we believe that multiple layer ones will accrue value and usage over time. Our goal today is to get to that next 2 billion users, and we need the right infrastructure to do that. And some applications will find that infrastructure on different protocols, and that's okay, because we are all working to create the right infrastructure to get users to engage. First, we have to have the people there, and kind of the ease of use there. And so it is going to be a multi-chain world. Over time, there might be one winner. A lot of people thought that was going to be Ethereum for a while, but we don't even know what this is going to look like in the next 3, 5, 10 years. There might be another protocol that's kind of being developed in stealth right now that's going to be the clear winner. We just don't know. So if everyone can find a way to work together right now, I think that is the most beneficial thing, especially in this bear market.
Are there any like real world apps that you're seeing are kind of getting traction with like normal people, as opposed to, say, just pure tech wonks or crypto bros and the like? I mean, I think MeWe is interesting because MeWe is an actual app that people use, not because of crypto, but because they appreciate the service and they use it as a venue to share their thoughts and the like. And I'm just curious what you're seeing in terms of, use cases that are working outside of just the use case of buying and selling a crypto for the sake of making money.
We talk about this a lot in the context of NFTs. I think NFTs are a great gateway for people. They're fun. And then there's also a lot of value to actually a non-fungible token. So if you think about things that are non-fungible, they've been around for many, many years. Think about your credit card number, your driver's license number, your phone number. These are non-fungible things. And, to tokenize these things is just kind of the next step. And so there will be an application where you can use that, and people have already been using them for privacy and identity. But think about how people, like brands, have been using them already. Nike is probably the best example, because they earned almost 200 million. I think it was around 185 million in their NFT sales. While it's a different kind of importance. It's important to the person who feels kind of brand recognition and identity through that brand. that NFT is very important to them. Also, Gucci and Tiffany's and Reddit have also been using NFTs. So like there are, I guess, like aside from like buying and selling cryptocurrencies, there are these like applications where people, mainstream people are coming into the space, and they might not even realize they're coming into this space, but that's their gateway. So that's
do you think NFTs are going to be more important if the metaverse becomes reality? I don't know if you have thoughts on metaverse, but how metaverse and blockchain kind of overlap, I think is very interesting.
Yeah. I mean, I do think NFTs are going to be really important because just the pure idea of being able to kind of store everything in this unique token. So we've invested in a company called Snickerdoodle that actually stores your web browser cookies on an NFT. And we think it's a great idea because, you are already surfing the web and you're already hitting accept cookies on every website just because you want to have a good experience. And what if the user get to accrue value for hitting accept cookies all those times, and all of your user data that's being stored in your NFT, you can then profit off of it through getting drop doodle tokens, and then you can transact with those doodle tokens, or the whole idea isn't built out, but that is the future, right? Like you as the user of the internet should be able to accrue value for going on certain websites or people taking your data. And so this concept of NFTs, it'll be important in the metaverse. I think it'll be important in your day-to-day life as well. And TBD of which one's becomes more important, but we think that, to our core, we think that Web3 survives when you, the user, don't feel any difference, right? So it's not like you're going to have to go into the metaverse and interact with all these different things that are foreign to you now, and like that's how you're going to be like in Web3. We think it's going to be like you log on to your computer, you check your email, you do all you like have a transaction, and on the interface you feel like it's Web 2, but on the back end all these Web3 things are happening and making the experience easier. So like while I do think it's important in the metaverse, and it will be an important part of the metaverse, I think it's going to be even more important part.
Divya, that's important to us, what you just said, Robbie. It's people need to, right now there's so much vernacular that people don't even understand. And you have to be in this DeFi, crypto, blockchain. Most people think that blockchain equals crypto. I'm talking the regular consumers, maybe not people obviously on this call. So we have to simplify things to make it more available to the mainstream, and that's critical. And it has to be transparent, like you said, Robbie, for people to be able to use this. And one of the things we're doing is we're moving to a follower model also as well. So people can come in and out of our app where it won't be a closed environment. We'll be able to interact with other apps. So our universal login or social graph, like you talk about, Robbie, it's a great idea to have your social graph or your whole browsing history as part of an NFT. We're looking at ways to help people be able to monetize that as well. But look, social for the future is critical. And if we don't get our arms around it and change the way it is being governed, the way it is being now in the forefront, you heard on Joe Biden's State of the Union, he talks a lot about that. So we have to get our arms around social. And I think social is going to be one of the largest, if not the largest, utilization for the future of Web3.
I think that's well said. Although, to be honest, I didn't actually watch Biden's State of the Union address. I'm going to have to catch the highlights on YouTube or something later. But look, guys, this is really, really great. It's very interesting to hear kind of both of your takes, because Robbie, you're seeing things from a higher, further distance, because you're looking at a lot of different opportunities. and Jeff, you're kind of in the weeds, in the trenches as far as trying to make use of a lot of this tech for a specific app that you're managing. So it's very cool to hear kind of how you guys both see the future evolving, through kind of different lenses. So anyway, thanks again for taking the time to chat with us, and we're gonna transition to a somewhat different discussion about Apollo and some of the alts managers. But later this afternoon, I'm actually doing a talk on big tech with a guy by the name of Brad Erickson, who's the internet analyst at RBC. And so he's gonna talk about a number of those names that could easily be disrupted in the future by some of the stuff that we've talked about here. So feel free to join in on that if you guys are interested. But anyway, thanks again, Rabia and Jeffrey. This is really great.
Thank you, Divya. Appreciate it.
Thank you. Thanks so much.
Awesome.
Nice meeting you, Robbie.
So earlier today, we did have Manish Pabrai talking about Brookfield Asset Management, which I think is a great segue into our next panelist here. Pleased to welcome back Samir Parikh, who, as you may all know, won our large cap contest last year for his thesis on Blackstone. And he is now back with a back-to-back win for his thesis on Apollo this year. So congrats, Samir. A little bit of background on his background. Samir brings over 25 years of experience investing across asset classes, spanning both public and private markets. He's invested across sectors in public and private equities, credit, and special sits. Samir received his MBA from Harvard, a BA in Econ and Bio from the University of Chicago, and completed coursework at Stanford Medical School. So Samir started his career in private equity before moving into hedge funds, where he's worked in some of the highest profile funds in the world, including with the early spinouts of Valpost, SAB Capital Management, an event-driven special sits fund, and Fir Tree Partners, a multi-strategy hedge fund where he's head of public equities in their real estate group and led the firm's investments in the alt sector. He now manages a family office vehicle, Juna Capital, to primarily own secular long-term compounders. And Samir is also in the process of putting together the architecture for a new investment fund called Giant Leap Capital that will take a value structured approach to investing in private and public equities and special sits. So I think a lot of you know Samir for his expertise on the public alternative asset managers when these situations were highly complex and misunderstood by the market. And I think we have a similar setup for today. So Samir, I'll turn things over to you. Welcome back.
Great. Thanks, Griff, and thanks, Divya and team for putting together another great forum that's been super informative throughout the day. Great job, guys. So I'll try to make this very short. I think it'll probably be more instructive to open it up for questions as they do get a lot of these and have over the past 15 years since I started looking at these. I'll start off by saying that Apollo, the alts in general, are extremely complex from an accounting modeling perspective, and it is that complexity that actually has continued to create the opportunity in this sector and in Apollo. The irony, though, actually, is that it's probably been one of the most obvious investment themes over my 25-year career. The reason for that is quite simple. We're all investors, we're all in the same industry, and we've all been in some way or form equities, credit, competing against Apollo. So I think from a diligence perspective, it's fairly easy to do versus some other industries where you may not be an industrial expert or an expert in a particular AI technology. It's no doubt that, sitting here today, the alts in general, Blackstone, Apollo, KKR, et cetera, they get better access to information. They've had industry leading returns over the last 30 years. And I can say, from my own experience, having worked at some of the most institutional hedge funds out there, having done diligence through just calling my own LPs and asking them where their incremental dollar is going, it's usually not to us or my respected peer hedge funds, it's usually to the alt. So I think that in itself is one of the ironies of this industry. So let me start off by saying that Apollo itself was one of the easiest alts to analyze because they were at one point the most asset light, and at one point the majority of their fees came from management fees and kind of episodic distributions and dividends coming out of their highly successful core private equity fund. Over the years, and more specifically over the last couple of years, they've made some significant changes, which has created over the past 12 months a lot more complexity in the business. And the main one there was the purchase of Theme, which has reconstituted the entire asset base there, the way they report, and quite frankly, the longer term trajectory, which is why I kind of moved it from a special situations, which is where I had kind of classified it last year. And I think it had won the special situations category at SumZero last year, into now what I think is going to be, one of the most interesting long-term compounders where you can just buy and hold this, and with some pretty strong confidence that you'll double-digit, you'll compound this over a fairly long period of time. I'm going to break my pitch into really just 5 buckets. I'll spend a minute or two on each of them. I have my report up there if you guys want to take a deeper dive into kind of where I'm getting my numbers, and then I'm on the website, and happy to have anyone reach out to me in particular to talk about some of the more intricacies and the details of my bottoms up analysis. Look, I'll start off with kind of just the business. Founded in 1990, so relatively speaking, Apollo is only 30 years old, right? They have about $500 billion of AUM now across yielding credit, PE, and other opportunistic asset classes. They've been one of the most premier asset managers in terms of returns. They've netted IRRs of 20% since inception. They've grown AUM at a 20% clip for well over a decade, and they've gone from a pure play private equity firm to a real diversified asset manager, and that's important, and I'll get to that in a little bit. Like I said, last year they completed the acquisition of an insurance company called Athene. Insurance scares a lot of people, scares me as well, because there's a lot of opaqueness there. But I would say Athene and the asset is probably one of the more I don't say safer, but certainly one of the more interesting assets out there in terms of what they do. It gave Apollo a few important things. One, a massive permanent capital base. It gave them, it's fixed annuities, by the way. There's a lot of different, and I won't get into the different types of insurance assets out there, but fixed annuities tends to be a little bit easier to analyze and certainly less risky on the risk curve. And it's a highly cash generative business. So I think last year, if I'm not mistaken, I don't have my model in front of me, so I apologize. They spit out $750 million of free cash flow. So, high ROE business and highly cash generative. So it was really transformational. So that's a high level on the business. I think my first starting point in analyzing and even looking at a business is, and I'm a little bit older, so I just try to find good businesses that I can hold for a long period of time. And I stole a page out of Blackstone's 2018 Investor Day So hopefully that they don't come after me. But John Gray spent some time on what makes a truly great business. And there are really 10 characteristics, and I'll mention them quickly. Fast growing, limited need for capital, magnet for talent, produces high absolute and incremental margins, anchored by recurring revenue base, generates significant free cash flow, loyal customers, global franchise, a real moat around the business, and brand equity. And if you think about Blackstone, which I think Divya would agree with, it has all those characteristics, and it gets a phenomenal multiple for that. Think about Apollo, has all those characteristics, and it trades for half the multiple of Blackstone. And we know we'll get to why that is, but when I look at those characteristics and juxtapose it against Blackstone, it has all of those characteristics and even more. Some additional things that I like, I try to think about businesses a little bit differently, and sometimes I get a little pushback on this. But when I think about Apollo and the alts, I look at them as data businesses. They get more data than most banks out there. They have access. They own these portfolio companies, so I know they're getting the data on a daily basis or a monthly basis. So there's no better arbiter of data on a mass scale than the alts, just because they own so many companies across so many sectors and so many geographies. Number one. Number two, there's massive network effects. Apollo's effectively created an exchange, if you will, that is matching risk capital with various return options. So it has the exchange element and network effects. I look at some aspects of their business, and they're some of the best SaaS models out there. If you go to any of these institutions and you look at their core customers, pensions and endowments, about 10 years ago, they may have had 1 or 2 products. Now they have 10 to 12. They will get to double-digit products, but they're on their way to going to 10 to 12 products for all of these guys. And the reason is, a lot of these businesses that Apollo is getting into are still nascent: real estate, infrastructure, core, and they can just sell into that installed base. That to me looks very much like a SaaS model. And then the other large thing that a lot of people kind of miss is that the growth that the alts have had over the last decade has really been in one slice, and that's been in the institutional market. And there's still a fraction of that. Over the next kind of 10, 20, 30 years, there's 2 markets that we're in the first inning. The first one is insurance, and obviously Apollo is the first mover in that. And you've seen every other alt replicate what Mark Rowan has done at Apollo, getting into insurance. But Apollo is way ahead of the other guys. And second is retail. I think that it's well known that most of us, high net worth and other retail, other asset classes have not had exposure to the alts as part of their portfolio allocation. So that's going to be a massive opportunity. So that's kind of the backdrop of, these are great businesses. They have elements of tech in them. They have a large TAM ahead of them. And then look, finally, one thing that's has always been paramount to any investment I make is the management team. In this case, we now have one leader there, Mark Rowan. I've spent a lot of time with him over the years. He thinks differently. He has a strong vision. He was the architect of the entire Athene transaction. And if you listen to him talk, he understands risk better than most of the guys I've interacted with on Wall Street. He has a relatively new quote, which I truly believe in as a value investor, which is purchase price matters, right? And that is the starting point of value creation, whether you're buying an infrastructure asset, a public equity, or for that matter, any asset class. So I think that having him as a leader, knowing that some of the top leaders at Apollo are taking all their compensation now in stock versus carry, and then finally, almost 40% of the stock is owned by insiders. The alignment here is very different. So those are all the things that I think about in terms of why it's a great business. Look, the question is, why then is the stock mispriced? And I would say there's really three main reasons. One is this transformation process is really still occurring. They're going from PE to various different products and asset classes that are still relatively nascent. If you do a study of the earnings profile of any of the alts 5, 6, 7 years ago, about 70% of the earnings profile of any of the alts would have been highly cyclical. Fast forward today, if you actually do the work on the components of earnings, I would say 70 to 90% of the earnings are now management fees and recurring long duration fees. So that transition is not obvious to a lot of investors. And then lastly, core, the products, they're longer duration, they're higher margin. So the entire profile of the alts is changing, not only from what they're doing, but that's also translating into just a different modeling and mathematical exercise. So that's the transformation is still in progress. The second is a theme. Like I mentioned earlier, the transaction was announced last year, closed, and this will be the first year where we'll really see the performance of the pro forma Apollo and Athene and the power of Athene. My viewpoint is as I alluded to earlier, it's a phenomenal asset. It gives them access to another $40 trillion fixed income replacement market. If you look, Athene was a public company. If you look at their performance over the last 10 years, it top tier ROEs as a public company, just great risk management. And there's a lot of embedded growth in Athene. And the synergies between Apollo and Athene are going to be significant, nascent, and it's not in any of the street numbers yet. The cash flows that will come out of Athene and the excess capital there is going to drive a lot of growth, I think, in earnings, in new products, and in high ROIC investments in the business. And look, the third is there's obviously, and this is not anything specific to the alts, but a dislocation in the market last year. I've never seen an environment where the alts will perform well when the VIX hits 25. And it's risk off in the sector when we have volatility. It's risk off when there's a recession. But the irony of these businesses is they actually create value when there's dislocations. And with the amount of dry powder that Apollo has, they've been leaning into that. And if you're a quarterly investor, yeah, you're going to trade out of it probably. But I'm a little bit longer term than a quarterly investor. So usually I'm a net buyer when there's risk off on the alts, because that's actually when you want to actually get involved with that. So those are the main reasons why transformation process, the Athene transaction, and just the macro environment of why we were given this opportunity of buying Apollo where it was a month or two ago. So fast forward to kind of where we are now, I think that, at the end of the day, you have basically 3 businesses now. And I won't get into the details given the time constraints, but the 3 businesses are very different in nature. You have what I call the management fee business, which is a long duration business. Blackstone for their, FRE. The business is the management fee business, which is again long duration capital, high margin, 50 to 60% margin, no capex, and very predictable. Blackstone gets 30 times on that. Apollo, a little bit younger in the development of the diversification. They do not have a capital markets business, but I give them kind of a lower 20s multiple on that fee business to get to about $50 to $60 of value. The second part of the business is, the carry that comes out of the business, the private equity business, and some of the other businesses. A lot of debate over the years on what the value of that business is. I've heard everything from nothing to 10 times, right, or 15 times. It's certainly more cyclical. It's certainly more episodic. But if I look at the most levered, excuse my language, or crappy industrial companies, they trade at 7 to 10 times. So, Apollo's been doing this for 30 plus years. They've had top tier IRRs. I think over a cycle, they've been able to prove themselves. I think over the next couple of years, they'll have about $1, $1.50 that comes out of fund, I think 9 and 10. And that will translate to another $10 to $15 of value. And I think that's a conservative number. So basically, just standalone FRE, and we should no longer be separating, Athene from Apollo. But I do, just to simplify kind of how to think about these businesses. So you got $60 to $70 of value just coming from FRE, performance fee. The insurance business, I think that I would say that I put a chalk multiple on it right now, despite the fact that, best in class ROEs. If you look at kind of simple math, $250 billion of AUM, put up 1% ROA, which has been consistent with the past, gets you to a pre-tax number, about $2 billion of after-tax earnings, and I think about 600, excuse me, I don't have my model in front of me, but call it 600 million shares. I think that translates into about almost $3 per share. And I put a 9, 10 times multiple. So you get to a $30 value just for Athene. So, when you put it all together, $70 core Apollo, $30 for, Athene, that's $100 of value. I wouldn't be surprised. So, if you go to their last investor day, they're going to spit out another $5 billion of free cash. That's after dividends, et cetera, and it's not clear what they'll do with it. My guess is, knowing Mark's high focus on ROIC, that they will create some value out of that $5 billion. It's not in my numbers, but so I think 100, 120. So I don't know what I think the stock is at 70 today. It's no longer a double, which is when I wrote it up. But I certainly think that you're looking at 70, 80% upside from where we are even today. And a nice little gift that SumZero and we've given you today with the pitch is a 10% off sale, a 7 to 8% off sale. I say I don't think it's going to last. Actually, I think that there's some disconnects with earnings and where street was, but I think net this is you're going to see this 7-8% downdraft today recover pretty quickly. Griff, how much time do I have?
You got about 10 minutes here.
Okay, so I'll finish up with a few things that that I think will happen and that will, you know, take us from where we are today to the 100 to 120 range. And then I'll leave a few minutes for questions. So, you know, the first thing is there's a number of catalysts here. The one that I'll start out with, and the one that I don't have a strong viewpoint on, but you know, I think the next leg for many of the alts, and I think Apollo and Blackstone are probably set up to be the ones where this happens, is an imminent S&P inclusion. It's not insignificant. And the reason for that is there aren't any alts in the S&P 500. We all know the amount of money that has gone into ETFs. We know that mutual funds are mimicking the indices and how that game works. And quite frankly, these are cheap, right? And they have a lot of upside. So I think that in the next 12 months or 24 months, we'll certainly see Blackstone and or Apollo. Apollo is one share, one class. So it actually has a leg up on Blackstone on getting into the index, albeit smaller market cap right now. But they are well positioned, I think, just from a structural perspective, to be added to the index. And that's going to be a big catalyst. Another catalyst is, if you look historically, Apollo's always offered a nice dividend. You know, they take and I'm not saying KKR, which I actually own, it is a bad way to do it, but you know, any incremental cash flow goes right to KKR's balance sheet. You know, as of right now, Apollo has a nice dividend, and that's going to open up and has opened up a massive base of yield investors. And today, I think they announced, I think their dividend was 160. I think they moved it up to $1.72 today. So that's another nice option, because that increase in dividend, which will naturally occur as AUM goes up, will naturally occur as the returns go up from the funds, will always have a baseline dividend and attract dividend investors. I think the other thing is Apollo has one of the most successful private equity businesses out there. And what you'll find if you actually do the work historically is, as these, and I think they raised a $25 billion fund, and then Blackstone raised a $26 billion fund. But you know, what tends to happen as these funds realize and go into monetization mode is, you know, there's obviously a carry split with insiders, but we as investors get that dividend, and that tends to be another catalyst to the stock. So we'll see that occurring over the next few years. The third catalyst is obviously what I've been talking about, is with Athene and the integration. We're obviously in a market where Athene has the ability to prove itself as a great credit manager, and you know, continue to put up those ROEs. And I think when people see the power of Apollo and Athene together, they'll realize that there are synergies there, and the pro forma business as well. But people, I think, are going to need to see, well, let me step back. People are going to understand what Athene really is. And from talking to a lot of people, they don't, right? So that's one, there's an education process. And then secondly, they're going to have to see how Athene performs in a market that we're in right now, which is, you know, and I'm not a macro guy, but certainly the volatility, the dislocations, rising interest rates, which, by the way, you know, should help Athene actually. And there's a thesis that doesn't help Athene. So I think there's a number of catalysts. one immediate one, and I apologize, I don't know the answer to this one, which was when they did the deal with CS's securities products business last year, there was a moratorium on their ability to buy back stock. And I'm not sure if that has lifted, but if it has, then there's another opportunity for them to buy back now. But obviously, another catalyst is they recognize their own stock is cheap, and they've been very proactive in buying back stock. So, overall, it's a catalyst-rich opportunity. I usually talk about catalysts when it comes to special situations because it's more relevant. But I think that, throw the catalyst outside of the analysis, and you still have a backdrop where you have a massive TAM, you have retail insurance industries growing, you have a business that's growing 20 to 25%, trading at a single digit earnings DE multiple. You have a new CEO who, in my opinion, is a rock star, and you have insiders that own almost 40% of the business. So it's I think it's set up really well amongst the entire alts universe. Hopefully I'll have some time for some questions.
Yeah, I think we are running up on our next segment here, Samir. So if anyone on the line has questions for Samir, don't hesitate to reach out to either the SC team or myself, and we can get you in touch with him, with any questions you might have regarding what he's up to. So appreciate it, Samir. Congrats again on the back-to-back win, and I'm sure we'll be hearing from you soon.
Great. Thanks, guys.
Thank you. That was Samir Parikh again with his pitch on Apollo. With that, I'll turn things over to Divya Miranda for our last segment here today.
Hey, everybody. Brad, can you hear me? There you go.
Yeah, I'm here. Can you hear me?
Yeah. So
Cool.
just to intro Brad Erickson, he's the internet analyst at RBC Capital Management. Brad, you cover Meta, Google, Amazon, Wix, and a number of other internet names. I know you've got a hard stop today around 4 Eastern, so I feel like we should just dive right into it. And what a day to dive into tech. I feel like ever since these Chat GPT announcements came out, big tech has been cratering except for Microsoft. So let's start off with Meta. I think, at least from our last email chain, this was your top pick for 2023, if not close to your top pick. I think it was your top pick. What would you say people like fundamentally don't understand about the business? There's been a lot of talk around all the different risks, regulatory, TikTok, et cetera. But is there one thing that people just, you talk to obviously buy side guys all the time, like they just don't get or just aren't willing to give them credit for?
Yeah, I mean, I think a lot of the hedge funds are there, is what I would say. So I don't know that those guys don't get anything, but I think on the long only side is where there's not as much sponsorship as there could. I feel like this is like a wall of worry to be climbed over the next, say, 1, 2, 3 years. And really what it is that, the Apple software changes that reduced their signal and their ability to attribute conversions for advertisers, that coincided, I should say, along at the same time when TikTok was inflecting and getting written up in the Wall Street Journal like every other day. And so you combine those two things, right? Long onlys, I've always been surprised how people hone in on the KPI of MAUs on these models, right? Like Facebook in particular, like they have 1 out of 2 humans almost. Like we're there, it's baked, like who cares, right? At this point, it's all about growing the value per user, essentially. But when TikTok sprung up and you had the signal loss, the story was completely broken all of a sudden, because now you've got like terminal value risk on Instagram, basically. And that's not, like, our view has been that if you look at the data, TikTok time spent in the United States, I think basically plateaued, if not peaked, in July of 2022. And Facebook and Instagram, surprisingly, are continuing to sort of show nice increases, which is probably a function of Reels, right? Short form video is proving to be far more addictive than traditional Instagram, which is great. And so I think what people don't get ultimately is that if Instagram is building on this and Reels is successful and TikTok's sort of this like stepchild at bay for the next few years, people realize Facebook still has structural advantage in terms of targeting. They have way more data than anybody else, so they're better at that. And they have the user growth. The story is the same as it was 3-4 years ago. So that's, I think, where people have to sort of steadily get over the hurdle over the next, year or two.
Yeah, let's talk about, you mentioned time spent. You run a lot of channel checks. I would love to hear, because I mean, this is the stuff that I feel like it's kind of glossed over in mainstream media. If you can just kind of talk through your channel checks and kind of what you're seeing on the ground.
Yeah, sure. So the Apple, I'll probably talk about it more. The Apple stuff was humongous. It destroyed so much goodwill with the small and medium-sized business advertisers that are so vital to this business. Probably 2/3 of the business or more, we think, is, call it, non-enterprise level advertisers and agencies. And it was like they woke up one day and they were like, I don't know what I'm getting anymore. I already thought Facebook was overinflating their reporting, and now it's gotten worse. Well, guess what? Screw you. I'm cutting my spend 20, 40, 100% in some cases. It was horrible last year. Our checks were terrible through the entire year. What's changed is that at some point, advertisers have to sell stuff, right? Whether they like Facebook or not, whether they like Instagram or not. And with this conversion improvement, we've been finding evidence of conversion improvement since they made some fairly significant changes back in kind of around September and October. They're winning back that goodwill. It's slow, right? You pull the rug out from a customer base like that, it's not going to happen. It's not going to come back overnight, but we are hearing very constructive commentary suggesting people are willing to reallocate dollars to Meta in a way that they weren't 6, 9, 12 months ago. So I think that's the overall sort of tone. And, separately, I think as we were, I think pretty well validated on this last print that like the SMB is getting marginally better on ad spend. If you see anybody in the mainstream media write about advertising right now, it's a disaster. It's terrible. It's as bad as it's ever been. On an absolute basis, yes. Relative to where we were in 22, not the case. It's getting better at this point.
Yeah, that's interesting. There are two things that management's talked about. One being improving measurement to sort of better answer the question of like, what is the actual ROI of investing ad dollars into the Facebook ecosystem or the Meta kind of ad ecosystem. The second is kind of sharpening the signal on targeting through the use of AI, which I feel like I've, at least on earnings calls, like I've gotten a little less clarity around. Like, so do you have any color on that? I'd like, if these are the two kind of components of the signal that was lost, one being like the ability for SMBs to target, the other one being their ability to measure the success of their ads or not, like where have they seen the greatest improvement in terms of overcoming all this Apple stuff?
Totally. So it's in an AI world, the measurement and performance, right? Measurement is kind of the leading indicator, performance is lagging. They sort of come together is the way I would say it. And what I mean by that is there's the big change is kind of two things. One is SK Ad Networks, which is Apple's sort of solution for measurement. They lengthened the attribution window, meaning the look back period on like when Facebook showed an ad versus what they think showed up conversion wise. They quadrupled it. They went from 7 to 28 days. So that's like a very basic one. That's not AI related. That's just very linear. But basically what what Meta has done is they're hooking up, they're doing what's called server-side attribution, server-side solution. They're hooking up CRM, like advertiser CRM, to their system, and then they're triangulating not only directly for the customers that sign up the CRM, but they're using the AI to create like probabilistic attribution, if that makes sense, based on like their broader book of business that is hooked up to CRM on the back end. So that's one thing they're doing. Another thing they're doing is the old world, they had an API, like if you were an advertiser, right? You're like whoever, you can hook up your CRM to Facebook to help with linear attribution. You do it, it sort of happens once, and then you go back to the drawing board every 3-6 months and you update it. What's different now is they've got the AI dynamically optimizing campaigns. So it's watching your CRM as well as anybody else's, particularly in the category. And it's saying, hey, you didn't know that you could sell to women over the age of 45. We're seeing conversion there. The AI goes there from a targeting perspective. So the performance is literally getting better real time. And what's happening is, you know, campaigns historically on Facebook last, I don't know, 3 days, 6 days, 10 days, something in that ballpark. People are letting campaigns run for like 3 months because they're finding there's better shelf life as the AI optimizes ongoing. And they're just getting long tail conversions that they never would have gotten before. So those
is that the Advantage Plus? Is that the Advantage Plus tool that they've built, or is that separate?
It's yes, but then there's also like Conversions API, CAPI, and there are third parties that have built their own sort of, call it sophisticated API, where they're helping their customers do this as well. So it's kind of an amalgamation of those things.
So like if you put yourself in the shoes of an advertiser, what % of these advertisers are basically letting Facebook figure out how to do the targeting based on AI tools today versus them doing all the customer segmentation and telling Facebook, look, we want, you know, 25 to 45 in Bozeman, Montana, whatever, you know, that kind of thing. Like I'm just how hands off is it now?
Which is another piece of the AI I didn't mention just right there, which is that's Advantage Plus. It's their version of what Google calls Performance Max. It's like AI channel allocation of dollars. Very small today, like probably less than 10 or 15%, I would say. Advantage Plus is, the adoption of it is going to be a little bit slow with the SMBs. It's a new interface within the ads manager. It's a little bit of like a leap of faith to develop campaigns on it. And they need the account management staff. They just did a layoff, so they're a little strapped there. And what we've heard is that people are trying to get sort of like training almost with account management, and there's a backlog there. So what you just described is Advantage Plus essentially. And I would say the vast minority of agencies and customers are using it at this point. Large enterprises, definitely, but like there's, you know, Facebook has 10 million plus advertisers on it, and there's no way 1 million of them are using this yet. So
in terms of the other side of the story was obviously operating expenses and expense reduction. And like one of the most interesting things that I thought Zuckerberg mentioned on the call was, you know, before he used to think, his mindset was like, okay, we like throw a bunch of bodies, you know, at every problem and just hire. And that in itself was kind of the path to growth. Now he sees the company obviously as more mature. And, you know, his view is that like, it's all like leaner, meaner, and, you know, that even the sort of product development side can improve with fewer people. It seems like a pretty significant 180 in terms of just like his philosophy on org structure and just how he's thinking about growth right now. I mean, do you think that's been sort of fully digested by investors, kind of the scale of that change in terms of how he's thinking about growing the organization? And by the way, I'll add, it's not just him. It's Bosworth. It's other guys. There are a lot of news about that guy Carmack, who was the ex-Oculus guy, who was always complaining about how there's too many people at Facebook that needed to be fired.
Well, the TikTok videos didn't help that, I imagine.
Right.
The daily new product manager videos. So yeah, I mean, it's kind of we took a look at this just on a revenue basis per head. Google is the highest revenue per head in all of internet at about $1.6 million per employee. After Facebook did their layoff, they're at about $1.3 million. So like, could you go higher? I mean, yes, they're meaningfully above most other companies. Could they go higher? Absolutely. I think with the CapEx cut, I think was the more sensitive topic on the quarter. And obviously the stock had a huge reaction last week. So in general, like, yeah, I think the OpEx I think it's like well reflected in the stock at whatever, $180 or thereabouts. I think from here, what people need confidence on for the stock to sort of like take another leg up is that you're not going to have to continue to ramp the CapEx between all of the AI stuff as well as whatever infrastructure spend around metaverse lies ahead. That to me, that's definitely like the more sensitive point. I think people can get their mitts around like OpEx moderating, clearly room for efficiency, but so much of the engineering and stuff is a black box. I think people, they kind of know they have to go pretty blind on that part of it. I think the CapEx is the much more important piece of the story here going forward.
Yeah. I'm just curious if any updated thoughts on kind of their efforts with respect to building new ecosystems. So Horizons is like I think part of their strategy of attracting teens, and that's the one where they got a ton of flack from, the press. I think it was the Journal that broke that they had targeted 500,000 users, but they only had 200,000 users in there. And just kind of like, how do you create kind of a Facebook-like level of engagement on Horizons, which is their kind of like metaverse ecosystem. I'm just curious if there's any news that.
No, I mean, it's interesting with the focus shifting back to cost cuts and what are they doing conversion wise and just, the ad market. It's amazing how little attention was spent on the earnings call or any of our callbacks. I mean, metaverse hardly came up at all. So, I don't think it's very controversial at the moment, obviously, but no, they need, I mean, just like maybe the preamble on the metaverse is like, it's going to look a lot like the web, right? You're going to have every company, any person who wants like a web presence going to have a metaverse presence. And on top of that, people need traffic, they need an audience. And so thus you're going to have all of the traditional sort of horizontal discovery platforms, social, search, e-com, all of those, right? And there's no reason Facebook can't be one of the ecosystems within that. Of course, the issue is for us, I mean, you've got a hardware adoption problem, right? Like nobody's ever sold more than like 50 million widgets of anything for like $400 in consumer electronics history. Like P&Ds, the freaking iPod, for God's sakes. Like Apple didn't sell more than 50 million iPods. Like, come on, how are they going to sell all these Oculus things? So clearly, and like you go back to smartphones, well, the carriers had a huge incentive to subsidize those in the early days to get everybody hooked on the data, and it worked. You don't have that with this case because they don't even control the ecosystem. There's no upside for like from a wireless carrier perspective or broadband provider. So like you're going to need to come up with a cheaper solution to drive the hardware or create the experience to drive that more. And until we get there, like I'm in the camp of like, I mean, Mark made the joke a couple calls ago, right? 2030 is going to be a big decade or something for us. Like, yeah.
So in terms of returning to positive top-line growth, I mean, I've always felt like WhatsApp is just such a sleeping giant. It's everyone's on it outside of the United States, and even in the United States, it's been growing. Do you think that click-to-message ads is the right strategy for making that work? I mean, it's obviously ramped up to being a multi-billion-dollar revenue run rate already. I guess, what do you see them doing with WhatsApp? Like, what do you think is the most exciting and interesting thing they can do there?
100% think that click to message is the best like go to market for growth today as the use case exists right now. The problem, and I would agree with sort of the sleeping giant comment, because anytime you have that big of an audience, right, and you're not able to monetize it, like you just gotta, you know, all you got, you're one product or one killer application away from inflection. The difference with WhatsApp, this has kind of always been my sort of broad view on this, is like the reason, to me, the reason WeChat is so successful in Asia is because the vast majority of the people that use it were introduced to the internet on the phone, right?
Mm-hmm.
Like we all generally were introduced on the desktop. And so we certainly use our phones a ton, but for whatever reason, as we grew up with these mobile ecosystems over the last, 15 years, we take very kindly to dedicated apps. We don't like some of these aggregation type tools, which of course is what, in a utopia of WhatsApp, that's what they would aspire to be, very much like WeChat, right? Text to click to message ads are, I think, a reasonable gateway drug to driving better adoption, to like, you know, being able to engage with some of the brands. And then all of a sudden you say, hey, I could order an Uber, I could, you know, order food delivery, I could do half a dozen other things with brands or companies I like or interface with. But it's going to take some compelling use case like customer service or what have you before you're going to really start to drive adoption. I would say certainly for Europe, definitely for like Latin America, it's super compelling because again, people just, I really believe that the correlation of how you got introduced to the internet is the key factor if you're going to use WhatsApp for a dozen type tasks and functionalities. But Americans, man, we're a tough nut to crack on that thing. So you know, 10 billion run rate's awesome, and it's certainly going to continue to grow. But yeah, I think it's going to be sort of slower and steady there versus some type of inflection.
Really quickly, how do you compare Google to Facebook today in terms of, I mean, I know Facebook's your top pick, but I'm just curious, why is that versus Google?
Yeah, so, I mean, let's talk ChatGPT in a second, but put that aside for a moment. Google gained probably $8 to $10 billion of share during the Apple signal loss period. And while we're not actually seeing any evidence of them giving those dollars back. Like I'm not seeing active reversion from Google to Meta for dollars that they lost a year ago. You're comping those dollars, right? Like that was a share gain. That was an outsized share gain year. And they launched Performance Max, which is their AI tool, which is like generally understood to over extract budget. Like the whole, I mean, whatever, we'll assume that Google's nefarious engine is able to extract excessive dollars. That's what advertisers believe. Is it true? I don't know, but that's the perception. So signal loss, Performance Max, huge share gains. You're lapping those in a tough ad market. The growth rates are probably potentially negative here, right? That's not a stock that's going to work. That's why I called Google more of a attractive second half setup. And you know, we've gotten a little extra lucky with some of the ChatGPT stuff that's happened here lately. So yeah, I think that's just core business wise, that's the issue. And Google doesn't guide as part of it. So they don't give you visibility. Facebook gives you a Q1 guide. So it guardrails my model and the others on the sell side that cover this. And you sort of know you're de-risked. With Google, you're going to have to sit around till April and July to see how good or bad Q2 is, and there's not a lot of comfort in that. And it's like, why would you buy this stock prior to sort of having more confidence in those numbers? So that's that. And then, yeah, ChatGPT, like, I mean, good Lord, who the heck knows? Like, you're clearly going to impair the user experience. I think there's a lot of agreement that Google ultimately will prove to have more tools and tighter integration and all sorts of advantages with whatever, the various solutions they're talking about. But I also think, like, where is the stock going to get dislocated to? Potentially a lot lower. And it's very, very hard. I mean, you've got terminal value risk all of a sudden for the first time in Google's history. That's never happened. So we don't know what the trough multiple looks like on that. So
have you looked into kind of the rebuttal though? And I see your point. There is this terminal value risk. People sort of assumed Google was in a monopoly, and in fact, I'm sure Lena Khan over at the SEC is very much of that camp. They've got. I mean, I've noticed certainly when I'm doing anything on search, for example, like even looking up something on YouTube, how uncannily smart Google is at figuring out what it is I'm looking for, which is clearly all AI powered. I haven't used Bard yet. I don't know if that's like something you download or whatever, but they do seem to be incredibly sophisticated as far as AI goes, and they, if anything, like we're sort of. I mean, their AI research, predates all of the stuff that we're seeing from most of these competitors. I mean, it feels like an overreaction. I don't know if that's your kind of gut feeling on it, or you actually think it's been a fair reaction.
Well, I think for the media, part of the reason I have a job is because I have the media to sort of like, in my view, maybe occasionally mischaracterize things. And I think this is a good example. The media is very focused on like the user experience and like, are people going to start using Bing and, all that, like the obvious sort of like first order effects of bringing ChatGPT to Bing and Google's inaccurate and all that stuff. That is obviously that's a risk. The real risk, like the reason the stock's trading down so heavily in the last few days, is because of one comment that Satya made at the launch, which was that gross margins for search are going to go down forever. That's the issue. It's a return on invested capital. And see, Mark Zuckerberg has already told us that AI costs a lot, right? I think on he was with Joe Rogan and he literally said, I could spend so much more than you guys even realize. If that's the case, like Google got asked the question on the earnings call, the CFO addressed it sort of about, hey, like, what does this mean for CapEx intensity in the future? And she said, well, gosh, we're already leveraging a variety of AI tools, have been for several years. And we look at everything through a sharp lens of ROIC, and, it's clearly not breaking the bank. So there was sort of, she kind of dismissed it, but I think the reality is that like, if you bring some of these tools, there's evidence that a chat GPT query is somewhere on the order of like 3 to 6 times as expensive as linear search, which is kind of insane, right? And so like, maybe they're leveraging a bunch of AI today, but we don't exactly know whether this more fully integrated solution is going to require a step function increase to CapEx and could put their margins in sort of terminal compression, that's the reason the stock goes down every day, honestly.
Why do you think Meta stock has gone down sort of in sympathy with Google? So not as much, obviously, but what's going on there? Is it just people think that there's going to be more competition in the ad sector down the road? Like what's the rationale?
I think it's probably a little bit of two things. One, it's just sympathy to its closest advertising peer. And then the other one is it's probably a little bit of reflection of fear around this CapEx intensity associated with the higher compute intensity with AI that I mentioned. The funny part is that, so I actually wrote about this just yesterday. I actually think Meta should be trading up on this. And the reason is twofold. One, I mean, they're investing in AI for what they can. It's in the numbers. So there's nothing, I don't think there's any like huge surprise coming there, where as Google, there is a risk around that. The content creation efficiencies that a natural language generative AI tool could create for marketers is extraordinary. We've already done checks on this. I've talked to marketers, advertisers, agencies. They're writing like 3/4 of like a marketing email or a slogan or whatever with ChatGPT. And then they're sort of like refining it at the end, but it's getting like really close to the brand message that they want. If you think about like spreading more content, more keywords, that sort of thing for lead generation, it could be really, really like expansionary for content for those that use social media for lead gen. And then, you know, obviously, you know, just around the fact that they are sort of
you're saying that
more.
you're saying that we should see like a new class of creators on the Meta family of apps that will be literally bots.
Sorry, say my earpod
But
died.
you know what I'm saying is
Say
like,
that one more time.
just are you saying that you know, Meta benefits from this this movement or this the Chat GPT kind of concept because there's going to be a lot of new content on, you know, created on the platform by like AI bots as opposed to, you know, real humans.
Yeah, that's right.
Yeah.
So there's like there's two things going on here. Number one, so short form video is a totally different surface than newsfeed or stories. The content for newsfeed and stories is often images. It's very static. It's easy to create. It's cheap to create. Short form video, it's hard, right? And in some cases, you got to pay creators, but like marketers don't even quite know what works on TikTok, on Reels yet. They're still learning. They're still going through that process. If you can use AI to create that, which by the way, that costs real money, all of a sudden you've got more dollars to plow into ads. So that's number one. Number two is if we assume that Google's search return on ad spend may go down because of this, right? Either because they're not getting as much traffic because it's going thing, or you're losing, you know, you're losing website visits, you're losing, businesses are losing the ability to compel people to come to your site. Well, I just said that Meta's ROAS is going up right now, and I think that's a persistent trend over the next year. Google's, in the eyes of investors, could be going down associated with ChatGPT. The way advertisers make decisions is they look at the return on ad spend on the tail of their spend, and they reallocate accordingly. So you could make a Google to Meta spend reversion argument very easily with all of this.
And on the subject of Reels, I know you've done some channel checks on that. What have you seen? I mean, I mean, from an anecdotal standpoint, I feel like I'm catching Reels all over the place, and I do think it is more addictive because I don't have to sit through a 10-minute video. But I'm curious what the data is showing on YouTube.
Yeah, I mean, it's yeah, we've done some work around ad load and that sort of thing. So maybe just for context, so on newsfeed, about 20% of like the total sort of content or impressions you see is ads. On stories, it's higher. It's actually closer to like 30%. We've measured Reels ourselves at anywhere between about 6 and 12%. So they are ramping up the ads. It's lower for people who use Reels less. It's higher for people that use Reels more, which makes total sense, right? They're getting you on, and you mentioned it, like they're absolutely pushing it, right? They're pushing you to like you look at a Reels video and stories and you don't even realize you've exited stories in many cases. So they're doing all of their little Jedi tricks to get you to move over. So the thing I'll say though is this is where TikTok struggles, and I think Reels will do better. Facebook knows so much more about their user. They have such a deeper, richer social graph about people that they're applying that to Reels, and the targeting is better. The performance of campaigns are better, and they saturate the audience far, not nearly as fast. On TikTok, they saturate the audience because TikTok doesn't know as much about the user, and so they run out of sort of like productive audience at a level of about, we think about 1/10 of Facebook. So like if you were spending 500 grand on TikTok, say, and 5 million on Facebook, you could spend more dollars on Facebook beyond 5 million and get pretty good return on ad spend. If you spent more than 500 on TikTok, your ROAS goes off a cliff after that point, is what the feedback from advertisers has suggested.
That is super interesting. Brad, I know you had to run. I don't know if you have any extra time. Did you want to chat about, did you want to say anything on Wix or Amazon and any of your other names before you hop in?
Yeah, sure. I'll hit it real fast. We got Expedia and Lyft here after the close, so that should be interesting. Yeah, so I upgraded the stock Wix. For those who don't know, it's an Israeli web design company. It's pretty small cap. It's like maybe like $4 billion company. But it's basically like the do-it-yourself website creation. If you're starting a cupcake shop or whatever, and you're on a shoestring, you can talk to Wix and you can literally easily design your whole site, even for selling cupcakes online. So it's full e-commerce and everything. Technically, it competes against Shopify, but it's a far cheaper, less sophisticated version. Shopify tends to be for bigger, so they sort of play in the same market, but not so much head to head. Anyways, we upgraded the stock on a few things. One, we've come through the new business formation hangover, if you will. There were so many new business formation exploded during COVID, and that has come back to earth. So we're kind of through that. But new business formation, we think, because of the availability of digital tools, is structurally ahead of 2019 levels and pre-pandemic. It's 30% ahead of 2019, given how bad, even with a bad-ish macro for SMBs. So that's that. And then, we think they're going to continue to gain share from WordPress. 45% of the world's websites are written on WordPress. And WordPress is not a good platform for anybody who's tried it. It's very clunky. And we do think Wix can continue to gain share there. And then what's sexy in 2023? Free cash flow stories. This thing, they've cut a lot of costs. They've overspent on all sorts of things, sales and marketing, some product development. They've streamlined their cost structure, and they've got a 3-year plan, and the stock's very reasonable. So it's more of kind of a defensive play, given all the cross currents going on in the macro. But as in my space of consumer internet, especially for some of these lower quality names that have start the year, this one's a more sort of defensive play, but one that I think is compelling.
Awesome. Brad, this is great, super insightful. Thanks for taking the time, and thanks to everyone who's joined us throughout the day. It's been a long day, but certainly information packed. And again, if anyone wants to follow with any of the speakers, please reach out to us. I will say also, all the research that we've talked, or all the names that have been talked about today, are also on SumZero, including Wix. Actually, rather great research on Wix on SumZero as well. But we're looking forward to doing this again next year. Hope you guys got a lot out of it, and thanks again for joining.